What's up, Tasty Nation? Happy Monday. It is June 29th. We've got a short week ahead of us with the observed 4th of July holiday on Friday, which means if you have any trades or things you want to adjust, the last day to do that is Thursday. There's about a 115-point implied move in SPX for the week, so it seems like it'll be a little quiet, but there are some interesting things around the corner. You've got Nike earnings, you got Constellation Brands earnings, and I think most importantly, you've got a jobs report on Thursday morning that could push or pull the market in a pretty big way, as that is a potential indicator for interest rates being higher for longer. But my name is Mike Butler. I'm here with Jermal, Chandler, and our very own Gus Downing. Guys, happy Monday. How was your weekend?
Happy Monday. It was great. Mine was pretty chill. It's a chill weekend where you barely remember what you did. And so, that was the weekend. My wife tried to get us to watch some movie, and I was like, nah, pass. Just want to be lazy. That was mostly the weekend.
That was it. That was the highlight.
Watching a movie was too much activity?
I didn't even watch. No, I didn't even watch the movie. That's what I'm saying. I passed on it. That was too much activity. It was, yeah. Because I know this weekend's going to be busy. We're going to Wisconsin. We're going to be at the cabin with the fam. We're going to be on the lake and hanging on the river and with four-wheel driving, just all of that. So I'm saving up energy.
Oh yeah.
What's up with you?
Good to recharge sometimes. Oh, good weekend for me. I went to the pool on Saturday. Real chill there. Still taking it real easy with this back situation, but was feeling good enough to lay in a lounger and sit in the hot tub. Then went to a White Sox game yesterday, which was eventful for the first 4 innings, and then pretty slow after that. But had a good time.
Did they win yesterday?
Nice seats in the shade, so always good to stay out of the sun. No, they lost 5-4 yesterday.
Did they play?
Royals, Kansas City.
Good. Yes. White Sox lost. I'm a Cubs fan. That's right. I'm just kidding. They actually look good, man.
Oh, they were fun. They're definitely fun. Yeah, I went to the wrong golf course. I did a little too much activity yesterday. Drove to the wrong golf course, texted my friends. I'm like, I'm here. They're like, no, I'm here. I'm like, no, I'm here. And they're like, look at the reservation. And I was like, oh, we are not playing at Indian Boundary near O'Hare. We're playing at Blue Island on the south side of Chicago.
Oh,
so I went about 30 minutes in the wrong direction. Missed about 3 holes. And then had some, rage shots.
Yeah.
Before I started to calm down. But
yeah.
No, it was fun.
Nice.
But yeah. E and I did the first call yesterday. E-minis were up like 30 points at that point. NASDAQ was up 100. We are doubling that now with the E-minis up 62. The NASDAQ up 350. So it could be a nice green day today, but these things have been pretty wishy-washy this last couple of weeks. And vol, although we are still in contango, of course, all these contracts are near 19 and 20, and we're pretty flat here, which is interesting to see.
Yeah, it's kind of interesting how it popped up already. Because I feel like it was, what was it, like 20 and change when you guys did the show?
Yeah, 20, 30, something like that. Opened flat and then caught a bid. But
I haven't seen all the different things yet, but I did see something going on with SpaceX and Charter. Apparently, they might be working on doing something together. I'm sorry if we were going to do that one. My bad. No. We'll get to that in a second. But speaking of, we got a lot of stuff coming. I mean, we got Gus here. Obviously, he's going to do money maps, and he's going to lay out the land on different things that he's seeing. We're going to do a math check with Mike, of course. We got a signal versus noise. Chris is going to be coming in to give you the rundown there on signal versus noise and what we're seeing as far as flows. And then, of course, the lovely Liz Deerking is going to come in, and we're going to chat with her and hang out. We have a guest, Peter Reznicek, a founder of ShadowTrader.net. It's going to show up. Hopefully, I didn't mess Peter's name up. I might have. I'll ask Peter about it when he shows up. We're going to have E live from the CBOE. We're going to have Tim Knight showing us his charts. We're going to have Julia doing some research stuff. And then we're going to have TP remote as well. And finally, end it off with Dr. Jim. So we got a great show for you guys. Got a great show.
Indeed. Well, Gus, as has been tradition in the last couple of sessions here, you've been showing us some stocks to look at. What do you got for us today?
Yeah, I got quite a few today. Jermal beat me to the punch a little bit on Charter and SpaceX. SpaceX actually taking inflows from 2 directions today. It's up itself, which people are accrediting to the fact that it's going to be included in the NASDAQ 100 before trading starts on July 7th. So that didn't take very long. I know there was discussions about potentially adding this to the NASDAQ before it even IPO'd, which would have obviously been historic, but NASDAQ decided they were going to wait a couple weeks. But yes, before trading on July 7th, we're going to see SpaceX included in the NASDAQ. And then on the other side of the coin for SpaceX, yes, Charter Communications is up about 20% on a Bloomberg report from Friday after the close that said SpaceX has held exclusive talks with Charter Communications about launching a commercial phone product. So SpaceX potentially looking to roll out their own smartphone on that side of the equation as well, would tie right in with Starlink. And then, I don't know, Starlink isn't satellite cell service, it's Wi-Fi, it's internet. So I don't know if ASTS comes into the equation there, exactly how they would get that to market. But yes, Charter, SpaceX working together on a potential consumer mobile phone.
They're up a few bucks to ASTS, and so is Rocket Lab. So the whole space is moving around a little bit.
Yeah, Rocket Lab's up pretty big here, up almost 10 points pre-market. SpaceX up 4-ish, but who'd have thought SpaceX would be the new phone provider?
yeah. Elon
After all this,
wanted to own everything. He's making X into a bank now, which I do think that X money is a very interesting value proposition as well. I think that just went live on Thursday or Friday last week.
Really?
And yeah, I suppose he's saying, why don't we have a phone? We have it. We have a version of everything else. Let's get a phone going. So yeah, Tesla phone, space phone. I don't know. Beyond that, we have Comcast trading up big, about 20%, as they announced that they are going to spin off NBC Universal and Sky Entertainment. It's expected to be completed in about 1 year. Comcast co-CEO Mike Cavanaugh is going to be the leader at NBC Universal, while former Comcast CFO Mike Angelakis, my best guess, will become chief of the new telecommunications company. So we're going to have Comcast Telecommunications and then Comcast Media, which is NBC Universal, Sky Entertainment.
The two mics is what I heard.
It is.
Mics are going to be in charge.
It's two mics.
Yeah.
A Mike and a Michael, I suppose.
I mean, it's kind of interesting. Just the two names you named so far are getting kind of a shot in the arm, if you will. Both of them are names that like nobody pays attention to or talks about, and yeah, all of a sudden they got some news and some business going on, and they're trying to find ways to make their stock, their shareholders, I guess, happy and make the stocks viable again. So kind of interesting.
This is like a great example of maybe not a perfect example, but I have 100 shares of stock in like Under Armour, Snapchat, and they're like a couple $100 losers here and there. But this is an example of like, I don't see a reason to close these shares because eventually I'm like, they're either going to just chop around here and it's going to be a non-event, or something like this could happen, something could change, and all of a sudden the stock doubles or triples over time and you get your money back. So,
and or a buyout or something.
Yeah. There's so many things that could happen. Like Ford, I closed that a couple of years ago. Similar scenario where it was like up $6 for literally no reason, just like noise. And you might have that opportunity. So,
well, yeah, and it just takes a little bit of attention to make that happen as well. Because this Comcast move, I really don't understand it. It's not like anything is fundamentally changing about the business. They haven't added anything new. It's not like they're going to have a bunch of new revenue coming in or anything. But they just say we're gonna spin this off. We're gonna make NBC Universal and Sky into their own company, and then for some reason that warrants Comcast surging 20% on just shuffling things around. You know, it's like if you ever seen an episode of Hoarders, whenever they're trying to clean those houses out, people just want to move things around to a different area of the house. That's all we're doing here with Comcast. So yeah, I can just little things, and yeah, the Snapchat spectacles. I'm surprised those couldn't save you. I don't know why anyone wouldn't want a pair of those giant things.
yeah.
Last thing I have on the docket here is Rocket Lab, which we alluded to already. Rocket Lab and Iridium Communications both up. Rocket Lab announced that it is acquiring Iridium, and the merger will combine the company's launch capabilities with Iridium's satellite communications network. So Rocket Lab up about 10% on that news. Iridium taking the bulk of it, up about 20%.
Beautiful. How big is this Iridium? Was that which stock is that?
I'm actually not all too sure. It's IR. What is it? IRDM. Yes.
Yeah. Just curious. I mean, because it's interesting because the stock is up. Rocket Lab is up on their acquisition. I mean, a lot of times, we've said this before, the acquirer ends up being down in that situation. Just depends on how much you're giving up. I don't imagine it's all cash. I really don't know Rocket Lab's situation, how cash flush they are. I just assume they're not. So it's kind of fascinating that the stock is up on that. People love it, I guess.
Yeah, Iridium.
4 billion, 4.6 billion.
Yeah, they did 875 million in revenue last year. 43 PE ratio, so nothing too crazy. 37 Ford PE.
Damn, Rocket Lab is 48 billion. I didn't realize that.
Yeah, Rocket Lab has really been surging the whole space sector. Everybody's all excited.
Yeah, really.
That NASA ETF I know has been very popular.
I think it's safe to say I've kind of lost sight of how big some companies are. You know, it's an exercise we could probably do when we start the tasty trivia someday about options trading or stock trading. Like, I forget sometimes how big. So we talk about the huge $1 trillion names all the time, but like just a random name, you know, like how big is MicroStrategy? What's the market cap? I actually don't know off the top of my head. You know, I'd have to guess, and it would be a big time guess. You know, like it's kind of I'm just losing track. I think.
Well, I think it's an interesting exercise because like Micron is a stock that has obviously gone from 3 months ago it was at 300, now it's at 1100, and it's flirting with 1200 every day. But when you look at the market cap of Micron, it's a $1 trillion company. They just hit that a couple weeks ago for the first time. But let's say you believe that Micron could eventually be a $2 trillion company, or like in the realm of the other Mag7 stocks when you think of Microsoft, Apple, Amazon, all those companies. Well, that would mean Micron's stock price would double unless they do some kind of split or something like that. Mm-hmm. So I think that's always interesting. SoFi is another one. So like SoFi has been up and down. It's been really volatile, but this is another one that was at 10, gapped up to 30. Now it's at 17. But you look at something like this, and this is only a $22 billion company.
That was a guess.
So if you think that this is going to be eventually a $100 billion company, well, you're looking at a 5x in the stock price. So I think it's always interesting to think about the market cap, and if you feel like you have a better idea of like, oh, this company does X, Y, and Z, this is their forecast, they could be this big in terms of market cap, that directly affects the stock price movement over time. So,
and yeah, that was the first. That's why it's the first thing I thought of. You talk about buyouts. You always got to think about market cap. Does this make sense? I can't remember which one was more recent, but there was some buyout mentioned sometime in the last few months, and it was like GameStop, right? It was like, this is stupid. This is not happening.
Oh yeah, GameStop,
right?
eBay.
Like you gotta when you realize, you know, like again, we're just talking about Rocket Lab buying a $6 billion company. Rocket Lab is $48 billion. They can handle that easy. Whether it's stock, whether it's cash, it's fine. But that GameStop situation, that was stupid. There was no chance.
That was so stupid. They were like, we have $40 billion, and we would like to buy your company for $55 billion.
Yeah, come on. That's not happening.
Somehow.
Like, you're not that far gone yet where things like that are happening. Well, just look at our website. It's on the website. What?
Yeah, I do think it's interesting, too, the way that all these valuations grow, because everything kind of grows side by side with the broader economy. You know, it's like an analogy people will use to talk about like the universe is that it's like raisin bread cooking. You have a bunch of raisins in the bread, and the whole bread is rising, so they're all moving further apart at the same time. Sort of what it feels like with these companies, too. It's like the way that all this money gets passed around, particularly in the AI space. People give $1 billion here, $5 billion there, and it's all the same money. But NVIDIA gives $5 billion to Intel, and then both companies increase in valuation. And so it's all this money being created everywhere. And you absolutely see the same thing in the space sector with Rocket Lab, ASTS, whatever. SpaceX, they all do launches for each other. Rocket Lab has a successful launch for ASTS. Both companies jump. So yeah, it's all growing in unison for sure. Is money real? These are the questions.
I think aliens are real, and they're trying to reach us, but because of the raisin bread,
it's true. They keep moving further away from us.
It's funny that's what I thought of when you said that. I was like, these aliens can't reach us.
Fun fact: aliens are allergic to raisin bread. I don't know.
There we go.
So when the alien invasion happens, just throw raisin bread out.
Valuable insights every day on Tastylive.
Speaking of, give us what you think in the YouTube chat. We're streaming live there. Just pop over to the Tastylive channel, and you can throw in your trade ideas, questions along the right side chat there. We'll be broadcasting all morning and all of the rest of the market day. But we're going to take a quick 90-second break. We'll be back with a math check related to Bitcoin on the other side of it. You're watching Tastylive.
Mike, what does it mean to be assigned?
When you are assigned, you are ultimately short an option that's in the money, and the counterparty has the ability to exercise that option. So if you are assigned, it means your option, against your will, ultimately, has turned into 100 shares of long or short stock.
What does a green scratch mean?
Ooh, a green scratch refers to stubbornness getting the best of you. And when I say you, I mean me. Green scratch refers to rolling a position, defending a position, and instead of just closing it for less than loss that you're seeing, or maybe a $100 loss, $50 loss, a green scratch is when you close it for maybe a 5-cent winner, 10-cent winner, 15-cent winner. Just the ability to see that green number on your screen and get out in a profitable way as opposed to a loss.
Putting on strategies, that's easy. Taking off strategies, that's also pretty easy. But what do you do with everything in between? Well, in our Options Crash Course Strategy Series, we're going to show you how to handle the winners. We're going to show you how to handle the losers. But most importantly, we're going to show you how to handle everything in between with simple and clear guidelines and reference points. We'll see you guys there.
Bitcoin is sitting around $60,000, a level many traders see as a make or break level. Historically, bear markets have ended after 77% to 85% declines, but this cycle is only down about 54% so far. Bulls argue institutional adoption and ETFs have changed the old 4-year cycle, while bears say the worst is still ahead. Meanwhile, IBIT options are pricing just 52% implied volatility. Surprisingly calm given forecasts that range from 42K to 250K in Bitcoin price. So the real question is, are options underpricing one of Bitcoin's biggest inflection point in years? Let's check it out on today's episode of Options Math Check. So Jermal, I know we have been trading IBIT, we've been trading Bitcoin, we've even been dabbling in MicroStrategy. And it feels like nobody wants to touch this thing, but we've talked about this before. Like maybe that's the time to get in.
Exactly that. Look, I mean, I'm not really here to debate whether or not Bitcoin is something that's viable, or something we're going to have in 100 years, or where Bitcoin is, or all that. I really don't know. I mean, that's there's a lot of people who want to debate that. It's a non-traditional asset. It is what it is. And so as a result, I'm trading it in that way. And I've tried to find ways to get long at these levels. I've done it via the short puts and IBIT. I haven't added to any personal Bitcoin positions though, which is interesting. I probably should think about doing more of that, but it's mostly been the trading in IBIT more recently. And the personal, I should say, I haven't added to personal Bitcoin positions, but I've done everything via IBIT. And so in a personal account, I've gone out and leaps and I've done a long call in IBIT. In the trading account that we trade every day, I have short puts. I just told you the other day, this happened on Friday. I was short the August 35 put in Bitcoin and stock dropped to 32, I think on Thursday. And overnight, I was assigned on 100 shares. There was $200 of worth extrinsic value in the call on the other side. That is a mistake. Like somebody made a mistake in assigning me on that put. I will take that all day long, sure. And to your point, I just immediately sold the put again, as you mentioned to me that happened to you once before. So I don't know what that means. I think it means that there's some people that are panicking out there, honestly, right now because of where the stock is, and understandably so, and all the negative sentiment that's around Bitcoin and MicroStrategies, as it were. But I find this, I find the price point, and you're talking about IBIT at $33. I find that very attractive, and I think it's worth taking a shot.
Yeah, I agree. I think at $33 per share, when it comes to IBIT specifically, you have the ability to participate in a really small way. And even though IV ranks at 37 on the lower end, when you look at the actual implied volatility for all of these cycles, it's still in the 50s, which is healthy for premium selling opportunities. We have a handful of positions in here, but I did want to look at August 1st, December. I think this is really interesting. So IBIT is likely going to open right around 34. And if we look at August, looking at the 30 strike put, 4 points out of the money, and then you look at the 38 strike call, 4 points out of the money, there is a significantly higher probability of being in the money to the downside based on current implied volatility. And you have a little bit of put skew here, which is really interesting. I think this is the first time I've seen put skew in IBIT.
Yeah.
I'm sure it's been here for a little bit, but I haven't looked. But
Me neither.
really interesting to see put skew because traditionally you've had call skew in Bitcoin products because of their propensity to make big moves to the upside in short periods of time, which is similar to like Micron and all these other tech stocks that have been just going straight up. Like Bitcoin and these other products that move up in a big way almost always have call skew. So the fact that they have put skew here and a higher probability to the downside, 4 points out of the money through August is really interesting. I think it speaks to the fear that is in this market today.
In a world where everybody's kind of focused on near-term stuff, 0 DTE, 1 DTE, for lack of a better phrase, get rich quick stuff, I think this is an example of something where you got to go further out, I think, to sort of get past all the noise that is currently around Bitcoin, which is very negative. It's very negative sentiment. I think you got to go further out. I think you have to go to August or maybe even Dece or maybe even Jan to put a position. I think it's better that way because then you're not as focused on the near term, which right now, it's just not, of interest overall, not just the trading, but again, we joke about this at times here around Tastylive. We've done a lot of content around Bitcoin more recently, and the people aren't as interested, and understandably so, because it's just not moving in the way that tech stocks are. So I think you got to go further out on something like this, and maybe, in 6 months, people are a little bit more interested in Bitcoin again.
Yeah, 100%. And when you go out to December, you see your traditional call skew here, looking at the same exact strikes at 30, 38, $2.40 with against a $270 option to the upside. So seeing more call skew further out in time, which is really interesting. And I think to your point, I think it sets up different strategies. Like in SpaceX, I sold a put to buy a call, long-term call. I think if you're a believer that Bitcoin will eventually rally, and if it rallies quickly, you'll have call skew get infused more into this product, then that kind of strategy makes a ton of sense. But I think if you were to do it in August or September, any of these cycles where you can see put skew a little bit, you're actually getting a better setup where you're collecting more value for the short put. And if you wanted to swap this and buy this call, you're picking up a 20-cent credit. You have no risk in the middle, and you have this asymmetric risk-reward profile to the upside while still picking up a credit. And your break even would be down just under 30, which is another 10% move to the downside from here. So I think that's really interesting, and that would really put you at like 55K in Bitcoin. But we're trading it. We're still active. IBIT is one of those products where we'll probably have a position on at all times just because of the premium and the price point. But yeah, let us know what you think in the YouTube comments below, and we'll see where Bitcoin goes. But we're still trading it. Really interesting to see the difference in the skews there. But we're going to take a quick break. We'll be back on the other side of it. You're watching Tastylive.
What is theta? Options lose part of their value over time as they get closer to expiration. That's why they're called wasting assets. Theta is how fast the option's value changes in a day, not taking any other factors into account. Way far out, an option's price doesn't change as much as time passes, but at about 60 days till expiration, the time part of the option's price starts falling, and at around 45 days to expirations, it starts dropping much faster. If you bought an option, you'll feel time decay pushing down on that option's price. If you sold the option, though, time is on your side, and keeping the credit from the opening trade becomes more likely. Even though options lose their value over time, Tasty mechanics say to exit the trade near 21 days till expiration. Remember, gamma risk gets stronger in the last several days, and stock movements will have more of an effect on options prices. Again, theta is just the rate at which options lose part of their value. Pretty simple.
It's time to trade smart, post-PDT rule elimination. And Tasty Trade has the tools traders need. The Active Trader tab's comprehensive market data is designed for rapid order placement in a single click, while bracket orders let traders set entry, profit target, and stop loss all in one ticket. From the Positions tab, you can monitor positions, roll trades, close positions, and create conditional orders. Now, traders of all account sizes have more flexibility than ever before to engage in the markets. Smart tools for smart traders. Tasty.
Investors Business Daily raves about us. Stockbrokers.com says we're best in class for futures trading, and Broker Chooser thinks we're pretty great too. So what else can we say other than trade like a trader? Tasty Trade.
What's up, everyone? Welcome back to the show. My name is Mike Butler. I'm here with Jermal, Chandler. E-minis are up 60 points. Nasdaq's up 300. Dow and the Russell are up as well. We got Chris Vecchio on the line, and I hope, Chris, you had a glorious weekend. What do you think about these markets right now?
The war is only on from 4 p.m. Eastern on Fridays until 5:55 Eastern on Sundays, apparently. We're seeing it again here. But that's not really the focus of this conversation. We're doing a little bit of a live signal versus noise here on the morning show. And I think that given the weekend's news, in particular, what happened in South Korea, we should be paying more attention to the tape for the semiconductors right now. And they're two of the more popular names that we've seen around here, Intel and AMD, both which have seen some serious put buying in recent sessions. Last week, traders put about 26 million into downside premium across the two names. Intel took about 15.7 million of that, and AMD took the rest, about 10.3 million. The single largest trade that we see on the options tape is the July 17th 130 put in Intel, 18 days out, 14.6 million on more than 13,000 contracts. AMD saw a clustering of short-dated puts around the 515 to 520 area, plus a few same-week downside bets as the stock started to wobble in recent sessions. But Jermal, I mean, you and I have been doing this for a while. This kind of has a familiar feel to it. We saw a similar setup in Micron and SanDisk, where the fundamentals were spectacular, but the options tape saw traders paying for downside after what had been, a significant vertical move to the upside here. And you're seeing that Intel and AMD are more or less getting the same treatment here. Short-dated puts are targeting a very quick fade in some of these names right now. The July and October trades that were set through give traders a little bit more room to breathe, but this is the kind of activity that happens when sector leadership starts to get crowded. No one wants to declare the trade dead at the moment, so the first shifts are a little bit more subtle. Paying for put protection, winning positions start to get trimmed. The same stocks that everyone likes to trade and own become a prime source of liquidity as funds get shifted around. I think, Jermal, when we talk about Intel here, just last week we were discussing Nancy Pelosi buying more than $5 million in Intel calls. Immediately after that disclosure, we see someone come on the board and put up 15 million in Intel puts. So arguably the most famous political trader in the country right now is long deep in the money calls, while you have an anonymous, who knows what their book may be, paying for downside on the same stock. I think that's one of our classic signal versus noise setups around here. But Intel has been one of the most shorted names in the Dow all year, so puts are joining a fairly crowded bearish trade right now. And that can cut both ways, right? If the stock continues to sag, the downside pressure builds. But if this thing goes vertical and you get another leg to the upside, that is a lot of short positioning that can be fuel for a squeeze higher right now. So this tape, it started to look tired a little bit. We know that NVIDIA's moved into correction territory, more than 10% off the highs. We've seen AMD, Intel, TSM all drop together. That spark, of course, was Broadcom's earnings a few weeks back when it did post pretty good Q2 numbers. Q3 guidance was poor, and it fell 14% in a single session. But the headlines have been fast and furious, right? Apple last week announced that they're raising prices on their iPads, their MacBooks, because of the memory costs. Hyperscalers are still plowing towards $750 billion worth of capital expenditures this year. And SpaceX is doing all these bond offerings. So again, we have all this great news. We have all this fantastic earnings information. And yet traders are acting like this is getting to become a little bit of a tired trade here right now. Guys, before you guys cut in at the moment, just consider the run that Intel's had here as traders start to lay out these bets, similar to what we saw in SanDisk or in Micron recently. It's up 248% year to date, 5x in over a year, and up 580% from last August's low of $19. It has hit a record of 141 recently, and while it's given back 9%. We do see here that this is a market that's been largely driven by geopolitical and political headlines. The government took a 10% stake in Intel at $10.47, putting in about $8.9 billion, becoming its biggest shareholder. Nvidia had added $5 billion, SoftBank added $2 billion, Apple signed on for chips. AI represents about 60% of Intel's revenue here, up from about 25% a year ago. So the story has clearly shifted right now. But are you getting a good bang for your buck? And that is always the question. What are the odds that we go up another 500% over the next year? Probably unlikely. Jermal, we can take a step back before I continue further. But when I'm thinking about these trade setups, this is a familiar pattern right now. There's a lot of folks who have seen double-digit, triple-digit, in the case of SanDisk, quadruple-digit gains over the past 12 to 18 months. I look a lot of this put-buying activity as probably people protecting their gains, protecting their stock holdings, not necessarily saying that this thing is over just yet.
Yeah, let's turn these into weekly charts, and I think that tells the real story in some ways. I mean, many of these trades you mentioned, Chris, are probably noise, but the one Intel trade is definitely signal. I think 13,000 contracts going up, 14 million just in an 18-day period. But when you look at these on a weekly chart, right? Like look at Intel this past week, look at SMH. You can just start pulling at whatever one's up you, because basically they all kind of look the same. To Chris's point, I mean, I think there's some exhaustion here. And I think that's what somebody is looking for and trying to take advantage of. I mean, last week was fairly weak when you look at some of these names. NVIDIA, we saw Mike and I jumped into Apple. Again, it's not the same as the rest of these, but Apple, I mean, huge move to the downside, raising prices. I mean, that should mean more revenue, right? But for whatever reason, it did not. The stock did not respond that way. And I think that was kind of emblematic of what we saw a lot of those names throughout the week. So I think many people are starting to try and play into some of these names to the downside. It's expensive. I mean, I'm not going to lie. I find that interesting when people are paying up for these puts, and they're expensive, implied volatility wise, but they're looking for big falls. And again, you just look at these weekly charts and you can see that can happen at some point in time. So I think they're just trying to play for that. At some point, maybe we see that. At some point, we do. I always figured if it happens, Mike, like it's going to be like a rotation into some of these other areas of the market that we talk about all the time, the Costcos, the Walmarts, consumer staples. And it might just be short-lived. I don't know if these guys make full freight on the positions that they're laying out here. Maybe in the Intel one, because they did the 130s, is a little more at the money. But some of these other positions are a little out of the money, but who knows? Maybe it works out for them. What do you think?
Yeah, I think when you have something that explodes to the upside so quickly, you're going to have your pullbacks. And we saw that in Micron. Like even the darling of the last month has had its big intraday range. And this is the weekly chart, like you said. This is a 250 point range for the week. So you're going to see big pullbacks in these things. I think what's interesting is when Chris brought up, what's the probability of this thing having another 500% move? Some of these stocks they're at interesting price points, right? You might look at SanDisk at 2,000 and be like, oh, this must be a super expensive or huge market cap stock. It's not really. I mean, yes, it's increased dramatically, but 310 billion isn't too big these days. Micron's at 1.28 trillion. So if you were to think that SanDisk were to get a quarter of the size of Micron, it's ultimately there. But if it grows anymore, like you're going to see the price of the stock increase dramatically. And I think it's always interesting to bring that into focus. And Intel, similar story, 645 billion. If you think any of these get up to $1 trillion, like you're going to see the stock price almost double in Intel and triple in SanDisk. So SanDisk probably would have a stock split. But I mean, what's the probability of them becoming $1 trillion company? I don't know right now, but at least you can see the market is saying these stocks are no longer the dusty stocks that we've seen over the last 15 years.
I think that's absolutely right. And the problem that some of these traders may have in the short term, particularly if you're leaning short right now, this is the window that a lot of the seasonal folks call Christmas in July. The final 3 days of June, coupled with the first 9 of July, have averaged 2.5% over the past almost 40 years, actually, since 1985, 40 years now. 78% of the time higher during that window. So you're getting a little bit of a bounce here today. And if this is another Christmas in July, just like we just saw the June swoon, June soon worked out perfectly well. If you were short the market June 18th through June 26th, you made a few bucks. So if you follow the July, Christmas and July seasonality here, this isn't exactly the most opportune window to be laying out short-dated puts if you're going to be aggressively bearish. Now, the news overnight, I keep stressing this, and I've been talking about it in the morning note, it feels like for months now at this point in time. But governments are treating the compute build-out and the AI build-out to the same degree that they've treated national defense and energy security. So what do you see in South Korea? A floor of sorts being put under the trade right now for Samsung, for SK Hynix. All good news. When does the trade end is the question a lot of people are asking, and it's the reflexivity of markets, the George Soros reflexivity of markets. High prices invite more capital induces more supply induces lower prices. So when will the supply catch up? We don't know. For now, I'm a momentum guy, so I'm going to keep pushing these things to the upside and buying at the 1 month moving average until I get smacked in the face. And for now, it's working. So all this to me is just noise as long as the charts keep pointing from bottom left to top right.
I'm with you on that. I'm with you on that.
Agreed. Yeah, I think it's a shift in the winds for sure, but there's always going to be opportunities out there. You just got to trade it intelligently, keep that size in check. And I mean, I think this is one of the times where I've been putting on a lot more long-term, like short put to buy call type situation, just in case it keeps going. I want to be paid, but do it in an intelligent, efficient way. Well, Chris, thank you very much for your insights. We will see you a little bit later on today. E-minis up 63, NASDAQ up 350, Dow and the Russell catching a bid as well. But why don't we pop over to the YouTube chat, see what the people have for us today. Again, if you haven't joined us there, just pop over to Tastylive. You can throw in your trade ideas questions along the right-hand side chat.
Yeah, we got somebody here asking about beta to delta metric. I'm not sure. Do you use that? I don't really use
beta weighted delta.
They must be talking about beta weighted deltas. Yeah. Could you show how to use the beta delta? Must be beta weighted deltas metric to keep your portfolio balanced, and what you do in unexpected movements alter that figure.
So I don't have beta weighted delta in my view right here. I'll add it in the future, but yeah, you can add that if you go to, first of all, beta weighted delta is automatically SPY. But what's interesting is if you wanted to change it to something like the NASDAQ, you could do that. So if you're trading more tech sector, I would argue that you should do that. SPY is obviously going to be more sector diverse, but the default on the platform is right here, beta weighted delta and SPY. And if you wanted to add more columns and things like that, you can do so by just clicking this gear in the upper right. But for me, I think when you have beta weighted delta, if you have a ton of positions, like I have a good amount of positions, but a lot of these are kind of leftover positions or positions that I'm not actively managing. The more positions you have, I think the more beta weighted delta makes a difference because your single positions don't have as large of a weight on the overall impact. If I only had like 4 or 5 positions, I would really just be isolated and focused on those 4 or 5 names relative to beta weighted delta. But I think it's interesting to see, like, if you have a bunch of positions on and maybe you're layering on positions and you think that you're getting diversity with, like, let's say you have a lot of bullish tech sector positions and you're trying to layer on some other positions, then you look at the beta weighted delta and you're like, oh, these are essentially the same if you weight it to SPY. So I think it's, at the very least, it gives you a better idea of what your portfolio sector diversity is. But I know for a fact, like, I'm basically long all these tech stocks. I have some downside hedges in SPX, and that's really how I'm positioning the portfolio. Is like picking on individual names that I know are positively correlated to the S&P 500, and then throwing on bearish positions in the S&P 500 via SPX to kind of hedge that.
Yeah, that's exactly the same thing that I do as well. I mean, I have the beta weighted delta metric. I don't look at it as often. Sometimes I do it as a sanity check on certain names. You can look and see, like, is this like long? I'm getting long something. Is this actually long, or is it kind of a short beta weighted delta somehow? Sometimes I'll do that. But other than that, for the most part, like Mike said, I know most positions I'm putting on these days have been kind of longs, whether they're short puts or somehow short puts to finance long calls or long call spreads. A lot of you guys know I've gotten used to doing a lot of super bold trades, and as a result, I'll try to find other ways to offset those deltas by doing short stuff in SPX sometimes. So that I'm fully aware that my beta weighted deltas are long and my deltas are long for the most part. But the main thing you need to know is that it's just that metric that helps kind of sort of guide you or sort of help you understand what your deltas are related to the rest of the market, I think. And so that's probably the biggest metric. It's actually one of the easier things to sort of comprehend.
Yeah, absolutely. And again, if you are really involved in the tech space and nothing else, I would say you could change your beta weight from SPY to QQQ. I would keep it with the big name ETFs. I wouldn't go like crazy with other products. You can if you want, but SPY or QQQ are probably the two I would use. Dow and Russell too. Like if you're heavily involved in the Dow or heavily involved in the Russell, just switch it to IWM or the diamonds, and you'll be able to see a better view of your positions and the holdings relative to the ETF.
Keep throwing those questions in because I see others, but we'll try to get back to those in a little bit when we have the opportunity.
Yeah, we've got Liz on the line, and I'm sure you're trading SPX this morning. How you doing, Liz?
Good morning, guys. How are you?
Good. How are you?
Good.
How was your weekend?
You did a great job on First Call last night. I was listening. I couldn't watch because I was in the car, but I was listening, Mike. Good job.
Thank you. Appreciate it.
What'd you do this weekend?
Oh, God, this weekend, my daughter had a show. She's always in plays, but she had a performance. She directed junior high kids. So that was the weekend. But we're coming to it. We're coming to an end with that. So, all good things. All good things come to an end. So guys, what are you guys doing? What did you guys do last night? Anything in the markets?
I did actually. I put on an iron condor here in the 3-day cycle. So I got the 73.20, 73.10, 75.50, 75.60 call spread. So just like chicken iron condor, collected $200, risking $300, just playing for kind of an inside move for this week. The implied move is 100 points. So I basically covered that range, and I put this on when the market was up 30, so we're doubling the price now. We're up 60 pre-market. But I think if we see continued sector rotation, that was kind of the name of last week, the name of the game of last week. If we see that, maybe we see an inside move in the E-minis. And especially with the jobs report on Thursday, let's say the market rallies towards my short call spread, the jobs report comes out and the market sells off, that could work out too. So,
all right, so my question is, Mike, how much did you collect on that? How much did you collect in your iron condor?
$200.
On a $5 wide?
Yeah, 10 point wide.
Okay. Do you guys know why it's called a chicken?
Yes.
Oh, why?
Because you're collecting 40 to 50% of the width, so you're chickening out on your higher max loss for a higher probability trade.
Oh, okay.
That's correct. That's correct. That was a Liz and Jenny special that we named that years ago, the chicken iron condor. So because the more you bring in, otherwise you're collecting a third of the width. If you bring it in or not bring it in and collect more, but if you're collecting more than a third of the width, it's a chicken, which is fun. Yep. I like that, Mike. That's a good one.
Yeah, I like these for like the 0 days or the near term stuff, just because if there's a big blowout move, I'd rather lose less. And if I'm right on the assumption, I want to be able to make as much as I can. So I like these for like the 0 days, 1 days, weeklies, what have you.
Yeah, it brings your drawdown in, right? So it's less of a drawdown with those. The two things that I want to say that I was trading overnight. Now, the natural gas, Jermal, you still have your natural gas position, right?
I still do, yeah. I have
but you're butterflied off, so there's no risk in your position. So I always look at, that's one of the first things I'll look at because my positions are pretty big in natural gas. So natural gas has come down a little bit, which is great. Jermal and I want it down. I've got 5 different butterflies to the downside in the near term, but because it's down and I'm kind of capped out in the near term futures, I went out a month to the 58 day and I did a downside ratio spread in that because you can get pretty far. So if you go to the 58 day all the way down to the expected move, and I did that. I bought 2.7 and sold 2.6. Now, this is not for the faint of heart. I wouldn't recommend smaller accounts doing this because it's big. It's good buying power, though, because the futures options, they give you span margining on this. And then I immediately, which I demanded Jermal do when we were trading the last time, I immediately went out and tried to buy the butterfly off for it for 10 cents, locking in $100 credit. So this is what my eye line will go to, especially pre-market. So I always trade futures options in natural gas, and I will look at SPX as well, because now I can.
Like it.
So now, Jermal and I were on the Wing in the Prayer program for it just to go down in the near term.
Wing on a prayer.
Yeah, these trades are fun. And they're super volatile. But yeah, to your point, if you throw on a ratio spread here to the downside, if you get any kind of reversal to the upside, you will likely have the opportunity to buy that 2.5. And that's what creates that symmetry, reduces the buying power immediately because you now have a defined risk, symmetrical butterfly. And if you can lock in a credit, that's perfect.
This has been my go-to move in natural gas for actually a couple of years now. I love looking at it so the 2.7 range is good for me. I don't like it when natural gas is up high. It's very hard for me if I'm putting it, if I'm starting in the 3 handle with natural gas to the expected move. So that's usually what I will look at. I was like, ooh, natural gas is down. Let me jump in. I actually went to the 58 day. The other thing that I thought you guys might be interested in is, now I do look at the CBOE's what most active. And usually every time I log in, it's the 0 days that are the most active. Today, it's not. So if you actually look, today it's the June 30th that is the most active. So it's the 1 day. Because remember, I've been talking about this. It's the end of month, end of quarter. That tomorrow is going to be, I think, a big trading day for taking a look at SPX. This is what I found fascinating. The number one option right now could change throughout the day, but pre-market, it's the 1 day 75.50. Well, it's 75.50 and then the 74.95. So call spreads that are up pretty high for tomorrow. Isn't that crazy?
That is interesting.
So I don't know if you guys remember, I put on the calendars June 2nd, June 6th, selling June 2nd to buy June 6th, and I did the 75.50 and I did the 7600.
Yep.
Yeah, I have the same thing, the 7600 up here. But yeah, that'd be crazy. We would get a 150 point move if we got up to 74.95.
No, I mean, I've been on my soapbox before and I'll get on my soapbox again. June expiration, I've seen it happen. I mean, and it's for a flash in the pan sometimes. It doesn't necessarily mean it's going to be, I know Chris was on talking about the June swoon versus the July heyday. What did he call July? Christmas in July. Christmas in July. Okay, but so I've seen it before. That doesn't necessarily mean it's going to happen, but it does have something to do with the fact that these ETFs and these things have to rebalance at the end of June, meaning they have to sell certain things and buy in certain products. They have to have them in there legally by July 1st. So you'll see some kind of movement. Sometimes it happens well before the actual expiration date, but you could see that. You could see that tomorrow. And some people are playing for it. You can tell by the expirations in SPX right now.
Yeah, you've got jobs report on Thursday too. So I think these implied volatilities are pretty low. VIX is pretty low, all things considered. But there is some kind of spiky implied volatility, sort of a binary event feel here, with only 60 points for the rest of the day today in SPX. That's going to change near the open. But these other ones, 90 points, 100 points, 115. To your point, I think you're seeing kind of this flattened implied volatility where these numbers are really similar for the rest of the week.
Yeah. I'm trying to remember the last jobs report. What day was that? Was that 6.5? I think it was 6.5. Yeah. Yeah, I'm not sure. It did not go well.
Do you guys keep an eye on a lot of those numbers? I know it's Chris Vecchio's Christmas when these numbers come out, but I don't. I mean, I like looking at them, but I don't really trade around those big numbers. Do you? Jobs report.
I pay attention. Do I keep track of the numbers? Do I remember? No, not at all. I mean, I just care about the movement, and I pay attention to the expected move beforehand and what I think the movement is going to be. But I don't pay attention. Like, I assume you're asking if I remember that we gained or lost 130,000 jobs. I don't remember that. That Chris remembers. And he remembers the one before, and the one before that, and the year before that. Like, he remembers all of that. I don't remember that.
It's fascinating. He does quote me like 1990 numbers. I was like, how do you remember this? But Jermal, you, me, and Mike will probably remember the price of where SanDisk was in a certain day when it took, if it took us out for, thousands of dollars. I'll tell you that price. But Chris remembers the numbers of the jobs reports, which is fascinating.
I'll tell you, SanDisk was trading 21.43 when I closed my butterfly on Friday at 2:17 p.m.
There you go.
That's probably the most annoying part about it, right? Like, I did wait.
Did you diamond hands it all the way to 217?
It's $300, Liz. I mean,
yeah, I get it.
I don't mean to sound callous when I say that neither. I just mean I paid $300 for that thing. Let's see what happens here.
Oh, I agree. That's where I was like, sometimes you just got to let those go. You got to let those roll. It depends on how you trade. It depends on the account size, but yeah, for sure.
Yeah.
So, you guys, I'm very excited, and I will be watching with bated breath with your guest that comes on after me. So Peter was, he's an OG Tasty Trader. He was on when we first started 15 years ago. He was part of the network.
Yeah.
The shadow traders.
Yeah, 100%.
So yeah, he's really cool. I can't wait to see you guys interview him. So I'll be watching from the sidelines.
Nice.
Yeah,
Actually, I'm always watching you too. So
just so we know. No, yeah, they look at a lot of really interesting things that I don't think a lot of people look at too deeply, but they are the masters of breadth and things like that. So yeah, it'll be fun and can't wait as well. But yeah, to your question earlier about looking at the numbers, I'll look at SPX implied moves, and if something stands out where there's clearly some kind of binary event risk, then I will go and see what that is and see what the narrative is around it. So I look at SPX first, the implied moves, and then I'll look and see if there's anything to pay attention to.
So Liz, you're saying you don't like trade those numbers at all? You stay away from them for the most part? I was just curious.
I know them, and you can see the binary event, but what are you going to do? Go into the bonds? You know what I mean? I'll look sometimes. I mean, to me, it's more interesting with earnings because I guess I'm just trained that way. This is the first, the last couple years have been more numbers. Up until this point, I've always said the market's got it baked in, right? So the interest rates, the Fed meetings, all this stuff, they're good to know. Sometimes I'll avoid putting something on if I know the market's going to move, if the Fed's talking or something like that. I'll actually step away instead of add trades in for that because I'm constantly trading. So that's one reason for me to remove it instead of jump into it. But other than that, I never trade for like a binary event in the bonds. I don't say, I think this is what's going to happen because you see that in the implied volatility inflated in the bond. So I don't look at those numbers as much as I will something like to Mike's point, looking at the difference in implied volatility in SPX versus there's a number coming out. I might sit on the sidelines instead.
I hear that. Yeah. I don't trade them as much as I used to. Again, I kind of forgot that we had a jobs number this week. But I put that trade on, again, those calendars and SPX, I put them on because of the way that we faded, early last week. It wasn't so much for the jobs report. I just felt, we were fading into the end of to the end of June. The month was going to change. There's probably going to be something happening around quarter end. And I wanted to be long on the other side of that. And let's just see if there was a cheap way to do it. And that's why I did the calendars.
Yeah. I like it.
Yeah. And volatility is kind of flat, sitting in the 18, 19, 20 handle, but still in contango. And I think if you get a strong week or two, you'll see this go back into a steep contango. So, Liz, appreciate you. We're going to take a quick 90-second break on Tastylive. Join us on the YouTube channel. Throw in your trade ideas and questions. We'll get through them as the morning continues. But we'll be back in just 90 seconds. You're watching Tastylive.
Okay, cowboy, here's an earnings event. Keep an eye out for them when you open your trade. They're fast, they're loose, and they can take you for a wild ride. But that's no reason to steer clear, because you can be your own personal earnings event if you take the bull by the horns. What makes earnings events so special? Before the event, people will start guessing how the stock will move once the earnings report is released. That, in turn, makes the options IV rank higher. Like way, way higher. The nearer the event, the more the speculation, the higher the IV rank. Then right after the event, IVR goes the way of the buffalo. If you sell high premium options right before the event, when IVR is really high, you can take advantage of inflated prices and lock your profits when volatility disappears. Only if, and this is a big if, the stock doesn't move against you. If it does, well, sometimes you eat the bear and sometimes the bear eats you. Earnings events can hit you hard. They can also pay off big and fast if you play your cards right. Pretty simple.
The market doesn't stop. So why should you? Diversify your portfolio with stocks, options, futures, crypto, and more from Tastytrade. Focus on the markets that matter to you. See the odds before you trade using curve analysis, IV rank, and more tools. Get industry insights that help you find your next trade right where you need it. Tastytrade. Download today.
There's a beast in the financial world, and it's not the bull. If that's you, join us on Tastytrade. Genius loves company.
Hello, everyone. Welcome back to the show. You're watching Tastylive. My name is Mike. I'm here with Jermal, and we've got Liz on the line. E-mini's up 60, NASDAQ up 300, Dow is up 230 points, the Russell is up 9. Bitcoin is trying to have a green print here, up 185 points, but nothing too crazy. If you look at some of the movements in the futures market, natural gas down 3%, much to the happiness of Jermal and Liz here. Silver down 1.25%, and corn down 2%. Everything else kind of just chopping around. What are you looking at this morning, peeps?
Do you think this rally is going to hold?
I hope so.
Yes,
I
right?
actually think so. I think
it could be anybody's. It's anybody's game now. We've seen the rallies go negative territory pretty quickly.
Yeah, I feel like if it was 20 points or 30 points, I would be less confident, but the fact that it's 60 points, like we're up almost 1% in the E-minis and NASDAQ pre-market, I feel like that's kind of a strength signal. But to your point, we've seen this completely reverse in a matter of seconds before.
Yeah. And the volatility is kind of saying we could keep it. I want to keep it. I want to keep this rally.
Yeah, I think to some degree, I think it should hold up. I think there's a chance it could be somewhat of a buy the dip. I mean, when we were looking earlier and looking at weekly charts and some of these names, you forget there was a pullback last week for the most part, especially in S&P and NASDAQ, not so much in Russell and the Dow, which I think speaks to the fact that there was a strong dollar last week and yields kind of held firm. I don't know if that's going to change this week, but I think people are going to try to buy the dip a little bit until otherwise, we hear something else.
Yeah, and it's 4th of July weekend coming up. I mean, you could just have the euphoric buy the dip where everything's green for 4 days straight.
It's the 250th anniversary,
red, white,
guys.
blue all week.
There you go.
250th anniversary.
So can I ask you guys a question? And it's literally a question. I don't know the answer. Sometimes I'm asking a question, seeing what you guys answer. So SpaceX is going into the NASDAQ, I think, in a couple of days, but it's not going into the S&P. So that's going to change the relationship between the two of them significantly, don't you think?
I mean, it's hilarious that they're getting the fast track. It's like all these rules that have been in place, they're just like, let's just put those aside. Let's get SpaceX in here as fast as possible. But
and it's going to be, I think, the 7th largest weighted company, and I could be wrong on there, maybe it's the 6th, in the NASDAQ as soon as it goes in. But you see the parallels of the NASDAQ and S&P, they have the same names in them. So this is the first time there's going to be a largish divergence.
No, I mean, good point to some degree, I guess. When I look at the top 20, and I'm looking at them now, trying to see 20 between both of them, it is a little bit different. Obviously, I think a lot of the 10 are the same,
Yes.
but like even not really. Like Intel's in the top 10 in the NASDAQ 100. Berkshire Hathaway's in the top 10 of the S&P 500, right? So as much as we talk about how similar, I think they're very top similar, but you're right. This is going to be, I don't know what weighting they're putting on SpaceX, I guess, is really the question. What weighting are they going to put on SpaceX and the NASDAQ 100? That will determine, like, is it going to end up being in the top 10 because of weighting, or I don't know. I think that's probably the big
Jermal,
thing.
and I had heard, and once again, this is not anything, I mean, please fact check, but I had heard it's going to be top 7. Like, it's going to be in top 10, so it'll be top 7. And I don't know if that's true or not true, but that's a big weighting in the NASDAQ.
Are you spreading news? Are you spreading, like, news?
You heard it here first.
I mean, the top 5 are the same. After that, it changes. Broadcom is in the S&P 500, and it is number 6, and it's number 11 in the NASDAQ 100. So I guess by design, they should be a little bit different. Again, I was looking at the top 20. Costco's in the top 20 in NASDAQ 100. Obviously, that's not in the Oh, actually, it is. It's number 19 in the S&P 500. So I guess, I mean, I don't know. I think they're still going to mostly move the same, I guess.
yeah, I think it'll be time will tell, but it's good for SpaceX bulls. I think that the fact that they're fast tracking it, and you'll kind of get that passive movement over time. But this thing can't get out of the mud. It's been in the 150 handle for the last 4 trading sessions. After all the euphoria, going straight up to 225 just a couple days after the IPO. So pre-market though, up 5 points, sitting at 157. That'll be good for our positions. The long-term Super Bowl, and then the upside butterfly that we thought was too cheap. But
what I thought you were going to ask was how much do funds have to buy since it's going into the NASDAQ 100? I don't know the answer to that. That part I don't know. But I mean, I think that's a thing, right?
It is a thing.
And that's what a lot of people are playing for. 30 seconds to the bell, by the way. But I think that's what a lot of people are going to be playing for. I wouldn't be surprised if we get a positive market, if we get this run into the to the 4th of July, and I don't know, when is this supposed to go into the Nasdaq 100? Is it happening this week?
July 7th.
July 7th, after the break. Okay,
Yeah.
so it could be powerful. I mean, we'll see. It could make it move.
Well, and then I still have Tim Knight, that show that we had on with him, where he's like $175. If it's over $175 by August 11th, then the insiders can sell.
That's my organ.
I love it. I don't know if you could hear it, but the off to the races. Amazing. E-mini's selling off here. I've got the 1 minute chart pulled up. Only up 50 now. So selling off just a tiny bit. The Russell, Bitcoin, and ETH all just ticked red. E-mini's trying to make new lows of the minute candle here, but SpaceX up $5, Costco up $5, AVGO up $6. Ooh, looks like we're trying to make new lows.
You know what's surprising is MicroStrategies is currently up, even though Bitcoin is down. You don't see that too often.
Yeah.
So you guys did a good job this morning on the Mike. Is it math? Breaking down the math.
Yeah, the math check. Yeah.
Yeah, that was a really good segment you guys did today.
Thank you.
Thank you.
Are you trading any Bitcoin or iBit or MicroStrategies?
Yeah, it's bigger than a breadbasket, Jermal. I was long lots of coins, and then as soon as we got options and the ETFs came out, I closed all those and went in, and now I'm using the ETH, ETH A, ETH B, iBit. I'm in it all. Like you name it, I'm in it, and I just keep adding to it as it goes down. So somebody stop me, please. But this is where I'm at right now.
I didn't even realize it was an ETH B.
So ETH B, ETH A, and ETH B. This is what ETHB will stake it for you. So it's almost the way that my brain understands it. It's almost like a covered call ETF.
Right. Yeah.
Yeah.
I like it.
Those are popular.
Yeah. ETH A, ETH B. I have a position on ETH A that is basically stock now, if I'm not mistaken. Yeah. I have the 18 strike short put. It's trading at 12. I'm just going to take the shares, wait to see if we get some more movement to the upside, and I can sell a call around 18, turn it into a covered call. But yeah, iBit, I have a longer term short put to finance 2 long calls at 45, and I have 100 shares with a basis around 65, but I've collected 3K in premium. So it's a very convoluted position, but basically my break even's around where we are now at 35. I'm trying to get 100 more shares with another 35 short put being in the money. We'll see if it holds. But if not, I've got this asymmetric explosion possibility to the upside if we get a big rally in iBit with my 2 calls that are fully financed by the sale of the short put.
I love the
You're bullish
explosions.
here.
Yeah. Got to do it. But even if I'm not, my shares at 65, even if I get hit with this short put, I'll still be reducing my basis down to like 50. So still playing the cost basis reduction game, but why not be bullish when this thing is not the talk of the town anymore? Nobody's trading it, at least relative to these other products that we're seeing.
Well, the shiny new object is SpaceX. So nobody's talking Bitcoin anymore because the shiny new object is AI.
Yeah. Look at this rally.
I know, a strong rally. Yeah, for the most part, I'm just watching right now. So I typically don't, unless there's an extra grind, I don't trade right away in the open. There was really, look, I'm long deltas. I've been long deltas for a little bit here, and so the portfolio is working right now. And I'm just kind of letting it breathe. There's really not an X for me to grind. There's no position. I mean, we talked in the pre-open about Rocket Lab and ASTS and SpaceX and Charter, that whole thing. I'm long deltas in those areas, watching those names right now. Nothing to do here. What I'm seeing so far is there's still this little bit of continuation of some of the buying in the software space that we saw on Friday. We saw those names start to get a little bid. That's continuing. I like to see that because I have been long those names. That's been kind of painful. Microsoft and Palantir and Oracle, but we'd like to see a bounce in those names. We need the bounce. We need the bounce in those names. We need it.
It's not what you see. You Mike just brought up that Microsoft chart. It's not, Microsoft couldn't get out of its own way. I mean, I want to bounce here in Microsoft as well, but I think all traders probably do, right?
I think so. I'm curious to know who's short Microsoft.
I mean, I get if you're short here after this rally and then maybe you close it down here, but like if you're still short down here, Like, what do you really
What's your
think is
thesis?
gonna happen here?
Right.
Like, but I don't think Microsoft's going anywhere. They're too big right now, and they have so much cash. They can withstand so much variance. Like, I think these are just buying opportunities when they get into this level. So
Take a look at that Ivy rank in Microsoft. It's 106, the Ivy rank.
Yeah, that seems weird.
That's high, isn't it? And there's no earnings. Well, we do have earnings on
I think that's what it is. I think they probably put the earnings flag here and moved the where it was or where the implied volatility was 44%. And this range I would imagine is pretty narrow. I would imagine the low in IV is like in the low 30s and the high is in like the 50s or 40s. I guess we're setting a new one if we're at 106. So I think the range of IV has been pretty narrow here, but yeah, earnings coming up in 30 days. So I think that has a lot to do with it.
And that's why you make the case that even though as important as a metric as IVR is, it's important to understand what the IV is to kind of have an idea. And again, if you don't know it, if you're not like, somebody who traded in a pit and Microsoft's implied volatility just off the top of your head, just compare it to some of the other names, the big names. Look at NVIDIA's implied volatility. Look at, the other Mag7s. Kind of gives you an idea for where it is. Again, NVIDIA's being around 40-something as well. So
with a 25 IV rank. So.
IV rank, yes, right.
Yeah. But I think the good lesson to learn all that was through the SpaceX IPO, right? So you guys were looking at proxies because it doesn't have an IVR and it's showing an IVR, but it's in its infancy. What is this? 10 days old? 12 days old? So that's one of those where you kind of have to use the proxy.
Holy cow!
Yeah, this thing was over 100% IV in all these expirations. Now we're looking at 75%. I would guess that this stays above 60%, 70%. I mean, it's kind of like a Tesla. Like Tesla, regardless of IV rank, Tesla always has 50% IV. Like,
and it used to be in the 70s.
Yeah,
I remember that.
Yeah, it just won't go as low as like
25.
Like Apple is at 29, 30. Right. Like this is low for an equity.
Mature company.
Yep.
Yeah.
Yeah. SpaceX up 5 points. Tesla up 5. Everything's up 5.
Yeah, it's kind of what it is. Yeah, it feels like that.
But yeah, we're seeing some interesting movements here in the
SanDisk is down 100. Really? That's weird because
it's down 100.
WDC and Sticks are up, but SanDisk is down 100.
Wow.
Huh.
What does this mean?
See, this would happen actually early last week, and I put on the butterfly. It was doing something exactly like this, and I was like, this is interesting. And I put on the call butterfly.
So, but pre-market, I swore SanDisk was looking like it was going to gap up 100.
Yeah, it just opened. It opened at 2090, so it's down 100 points from the open 5 minutes ago.
Yeah,
crazy.
I mean, it's a huge product, so it's not really that crazy of a move. It looks worse than it is.
You guys trade INFQ?
No, talk to me. What is INFQ?
I don't know. Somebody was asking in the chat about INFQ, and they were thinking about doing a 13 put in 14 days. So what are your thoughts? I'm not interested in this trading this, but we can talk about the name and talk about what we do. The 13 put. What?
I don't know what it is, but they want the 13 put in the 18 day.
Yeah, they want the 13 put.
There is no 13.
There's no 13 put.
See no 13 put anywhere.
No 13 put.
I don't know. Me neither. I know it is a trick.
And liquidity is very subpar when you don't see the weeklies. That's kind of one thing.
Yes, we talk about that all the time. Yep.
Yeah, I don't trade any of these. If I don't see weeklies, I don't trade it. Like if you want to invest in it, it's $14. Like fine, you want to buy 100 shares or whatever you want to do. But yeah, no weeklies, no tradey, because it's just there's not enough liquidity here for them to open weeklies. I think that's a good indicator. But Liz, we got to take a quick break. We're going to see you a little bit later on. Thanks for your contribution as always. And we'll see what happens with SanDisk down 112 points now.
I'm buying a call calendar.
Kind of wild. Oh, hey, got to do what you got to do.
Did it again.
You're watching Tastylive. We'll be back in 90 seconds.
Ready to take your trading skills to the next level? Dive into the world of stocks, options, and futures with Tasty Trade courses. Whether you're a beginner or more advanced trader, our courses can empower you with the knowledge to succeed. Watch as our team in Chicago shows you how to use the Tasty Trade platform and go over the basics of trading. Perhaps you'll learn about a new strategy or a potential product for your portfolio. To find our courses, go to the Manage section of our web platform or head to courses.tastytrade.com. Start taking control of your financial future. Visit our courses today.
We built Tasty Trade's web platform for today's traders. See it, click it, trade it. Drill into data, find opportunity, and track the action with hundreds of indicators. Track your options profit and loss history over time per symbol. Note your progress and plan your tactics with a trading journal. Fund your account and start trading right in the app. The tools, the data, the knowledge. See it, click it, trade it. Join the club. Tasty Trade.
There's a beast in the financial world, and it's not the bull. If that's you, join us on Tasty Trade. Genius loves company.
Tasty Trade has crypto, and you can trade with zero commissions. Bitcoin, Ethereum, Litecoin, and more. Diversify in one place. Crypto, we got it. We get it.
What's up, everyone? Welcome back to the show. It is Monday, June 29th. E-minis are up 71 points. NASDAQ's up 360, down the Russell Green as well. Seen some big moves under the hood. You've got SanDisk down 100 points. Kind of crazy. You got gold down 40 points as well. Lots of chop here. My name is Mike Butler. I'm here with Jermal Chandler. We've got Peter Reznicek on the line from shadowtrader.net. And Peter, I remember back in the day, 10 years ago, 15 years ago, when the old setup was with the actual shadows over your face. I don't know if you probably remember this for sure too. Old school Tastylive setup. How you doing today?
I'm good. How are you guys doing?
Doing good.
Fantastic.
Good.
Good. What are you looking at today? What are you looking at this week? You think this is gonna be inside week or movement outside of the pre-market or the short week we've got here with the holiday coming up?
Yeah, I mean, I think potentially bullish. I was talking about this last week that the downside activity just seems to be muted. It's like they're trying, but they're not getting anything for it. And one of the reasons for that has just been the extreme sector rotation that we've seen, right? You have a market where you cannot have a single day where all of the 11 groups in the S&P are pulling in the same direction. So you may have some days where tech is just slightly soft, but it's immediately going right back into financials, healthcare, or others. So that's what I don't think this is any much of a change before the holiday. Like I'm just looking over here on my Minder where I've got those groups from the S&P, and like right now, consumer discretionary and industrials, which would be like XLY and XLI, they're really strong. And then there's a lot of what I call kind of pink on the screen, where sectors are down less than 0.5% from the open. And for instance, like communication, staples, utilities, this stuff is weak. And tech right now is actually very flat. I know we haven't been open very long, but it's marking literally right at the open. So I'm just kind of expecting more of the same, which means sector rotation. And to me, that's going to be sideways and maybe possibly higher.
How have you been positioning in these markets? Is this do you believe in the tech rally, or is this one you're interested in fading? And what are the multitude of ways of doing it? Because obviously you trade option stock futures, but how have you kind of
No,
placed yourself?
absolutely. So I would say, in a nutshell, I would say very cautiously and kind of for a little while now, leaning more towards short call sales, kind of leaning more towards on the short call side rather than being directional with debits. We do a lot of stuff with ratio spread, broken wing butterfly, unbalanced, things like that. Spreads that we know we can put on for, even money or real cheap and like let them expand. But beyond that, like I said, I think we've been leaning a lot more on short calls on days when we see that those names are up, not just certain names of the market itself, just because there's a good amount of vol and premiums are pumped when things move in whatever that direction is, but there isn't that huge follow through, right? So that's kind of where you want to be, right? You want to have your premium as pumped as you can when you get into it, but you don't really want that follow through pushing that instrument, towards your strikes.
Yeah, I think that's a great point. And SanDisk is one of those where it opened relatively flat and then just immediately sold off 100 points. If you had a strategy like that, you were definitely looking good, especially with short-term stuff. But what do you make of this kind of macro rally in Micron and SanDisk and Intel? Some of these names outside of Micron, like some of these names we haven't heard from in many, many years, like Dell, IBM. Do you think that this is kind of just part of the AI boom and this is just a product of that? Or do you think that there's actual staying power in some of these names that we haven't talked about in so many years?
I think some of these names should have more staying power than others, because if you look at I think the hyperscalers are a better example. Like when I look at stuff like Microsoft or Google, some of this stuff gets affected by pockets of weakness in the AI trade here and there. Whenever, it feels like every week or so, the idea comes out that this is overheated and it's all going to come down. But the names that are really the ones you want to look at, I would say, at least for longer term traders, are the ones that have already, or I should say had, a very viable business, right? Long before there was even an AI trade, right? So IBM is one of those, Google is one of those, Microsoft is certainly one of those. I mean, their ecosystem is huge, so outside of that. So that's where I would be looking.
Is there anything in the future space that's got your eye? I mean, obviously, besides, the ESs and NQs, but we've talked this morning about Bitcoin a little bit. We've talked about nat gas. Obviously, gold has kind of been struggling to find its footing with the dollar getting strong here. Is there anything you're kind of paying attention to in those areas?
Yeah, I would say out of those two that you mentioned, definitely gold and Bitcoin. Bitcoin is really noteworthy here to me in that the attempts thus far, like if you guys can throw on that future chart you're looking at, can you flip it to an hourly on that BTC? Like a 60-minute?
So you're actually really trading this a lot.
So you see on the 60-minute, it's very clear how none of these moves below 60,000 have held, right? It's all just been rejection. And that speaks to me. Like, I'm not doing anything in it right now, but I always just believe, keep it simple. If it keeps going sideways and it can't get traction and print 56, 55, 54, whatever, and it stays here, then the next move should be higher, right? Because it's just, to me, it's just accumulating more short interest as it's pushing against that level, but nobody's really getting paid.
Yeah, no, that's a good point. I mean, there's weird things I think happening overall. Like, we trade the IBIT pretty heavy, and I mean, me and this guy were talking. I mean, I got it signed on a put that's like 60 delta, bro, 2 months out. I mean, that's weird to me. So I think there's a lot of panic out there for whatever different reason, and there's also just people kind of keeping an eye on this thing. But I think at some point it's going to get a lot more interesting.
Yeah, I think it's
most definitely.
It's the old adage of when there's blood in the streets or when nobody's caring about it, like that's maybe when you should take a look. And I think IBIT, especially with the rejection, and you look at something like this, and it's very similar where it hasn't had the ability to go below 30, really. And if you look even further out, you can see there's kind of this line in the sand. And if you're trying to pick a direction, I think it's interesting to the upside, especially with the lack of call skew and the ability to have that be infused again into these markets if there is a move to the upside.
Most definitely. I totally agree with that. Absolutely.
Love it. Well, Peter, thank you so much for joining us today. We'll see how these markets are moving. E-minis are up 82 points now. NASDAQ up 450. The Dow is up as well. The Russell's the only one that's red of that four, the group of four there. But we're going to take a quick 90-second break. You're watching Tastylive. You'll see you on the other side.
Back in San.
First thing about Tasty Trade is how easy it is.
It's a very quick, light platform. It's all on one page.
And with 1 or 2 clicks, you can be anywhere on the platform.
Being able to see graphically where your profit and loss zones are.
Whether it's a pool, a puddle, or a sea, you can navigate your way out of it with the Tasty platform. So I love that. You guys have the most unbelievable customer service in the business.
Email support, call support, get through right away.
They actively listen to the customers to make changes to the platform to make it better.
In fact, I've never seen anything like it in any corporation in the United States.
So why are we all doing all the things that we do inside of the active trading space? Simple. To make money and generate returns. Well, inside of the Tasty universe, there are essentially 5 keys to making those returns. And in this crash course, we're going to break down all the details of each one of those keys. So I'll see you inside.
Tasty Trade's Active Trader interface makes futures markets your arena. Built for the bold, not the bored. Trade CME futures with a single click. From micro contracts to major ideas. And go even further with futures options. Tasty Trade lays out multiple ladders and charts for total visibility. Plus, hundreds of built-in indicators for traders who want a broader view. Tasty Trade, pro-level tools, intuitive design, total control.
Hello, everyone. Welcome back to the show. You're watching Tastylive. My name is Mike. I'm here with Jermal. And the E-minis and NASDAQ continue to rip higher. E-minis up 85, NASDAQ up 440. Lots of movement. I just closed my Apple call diagonal spread for a $200 winner. I think for me, it's going to be risk off this week just to prep for the long weekend. I also won't be here on Thursday, so I think that also plays a role into it. If you're going to be out a couple weeks or a couple days of this week that's already short, maybe you look at pushing things out in time. Maybe you look at closing some winners that might not be at 50%, but are still viable if you've only been in them for a couple of days.
Mm-hmm.
We got E on the line live from the CBOE floor. What's the noise level like over there, E?
On a scale of 1 to 10, I'd give it a smooth 6.5, close to 7. As the market opened up today, it was sitting about close to an 8, so it was pretty active right out of the gate. But I'm doing my best to hear you guys right now, but it seems like the market is liking the noise that's going on because we're ripping towards the previous week's levels that we were trading. So how are we doing today?
You don't know what a 5 is yet. You wait till you have a crazy day on the
This is like the implied volatility when you have a lack of data. So you get like that 100 IVR, but it's just because it's 1 month into the year. That's how you got to grade my scale right now, since this is like the 7th appearance over here. So
it's true. Yes. That's good analogy for sure. No, we're watching this market bid right now. We're been talking about we talked about Bitcoin a little bit earlier today, and it's kind of one of those things that you wonder if there's an inflection point coming at some point. We're watching a lot of the space names, the Rocket Labs, obviously SpaceX of the world, what's going on there. But for now, I got a lot of positions I need to monitor, and like Mike said, it's probably going to end up being kind of a risk-off week for me to some degree, depending on how we finish this week. We'll see. I feel like when I have long deltas and I turn into a risk-off week, the market just keeps going higher because I'm taking off long deltas and whatever. It's like, man, I could have left these on. But sometimes it's like that.
Yeah, that's fair. Yeah. I mean, when I'm looking at some of these positions, I'm closing them right now. Uber, $135 winner. That's a longer-term diagonal spread. But I also got out of Apple, which is a $200 winner. I got out of Rocket Lab. That was what?
What'd you have in there?
I had a short put at 8.
Oh, okay. That was so it wasn't. It was. We both did that. I couldn't remember.
Yeah.
I have one too. Yeah, I'm about to take that off in a little while.
Yep. So yeah, nice rally today, up 9 points. Short put came in quite nicely. I think this one, if you wanted to hold it, I mean, you have 15 points out of the money with 18 days, with $2 left to decay. But again, I just want to get some risk off and book those winners where we can.
Yeah, 100%. I'm thinking this. No, go ahead, Jermal.
No, you go ahead, E. No, go ahead.
No, I was just going to say, I'm thinking the same, especially into this shorter week. I may roll some of my positions, give them a little extra time. I know Mike and I were going back and forth on that a little bit yesterday. So again, with the shorter week, I'm just thinking about maybe adding a little bit more time, even to some of my oil contracts. So just thinking about managing some of these trades rather than being so aggressive to start the week at least.
Yeah. E, what do you think about this SanDisk move? Are you trading this thing? You watching from the sidelines? What do you make of it?
Was that SpaceX you were saying there, Mike?
SanDisk down 135 points right now.
SanDisk.
Yeah. Are you trading this thing,
Down
or are you?
135 points right now.
Yeah.
No, I mean, right now, I've kind of just been waiting for the backside to be put in a little bit more. The short delta looks really attractive, but I just have to give it a little bit more time to see visually a stronger pullback in these markets. I mean, if we get a little bit of a relief pop, maybe try and get on some short delta. That's how I've been eyeing it today. Are you guys doing anything in the microns and the SanDisks? How have you guys been approaching that runaway trade?
I've just last week was the first time I did something in SanDisk, and I did a call butterfly upside further, and that worked out pretty well. And so just trying to see if that works again. I just put it on again. I did a similar thing. I mean, last week I think the stock opened up down, kind of like this, and I ended up putting on a further up call butterfly and just trying that trade again. See what happens.
So you're getting a little bit of more long delta. You're taking advantage of the pullbacks these days.
Yeah, I mean, I'm taking advantage of the fact that, I mean, first of all, you can do a $50 wide butterfly for $3, and the stock actually can jump another $200 back up and get towards that level. I mean, that's really what I'm trying to take advantage of. We'll see.
Yeah, I mean, it did it last week, and we barely pulled back, and we did exactly what you just described there. So,
yeah. I think this is a situation to watch for sure, especially because it opened flat and now it's down 150 points. It's just 7% sell off in 26 minutes. Craziness. Micron as well, moving to the downside. But this is your classic, like we talk about sector rotation, like Micron's down 5.5%, SanDisk down 7.5%, yet the E-minis are up 1%, NASDAQ's up 1%. So you're seeing some liquidity come out of these products and get back into your Googles, your Microsofts, your Palantirs, like all of these products that are green today. AVGO, Costco's up 15, Apple's up flat now, but you get my drift. It is
Things are changing right now as we speak. We're dropping.
Yeah.
It's dropped like 37
yeah, we're
points.
dropping.
Craziness.
Selling off right back near that morning low. That was just in about 2 to 3 minutes. Wow. A lot of volatility. It looks like volatility should be expanding a little bit more there.
Yeah.
A little bit.
Nutty.
Yeah.
Nutty. What else you got your eye on this morning? You looking at any futures trading? Gold? Gas?
Yeah, right now I'm looking at the micro NASDAQ. Still deciding if we want to get long or short here. This is another area that's pretty attractive. We did a little bit in NASDAQ yesterday. Whenever we rallied towards the high, we were able to take some shorts that will circle back around to whenever Gus and I hop on later today. But the price range it's sitting in right now, I think it's just a little too much uncertainty. I'm not able to carve out any type of firm conviction in any of these trades right now. So I'm going to sit on my hands just with the volatility we're seeing at the moment, because this market is flying 100 points, 200 points in the matter of 5 minutes. So we'll be patient.
Yeah, for sure. And this is the nice thing about MNQ, MES is you can do stuff like a strangle, straddle, and just have it on continuously. That's what we've got. And it helps us just have premium on that's decaying, even in these markets that are kind of wishy-washy, hard to, plant our flag in any kind of sand here. But appreciate your time over at the CBOE. We'll see you a little bit later on, and I hope the levels in terms of decibels crank up there for your entertainment.
Yeah, right. For sure.
We're gonna take a quick break. We'll be back with Tim Knight on the other side of it. You're watching Tastylive.
tried to rewatch that market measures from this morning, Bodacia. Our raid really distracted me. I was like, get away from me, uncontrollable fire.
I told you, Tasty Grax, you can't plunder with headphones on. Light pillaging, maybe.
Sometimes I'll hide in a gross peat bog in the middle of a raid, just so I don't miss market measures.
I'm only recently comfortable admitting this, but I think I trust market measures more than I trust my savage hellhorse, Arbitrageur.
God, I forgot to tell you guys that I slaughtered a horde of conformerons this morning. Did the whole terrifying row of severed heads on pikes as a warning thing, but you never know with those idiots.
Okay, thanks for the heads up.
Ha ha ha! Goblets of hot blood for everyone.
Nice.
Thanks, you guys.
Normally I hate puns, but that one was okay.
Tasty Trade has crypto, and you can trade with zero commissions: Bitcoin, Ethereum, Litecoin, and more. Diversify in one place. Crypto, we got it. We get it.
Pay for back testing? No. Pick from hundreds of symbols, any strategy you want, and all the data to trade smarter. Tweak the delta, dial in the DTE, and stack the legs. See what survives. Check out Tasty Trade today.
So you're an active trader, looking to increase your return, decrease your risk, or quite possibly both. Sure, you've heard of the Greeks. You know, your deltas, your thetas, your vegas, your charms, your vamas, etc. And you're wondering, hey, how do I use these guys to improve my risk-return relationship? Well, join me for a 10-episode crash course, and I'll show you exactly how to do it with all the gimmies and gotchas, one Greek at a time. We'll see you there.
Hello, everyone. Welcome back to the show. E-minis are up 50, NASDAQ up 225. Seeing a little bit of a sell-off here. Micron down 73 points, 6.5%. SanDisk down 160 points, down 7.5%. Much to the delight of our next guest, Mr. Tim Knight. I assume these are shorts that you've been eyeing, if not participating in. How you doing this morning?
Yeah, we're only half an hour into the trading day. Micron is something I follow pretty closely, and you just said that's like, it is? And that's how far behind I am. But it was a funny thing because my trading style is really different than you folks and I'm not talking about like the perma-bear thing. I'm talking about just the construction of the portfolio, because basically I just have lots and lots and lots and lots of little shorts, as well as a few long put positions. And so this kind of this Frankenstein's monster thing, and it behaves in a way that isn't necessarily the way the market's behaving. So, for example, this morning, we had a strong opening, and the ES climbed its way up to like plus 85, NQ, RTY, everything green. And it should have been a really lousy morning. And I was down, to be clear, but it has this, as I'm observing kind of the numbers, it's sort of like I've just performed open heart surgery on a guy, and I went to get a coffee and came back, and he's like in a Pilates class. Like, what are you doing? And so the strength of the positions, their recovery is like, okay, this is nice that they're not getting completely demolished. And it was annoying that ES kept climbing, but as you've just noted, we're finally seeing some selling. ES and NQ are still green, but a lot less green than they were. And the RTY is down. So I'm feeling a lot better than I was half an hour ago.
I can tell. There's a smile underneath there. I see it.
Yeah. May we look at a chart or two?
Sounds good.
Please.
Okay. So not a whole lot going on to talk about, but there's a few I wanted to point out. One, kind of my ongoing obsession with SpaceX. It's a funny thing because this thing, for the first 6 days of its existence, was mayhem, just an absolute crazy dynamo, whereas the past 5 days it's been like a passbook savings account. I mean, it's just kind of sitting down here. So it does seem to have found kind of a happy equilibrium. When this was going on, I really thought and talked about and wrote about that this ain't so good for the other big IPOs, and we've all read about Anthropic sort of quietly like 2027 on their IPO because this kind of sucked all the oxygen out of the room. But it's important for those things to happen at all, and for the market in general, for SpaceX to kind of find a happy home here. Because if for whatever reason it decides to begin its price with a 1 and a 4, people are going to start getting really jumpy. But so far, it's just kind of hanging out. We've, as I say, reached a happy equilibrium. It's funny you mentioned the Micron thing because sadly, I don't think I'm short them anymore. I've got all kinds of other exposure to semiconductors, but I guess that must be helping because SMH is a really key position for me by way of long January puts. And we tagged this trend line here, which was a great time to get in. I added to my position here, and since then we've tumbled down here, and this support here is pretty key. And when I was putting these symbols together, we were still having a pretty strong day, but this is starting to kind of threaten the support. We could see this snap pretty soon. We're sort of teasing it right now, so that's very key. In Q, a little bit of the same idea. Key support level down here, and for the past 4 trading days, we've been kind of teasing that too. We were quite strong earlier. We were near Friday's high, but it is certainly within the realm of possibility that before this day's out, we're going to cut below this guy too. ES, this one, a little bit murkier, but let me just bang out real quick. Let's zoom way back. And what I'm keeping an eye on here is what I would describe as, well, really almost a diamond pattern here. Let me see if I can rough this out real quick. I'm not quite as adept at this platform as I would like to be. Here we go. Yeah, something like do. All right, that's not going to win me any awards, but something like this. Let's allow me, because this is important. I really want to try to get this right. Something along these lines. All right, something close to that. So I know that looks like an egg, but I'm trying to kind of get across the idea that we're in this kind of diamond, hopefully topping pattern, but we need to keep making progress. We need to get below Friday's lows, and obviously ultimately get below the lows we had seen back here on June 11. But the kind of innate weakness we're seeing right now is really interesting to me, because I wrote this morning about, and you gentlemen might have talked about this already, that there's this clear phenomenon going on, like an hour after the close Friday, it's like the war is back on. And an hour before Sunday's futures open, it's like peace. And so we get this weekend of like bombings and attacks and so forth. And then like just before the futures open, it's like everything's fine. And maybe that narrative is starting to lose a little bit of credibility, because we were strong based on nothing but that. Like, we're talking again, and there's only so many times you can do that. It would be like, it matters. A couple of other things. Bitcoin continued to be, my disposition here is really bearish. It's a little nerve-wracking, because this tends to be percentage-wise pretty volatile, but this is IBIT, the big ETF, and it's a honey of a pattern, really large. Weeks ago, I thought we might kind of crawl our way back to 71,000 or so before slipping. We only got about to like 67 or so, and we have been definitely teasing the sub 60,000 zone. So really like my BITI long and the IBIT short. And then finally, with the spider, and this is a bit of a different take, we were just looking at the ES. This gap here is one I've been really watching closely. We were strong earlier today. We basically were at the same highs we saw all last week, except for this gap here. So this gap was between Monday and Tuesday. And my thesis on this was short term, as long as we can stay below that gap, the one or two bears still that exist will be okay. And so far, so good. I mean, as you can see, we've been in a tight range for days now. There's no need for a victory lap at this point, but at least we've sold off from that early morning strength. So things are looking pretty good from my end. So that's kind of my run around the track this morning.
So it sounds like the rally didn't deter you at all. It seems like you're even more emboldened now, especially seeing us sell off about 40 plus handles here.
It irked me. The rally didn't deter me too much. I'm irretrievably stubborn, I guess, but or constant as the Northern Star. We can put a positive light on it.
There you go.
Yeah, I'm encouraged by the fact that this piece is broken out again. Rally lasted about 22 minutes. So.
Yeah, and I think to your point, we've seen, especially with this chart here, we've seen all of those highs get kind of rejected, and selling has been occurring after we've hit those highs. So that's another reason why I've been looking at this portfolio, and any of the bullish positions I've put on, I've taken off if they're quick wins. Not only because we've got a short week with the holiday, but I think if that pattern continues, you can kind of just chop in and out, in and out, in and out, and have a lot of opportunities for re-entry. But yeah, thank you very much, Tim. We will see you.
It's been a pleasure.
Absolutely. We'll see you a little bit later today. E-mini's selling off quite a bit here, only up 36 now. Cut the move in half, basically. NASDAQ up 100, the Dow up 250, and the Russell down 20. We have our next guest ready to go here. Julia, how was your weekend? How you doing?
Amazing. How was yours?
Great.
Good.
Can't complain.
Yeah.
Can't complain.
Take a plane? Is that what you said?
Can't complain, but I will take a plane if you have a plane to give me.
Yeah, for sure.
I will accept.
I don't want to take a plane for a very long time.
I think you would want to this week, though. It's going to be hot. I mean, this is going to be
it's going to be a little toasty, yeah.
Which is good.
I was flying a lot a couple weeks ago, and it was just a lot of the airline industry's logistics I had to deal with. I'm okay with not dealing with that for a while.
I hear that.
I get it. I think to that end, though, I'm a big United person because the hub is out of Chicago, so I just take United wherever. And knock on wood, I feel like I've had a pretty good run here with lack of issues, delays, canceled flights, whatever. Shout out to UAL.
Yeah.
I've had pretty good experiences with them too. And I remember, some friends, we were looking to go to New Orleans a couple weeks ago, or I guess it was a couple months ago now at this point. And the tickets at the time were very, very cheap. And they were like, oh man, this is like a third of the price of United. Let's get Spirit Airlines. And I'm like, I don't know, man. They've been kind of going bankrupt for the last 2 years, and this might be the final nail in the coffin. And then lo and behold, a couple weeks later, they actually stopped serving flights completely. So we lucked out. We got to go to NOLA and we ate a lot of oysters.
Yeah. Love it.
I love oysters.
They are very good. We just had some in Seattle, which is another good spot. West Coast oysters. Love it.
I like to do a smorgasbord, but I do also have some slides if you want to get into it.
Yes, please.
Let's do it. Okay, so this is a weekly market summary. This is put together by Kai. If you want to follow him over on X, he's Kaizing1. And this is kind of talking about recapping what happened last week. A lot of stuff happened last week. We're seeing some really interesting behavior, especially in the Russell, seeing interesting behavior in healthcare stocks, among other, more commonly discussed topics, such as in the semiconductor space. So I just wanted to kind of go through it and give people an idea of what to kind of look out for this week as well. Yeah?
Yeah.
Let's do it.
Cool. Okay. So tech-led sell-off. NASDAQ was especially hard hit, and it fell like most of the days last week. It turned red. And this is a lot of AI valuation concerns. We did have Micron earnings as well. That obviously beat. And we saw a big rally in Micron, but a lot of that was actually given back on Friday. We also had PCE kind of consistent with this sticky inflation narrative. We're going to see how the Fed continues to adjust to that moving forward. But a lot of it was around tech and Micron. Brent crude as well, lowest level since before the Iran strikes. So eventually that might have some trickle down effects across the rest of the economy. And then we're also seeing very interesting support in the Russell last week. And I'm very curious to see it continue potentially into this week, where we're seeing money really moving from, or investment moving from these mega cap tech companies into healthcare, industrials, and small caps, which again, it's really been helping the Russell out. I've been rooting for the Russell for years. It's been lagging behind the other indices so much. And I think we're finally starting to see it be more resilient and show a bit more growth compared to especially any of the tech heavy indices like the NASDAQ.
I think the Russell is definitely, and it speaks to, we talk about software rotation out and back in. Same story here. When you have when you understand these relationships and you see one's lagging behind, it makes a lot of sense to assume that eventually it won't be the case.
Yep.
One can only dream.
Yeah.
But yeah, if this isn't a nice picture of just like the volatility that we're seeing in the indices, where the Nasdaq has just such aggressive growth and then such an aggressive kerplunk, and the S&P with again being a very tech heavy index, following a similar trend but less volatile, and then the Russell and to a lesser extent the Dow showing actually more resilience. So in terms of like potentially making directional assumptions, all of the indices have high IVRs right now, so potentially like short premium selling conditions. So just keeping that in mind, where we're seeing kind of like more neutral chop in some of the larger, like of the S&P and the Nasdaq, and then with like small caps, we're seeing kind of more steady growth, which again is nice. I've been kind of waiting for the small caps to catch up.
You are really rooting for the small caps, aren't you? You are
someday.
Small cap cheerleader.
I'm trying. Maybe that's just we can all like collectively uplift it.
Hey, you're winning
Probably
last 2 weeks
actually,
at least.
The last 2 weeks,
Yeah,
exactly.
I mean, this speaks to, again, the week of 6/15 was in the wake of the Fed meeting, and there's definitely been some meaningful change. We also had PCE last week, like you mentioned. And so we've seen the dollars remain sticky. We've seen yields up there, and for whatever reason, there's been this bifurcation that took place last week for sure.
Yeah, so we're going to continue to see that. And then this again tells an interesting story. Looking at the biggest movers in the S&P 500 from last week, we got AbbVie, UAL, kind of like, hyping up United, and then GLW, which is I think like a ceramics and textiles company, and then Merck and J&J. So the healthcare really, really rallying last week. And then to the kind of like on the downside, we have a good amount of like data storage companies, which were really, really significantly driven up the last couple of weeks, starting to correct a little bit. Qualcomm, Oracle, WDC, and then ON. So any of those tech heavy indices just really experiencing getting dragged down from that, which makes sense after we've had like the very strong rallies of the past couple of months at this point. But healthcare, really interesting story there.
Yeah, that was something we were kind of noticing throughout the week last week. The healthcare names were starting to see that rotation. Obviously, the tech stuff. The move in oil to the downside obviously is what's leading to UAL. You're right. GLW. It's Corning, it's glass. It is a textiles company, but I think they've kind of like parlayed themselves into somewhat of a tech company in some way, shape, or form. Just based on the way it's trading, the way the vol is, you can kind of see it. It's really interesting.
Yeah. It's super interesting. And then for getting like healthcare exposure without necessarily trading some of these single company names, you got XBI, the biotech, the biotech ETF, and then XLV, which is the healthcare ETF. XLV is kind of liquid from what I remember. I haven't checked up on it recently, but those two names potentially worth looking into for getting some like healthcare exposure. And then the Russell has twice as much healthcare exposure as the S&P. I think it's at like 16%, where the S&P is closer to 8% of the holdings are healthcare.
Very interesting.
So looking at crude, it was down about 10% last week. So that's actually a pretty big move for crude, 96 percentile decline for a week. And we're now fully retraced back to pre-war levels, down about 24%. As Kai put together, the 3-week decline ranks in the top 1% of all 3-week periods. So very significant decline. And hopefully eventually will, kind of like help with some, at least of the inflation narrative. That's the goal, right?
Yeah, I think this one is not surprising at all, especially when you look at the flat curve we now have. We had a 15-point backwardation at the height of the war, and now we are completely flat almost, with 70, 69, 69, 68 as the prints over the next couple of contracts here. So crazy moves.
Yeah.
Yeah. So a lot of different products to potentially trade in this. Helps a ton with like sizing and exposure. But yeah, a whole lot of volatility. I don't know, I'm kind of cautious about trading some of the energy products with this and like natural gas as well. But obviously, so very significant declines there. Looking at Bitcoin as well on the next slide, roughly flat actually on the week, but down overall, continuing this kind of like decline. We're seeing like pretty significant outflows in a lot of the spot like ETF products. So continuing to trade down. I don't know if you guys are trading any of like the Bitcoin products at all, or any of like the crypto products. Ethereum was also down about 8% on the week. So kind of a continuation of the trend that we've been seeing. You got IBIT as well as like some of the futures products. So yeah, I don't know if you guys are in any of these names right now.
Are we? Yeah.
Yeah, we got IBIT, Ethe. Just compiling as much premium as possible in IBIT and trying to dollar cost average down my 100 shares I already have. And then ETH I will have 100 shares with a short put at 18 and the price at 11 right now. So
Nice.
yeah, I'm long for better or worse.
I've been long for a while, so we'll see. I don't know, but I will say like IBIT, extremely liquid options. IV rank of 35, so seeing pretty significant like premium inflation in there. So just like having a very accessible, highly liquid product with a bunch of liquid options as well. Nice to be able to control that exposure. But yeah, I've been long for a while as well. We'll see when that ever. I don't know. Maybe we'll root for it like we did with the Russell.
There you go.
Who knows? Okay. And then last one, before we get to some of our recap slides, talking about the corrections in the metals. Again, pretty significant last week. Silver crashed, kind of down 10% in a week. Crazy for a metal, but maybe not as much for silver. 99% weekly move. And then gold fell as well, which is a pretty significant move for something as stable as gold usually is. Again, coming off of these really crazy highs that we've kind of seen the metals reach towards the beginning of the year. So with the metals as well, I've been kind of a bit more neutral in the metals recently, actually, because again, it's had some of that chop that we've actually seen in some of the kind of the equities. And in a really interesting piece from a couple of weeks ago is that metals are not giving the same exposure right now, or the same kind of diversification, I should say, relative to the market indices as they used to be giving or historically. So they've been a bit more correlated with the markets and some of the larger indices. So just important to note in terms of like where you get your price diversification from.
Yeah, we bought it. I bought it last week. I bought an MGC contract and sold. I bought it at like basically just under 4,000, I think, like 39.85, and then sold a 4,200, 4,220 call spread against it. So sort of quasi covered call, if you will. So played. I mean, I think I had position on just about everything that you talked about this morning, except for healthcare, except for UAL. Most of the things I have positions in these days.
Maybe there's your gaps. It's healthcare and airlines. Well, the one, I guess.
Yeah.
So I don't know, but I've been more neutral in the metals recently. I feel like metals are like, you get those like face rippers sometimes, like it'll just move like, I don't know, 50 points in a day out of nowhere. But recently it's been going okay with kind of the neutral assumptions, but that can change very quickly. Especially, I don't trade silver as much. I find it harder to size in silver compared to gold. So I trade a bit more gold.
Fair. Yeah. I've got a covered call in silver from a straddle that was all the way up at 87. Now we're at 52 in silver. So I'll probably be in that for a while, but collected a lot of premium. I think my basis is around 65. And then GLD, just a short put spread in the gold futures, 3,800, 3,780. So involved, neutral to the upside.
Involved. Okay, we got one more slide. Just looking at 3,400 companies. That is not, it's not quite a coin flip, but it's pretty close. Just looking at the Q1 earnings review as of the week 622, we're seeing a slight positive return or average return when it comes to reporting around earnings, and a little bit more of a tendency towards the losers, but looking at the aggregate is pretty close to a coin flip with a little bit of favoritism towards the downside on that one. So, but all around, like very volatile earnings season so far.
Yeah. Yeah, it's been a wild one. It's been one of those where it's like you expect big numbers, but the stock drops. Like I feel like that's been the MO for a lot of these companies.
For sure.
I feel like, this is purely anecdotal. I feel like you get big, either drop, huge increase, and then it just kind of gives, I want to say like most of it back, either like, the later in the trading session or the following day or something like that. So that's kind of been where I've tended a bit more towards the neutral side in some of my trades recently. So it's like kind of a little heart attack, and then you maybe hopefully relax a little bit. Maybe you don't though, but we're going to see, especially with gold. Gold gives me trust issues. But looking for later this week, we got PMI coming up on Tuesday. On Wednesday, we got War Speaks in Portugal. So that exciting. It's like when you speak in Portugal, that's, made it on the slide. So a lot going on this week. Thursday, June job reports, and then ongoing, just Iran, we're gonna see what happens. Who knows? It changes every day, changes every minute.
I try not to pay attention to it, but they're speaking in Bergenstock. Is that where like the stock? Is that where the shoes are made? Is that the actual German name?
Bergenstock?
there might be something that we'll ask our friend ChatGPT in a second and find out.
Yeah, we'll find out.
But Julia,
Potato
appreciate your insight as always. We'll see you a little bit later, but yeah, have a good rest of your trading day. E-minis selling off here, only up 22. The NASDAQ is red now, down 7. But we're going to take a quick break. We'll be back on the other side of it. You're watching Tastylive.
I had to rewatch that market measures from this morning, Bodacia. Our raid really distracted me. I was like, get away from me, uncontrollable fire.
I told you, Tasty Grax, you can't plunder with headphones on. Light pillaging, maybe.
Sometimes I'll hide in a gross peat bog in the middle of a raid, just so I don't miss market measures.
I'm only recently comfortable admitting this, but I think I trust market measures more than I trust my savage hellhorse, Arbitrageur.
God, I forgot to tell you guys that I slaughtered a horde of conformerons this morning. Did the whole terrifying row of severed heads on pikes as a warning thing, but you never know with those idiots.
Okay, thanks for the heads up.
Ha ha ha! Goblets of hot blood for everyone.
Nice.
Thanks, you guys.
Normally I hate puns, but that one was okay.
I bet you work a lot of hours.
Yes. I bet you can't guess how many hours a week I work.
Really?
Mm-hmm.
60.
61.
Oh, God.
$1,000.
So
Boom!
close.
Oh,
So
my day
close.
is starting out great. Want to go double or nothing?
Let's see. What color are jeans?
Blue.
You got it!
Common color of jeans. They write songs about it.
I thought it was tough.
Double. I win double.
Great job.
Yes, and you get nothing.
I'll pay you in love.
That's not how this one works.
I will pay you
No.
in hugs and kisses.
There is no hug and kiss worth $1 million. Cool.
I could make it worth $2 million.
I've kissed you before and it's not that good. Woo! This is what I love. Every time the game hurts you, she gives it right back to you.
What do you mean I don't kiss good?
You're awful. You're very mouthy. Man, this feels good. Oh, this is why I do it. All right, come on, let's keep going. I'm on a roll right now. What's the matter?
I didn't know I was mouthy.
You think it would be good, but it's not. You should practice more.
Okay, my turn.
Okay. Try to make a little money back?
Okay, you want to go big?
Yeah, let's go big.
I'll get it on this man's game. I'll get in this man's game.
Yes.
$5 mil.
$5 million?
$5 million and a speedboat.
A speedboat?
Uh-huh.
This is serious. Yes, I'll take the bet.
Okay.
Oh boy, here we go.
I bet I know the name of your childhood friend.
Nobody knows the name.
Really?
I never talk about him.
Oh, really?
Oh.
Lenny Cancelleri. Bam!
Putting on strategies? That's easy. Taking off strategies? That's also pretty easy. But what do you do with everything in between? Well, in our Options Crash Course Strategy series, we're going to show you how to handle the winners. We're going to show you how to handle the losers. But most importantly, we're going to show you how to handle everything in between with simple and clear guidelines and reference points. We'll see you guys there.
Tasty Trade has crypto, and you can trade with zero commissions, Bitcoin, Ethereum, Litecoin, and more. Diversify in one place. Crypto, we got it, we get it.
Hello, we are back. This is Tastylive. My name is Mike. I'm here with Jermal. E-minis caught a bid. Kind of wild. Up 50 points now. Nasdaq's up 170. Dow up 350. Micron not down as much, only 80 points. And SanDisk also catching a little bit from the sell-off. Still down 150 points, though. Kind of a crazy move. But we've got TP on the line, and I'm interested to see what you are trading today, sir. How you doing?
Hey, Mike. Hey, Jermal.
Hello.
What's happening? How was the weekend,
I'm
TP?
good. All right. So, Jermal, I know on Mondays you always like to limber up your brain. So I'll give you maybe, I don't know if this is a chemistry question or not. But I mean, I know you're a chemist. So
once upon a time, TP, I don't know. I've forgotten a lot.
At the Preston Ranch, we've been having some air conditioning issues. So, I like to look at, I like to know about my systems, right? And so the whole thing about the expansion and contraction of the gases or of the refrigerant releasing and absorbing heat, is that a chemical thing or is that a physics thing?
It's definitely a chemistry thing. That's kind of like ideal gas law or something like that. Not ideal gas law.
Oh, yes,
like
of course,
Boyle's
the
law?
ideal gas law.
Like Boyle's law? Something like that, right? Pressure and volume. Pressure and volume and temperature. He knows this.
That sounds about right.
He's helping me remain a chemist. I appreciate that, TP. He helps me remain somewhat of a chemist, somewhat of an engineer. But yeah, I would say that's definitely probably like a Boyle's law, Charles law, Boyle's law, something like that, right?
See,
it's still there.
This is why I have Jermal on speed dial. So anyway, yeah, and by the way, I just think air conditioning, refrigeration is probably one of the greatest leaps of humankind of all our existence. It really is. Mm-hmm. The ability to figure out that you can heat and cool things by absorbing and expelling heat from a liquid, that's amazing.
Well, it's thermodynamics too, right?
What is it?
When you put
Carrier,
in that
the guy Carrier? I'm sorry, Jermal, what were you going to say?
No, it's when you put it in that regard, it's thermodynamics too, right? Heat transfer, things like that.
You tell me. Yeah, I mean, right. That's what I was wondering, is a physics thing, but you know what? I'm going with you with the chemistry thing. So you're right. So Mike, what you pointed before I joined in, you were talking about SanDisk. And what I was looking at before I joined on is I have my little systems that I look and see what are having the huge moves down right now. SanDisk was actually on the list. When it was down 190, it was down 9%. It was down 1.18 standard deviations. And so I look at a lot of times I look at things in terms of standard deviations because it sort of normalizes them. Yeah. It factors in both price, the dollar change and the volatility. So that's why I like to look at it. And just going across the board in some of those names, it was, there were some, Ciena was down, Intel was down, stocks like that. There was a little bit of a bias on the downside towards some of those.
Forgot about Ciena.
Some of the chip stocks, some of the AI stocks. On the other hand, the big losers on my list were AT&T and Verizon, getting smoked today. Verizon was down over 3.5 standard deviations. VZ. I sell puts in Verizon because you get decent credits. That's what I'm getting whacked on today.
Mm-hmm.
Yeah, apparently it could be due to the fact that SpaceX, this company that we thought was going to Mars, is actually just going to be the next cell provider. So
yeah,
that's a head fake if I've ever seen one.
I know, right?
Well, yeah. Well, Mike, to that point, it was always about AI and their. What is it, Colossus 2 or whatever they're building in Tennessee? That's just a big AI machine, big data center. That's what I talked about in the cherry bomb today is, all right, I understand data centers suck in a lot of respects, but we still need them. It's the next railroad. It's the next highways across America, that sort of stuff. So anyway, excuse me, if he can use his... Whatever. If he uses SpaceX to launch satellites that will pass around the internet, whatever signals or whatever there, hey, more power to him. And if that kills Verizon and AT&T, I've had enough problems with their cell phone service over the years. I wouldn't really care. But they are down today, and their volatilities are relatively high, particularly AT&T. So if you were looking for a stock to a contrarian trade, and I haven't looked at their options, so I don't know which way the skew is pointed. But yeah, I mean Verizon.
Wow, look at
so
T-Mobile,
you look
bro.
at.
I think I got to sell a put. You're bringing up some interesting stuff here, TP. I really. We knew about the news this morning, but I really hadn't looked at those names, at the AT&Ts and Verizons of the world. But then I look at T-Mobile, which is definitely like when I look to sell a put, I want some decent value on it. And you look at this name, and it's TMUS.
It's
and
TMB.
And it's
TMB is T-Mobile.
TMUS, right?
Yeah.
And it's this is down. I mean, and you look at the chart.
So hey Mike, let's see which way the skew is pointing on those options. 18 days is fine. So it's 171. So it's right around 170. Let's say down to the 165 puts, up to the 175 calls. Yeah, to your point, Jermal, the skew is pointing to the upside in T-Mobile.
Yeah, 5 points out of the money on either side. Lots more premium here.
Yeah, and it's, what do they have? Let me see the screen. Yeah, so they have decent volatility in there. And so Jermal, I'm not sure if you trade these things all the time, but if anybody is looking for a contrarian bet, something in these telecom stocks that they're just getting whacked today, whether it's Mike's point about the Starlink stuff or just general, we don't like telecoms, it's an opportunity. The other things I'm looking at, trading a lot of the 0 and 1 and 2 and 3 day options in crude oil and notes. So crude oil, I'm short put spreads, as I've been saying forever, and this rally in crude isn't really helping me that much. So I was selling the 69.75, 69.25 put spread. Taking in 6 cents or something like that, 7 cents for 1 day. The return on capital, and guys, for me, it's all about return on capital. It's only, TP, you're only making $70 in that trade for what, $500 worth of risk? It's 70. The return on that is huge. The same thing with ZN in the 10 years. Selling a put spread in there with 3 days, taking in a couple of ticks, and remember the ticks are, $15, 15 and change per tick. You can get decent premium, and again, keep your strikes tight. The return on capital for verticals in some of these non-standard 0 DTE options, like crude, like notes, I love trading these things.
Yeah, and the crude one we just looked at was 20%, just about. This one is 15%, similar. So yeah, day to day, you're getting big returns on capital and high probability nonetheless. But
sure.
TP, appreciate you. We are going to take a look at these names. I think, to your point, the telecommunications products taking a hit today. If you think they're dust, maybe you could play for a continuation. But if not, you're getting a big discount in a lot of these names. So we'll check them out for sure. E-mini's up 60 points, NASDAQ up 200, the Dow up 450, and the Russell is the only one down of those four. But we are going to take a quick break. We'll be back on the other side of it. You're watching Tastylive.
Tasty Trade is now on TradingView. Trade stocks and futures directly on TradingView charts with Tasty Trade's low commissions. Try it out and leave us a review.
First thing about Tasty Trade is how easy it is.
It's a very quick, light platform. It's all on one page.
And with 1 or 2 clicks, you can be anywhere on the platform.
Being able to see graphically where your profit and loss zones are.
Whether it's a pool, a puddle, or a sea, you can navigate your way out of it with the Tasty platform. So I love that. You guys have the most unbelievable customer service in the business.
Email support, call support, get through right away.
They actively listen to the customers to make changes to the platform to make it better.
In fact, I've never seen anything like it in any corporation in the United States.
Ask that, I'll ask that.
What's up, everyone? Welcome back to the show. You're watching Tastylive. My name is Mike. I'm here with Jermal. E-minis and NASDAQ chopping around here, but they are back to near the session highs. E-minis up 60, NASDAQ up 200. But we got a very candy cane looking chart on the screen there, as pointed out by Dr. Jim, our next guest. Dr. Jim, how you doing?
What's up, guys? How we doing? Like I was saying, in this kind of market, man, like all we can do, guys, is scalp BIL. Like that's all we can do. That's all we're left with, right?
Yeah.
You just got to scalp BIL and hope for the best. And we were joking, like, can you actually get short BIL?
I think they come and take your house. I think they come and take your house if you try. It's very un-American. You will get extra tax somehow.
All of a sudden, you're on a watch list.
You literally, they'll take your passport, I think. I mean, seriously.
Yeah. They put you in a new tax bracket if you're short some BIL. That's pretty funny. No, that's good stuff. But man, this market this morning, I mean, obviously, we won the war again for the 18th time last night. Like, okay, it's amazing. And then this morning, like, it looked super strong, and then they just sent them down. Now they're ripping right back up. They're sending it back down. Market's moving. Things change, gentlemen, Yeah,
it almost seems like we're starting to already get kind of end of the month flows. When I look at a heat map today, it's it's clear that there's some selling going on in the tech, but it's a very Christmas tree-like look. Like there's a lot of reds and greens in a lot of different places, even within the same sector. So I think we're starting to get sort of this sector dispersion, as they talk about, that typically comes at quarter end, especially at half the year.
Yeah, we're seeing recent highs, and then just instant selling, and now back up. So we are seeing two-sided action today, which is good for really everyone, whether you're bullish, bearish, especially if you're doing zero-day stuff. Bullish, bearish, neutral, this is the kind of chart you want to see if you are trying to take advantage of that. But the only things I've done today are just closing positions in a handful of names. Apple, Rocket Labs, and Uber. Took some profits out of those three. And that'll be my MO for the week, is just closing positions that are winners, free up some capital as we go on to the long weekend here.
I'm trying to do that, but the more we talk to these great people on our network, I keep putting on positions somehow. I just sold a put in TMUS based on what TP was saying. He brought that to our attention. But yeah, for the most part, I've closed a couple of things too. I closed Rocket Lab. We'll see how it plays out.
Yeah. What do you got for us today, Dr. Jim?
All right, gentlemen. Yeah, let's talk about synthetic long positions. So, a lot of people are bullish. A lot of people like playing the upside. But one of the things that can be kind of a gotcha with playing the upside is, the buying power on like just buying stock can be quite prohibitive. Like it's pretty expensive to just buy straight stock. And so I wanted to offer up a couple of ways around that can give you the same delta exposure to the upside at a fraction of the capital. All right, gentlemen. So Laura, let's go to the first slide. So why would we even bother? Well, as I kind of just alluded to, you want to play the upside. You could even do this on the downside too, of course, but I think most traders are kind of looking more towards the upside. And so the capital efficiency with synthetic positions, man, it's second to none. And when it comes to options, like if all you ever did was just recreate like bullish positions, but you did it in a more capital friendly way, to me, that's alpha. Honestly, like to me, that is legitimate alpha. Now, it may not show up in like the returns, and it may not show up in like risk-adjusted abnormal returns, whatever, but that's alpha, man. Like if you're able to essentially simulate the same position with, let's say, 20 to 25% of the capital that it would take if you went straight to the stock, I don't know, guys. I call that alpha. What do you guys think?
Yeah.
I call that every day ending in a Y for me is what I call that, essentially.
Yeah, I think there's it's definitely something that retirement accounts should be considering all the time, because a retirement account, like if you sell a put in SPY, you're putting up the same capital as if SPY is going to zero. And if SPY goes to zero, I'm more worried about how much rice I have in my cupboard than markets. So yeah, IRA accounts, things like that. But even other positions where you can use less buying power if you just spread it off. And if you intend to just like go back to a naked put in that same example, if you do get the big wipeout to the downside, you can really reduce your cost basis by just selling out of that long and then getting back into that naked short. So I like it.
Yeah, no, exactly. That's and the IRA accounts. I mean, that's the perfect example of this whole idea where it's like you're not getting the margin relief. Like there's no margin relief to be had. So you have to find some creative ways around that. And these are a couple of ideas that might help. So Laura, hit us on the next slide. So this is kind of the OG like synthetic long stock like strategy, right? You go to the at the money options, you sell an at the money put. You buy an at-the-money call. So something like this wouldn't necessarily work in an IRA because you're still going to be short that at-the-money put and you're going to be margined all the way down to zero and you're going to be counting, the beans in the pantry. But if you're looking in a margin account, right, I'm short an at-the-money put, I'm long an at-the-money call, that's 100 delta, right? And you're going to be able to do this for a fraction of the capital that it would require to buy those 100 shares in whatever stock it is. And so if you're in a margin account and you want to play the upside, this can definitely be something to consider. The gotcha here, and I'm curious if there are other gotchas that you guys see. The main gotcha here is, the nice thing about stock is you can just put it in the stock drawer and not worry about it. Like if this is something you intend to hold for a long time, you don't have to worry about it. You don't have to babysit it. Like it's just going to be there. This, especially if you're doing it like 45 days out or even 60 days out, if this is going to be a year-long or multi-year long position, you're going to have to be in there at least a little bit because when you get close to expiration, you're going to want to move things and roll things and make the adjustments that need to be made. And so that's probably the biggest gotcha. But man, for the buying power savings, I don't know, guys, it seems like a slam dunk to me.
Yeah, I couldn't agree more. And these things are going to ebb and flow. So it depends on the product you're trading too. Like if you're trading a product that has 200% IV, you're likely going to be putting up a lot of capital relative to a different product that has 50% IV. But I'm looking at Rocket Lab right now, $90 stock. If you bought 100 shares, you would put up $4,500 in buying power. But the margin requirement for a short put is only $1,800 in buying power. So that's where that buying power relief comes in. Just replacing the long stock position with that short put is what gives you that buying power relief. And same thing with like a covered call. Instead of buying 100 shares and selling a call, just sell a slightly in the money put at that same strike, and you're going to be using buying power much more efficiently than if you own those shares.
Yeah, I mean, these are the things that, these are the ways that you can make your money go a longer way, and sort of set yourself up to be able to do other positions when you're able to preserve capital using these type of strategies for sure.
Yeah.
Yeah, and it's like, capital, buying power is oxygen, right? Capital is life. When it comes to, what do we want to do? How are we going to do it? If there's no buying power left, it doesn't matter what you want to do. You can't do anything. And so when you start thinking about officially using the capital, I think that these are some strategies we can deploy. So this is the OG. Laura, go to the next slide. So this is kind of the modern twist on the OG. Now maybe we go to something like a zebra. Right. So now this is something that you could use in an IRA that's going to give you that margin relief that Mike was referencing a couple of minutes ago. So now maybe I buy a couple in the money calls. So I buy 275 delta calls. That's going to give me 150 delta to the upside. And then I sell an at the money call. That's going to give me 50 deltas to the downside. So my net result is still the same 100 deltas. Now, same exposure to the upside, far less buying power. Zebras, I would say, are going to require a little bit more skill and ability to manage because there are kind of some nuances and some booby traps that are kind of in there that you need to really, take some time, dig into the archives and take a look at. We've done a ton of zebra content. I know, Mike, you've done a ton of this content before. I've done some even out from theory to practice. It's like give these guys a look, spend some time with this for a little bit. And when you do the first one, like I would, keep it kind of small, do it in like a lower price stock, just so you kind of get your feet wet. But this can be a great strategy to duplicate the 100 shares, even in an IRA, and save you a bunch of buying power.
Yeah, the zebras are super effective. And I think I like to use them a lot in really low IV products. So like SPY or QQQ or TLT or GLD, these products that have, IV in the teens or even the low 20s, because that's where you can really get super efficient. And it's the opposite of short premium, right? If you're selling an option, you want that high IV so you can get a lot of premium relative to your risk. In a zebra, you want really low IV so that you can buy this thing and get that 100 delta position for very cheap relative to the notional value of the stock. But it also works in like near-term cycles. If you're just trying to play SPY or the Qs for just this week in a certain direction, you can get into a 100 delta position for a fraction of a short option or 100 shares.
Yeah, and the risk is defined to some degree, like on both of these type of things. Whether you're talking about, the zebra is very defined. Obviously, when you're doing a synthetic long, selling that put and having the long call, it's defined, but it's substantial. But it's only to the downside, only to zero. I know that sounds catastrophic, but it's not as bad as if it were selling upside and a name like we've seen with these tech names that have just continued to go and go and go. So it's these are very kind of more defined sort of risk names, positions.
That's exactly right. And that can be a beneficial thing in and of itself, obviously. Mm-hmm. So, all right, beautiful. Let's get them a few takeaways, man. Let's move on to the next piece. All right, one of the biggest advantages to using options is the ability to efficiently allocate your portfolio resources. And there is no better example of this than with a simple long stock position, one that can be easily duplicated with a synthetic long position or a call zebra, whether you're an OG, whether you want the modern twist. Like, we got something for everybody here this morning. There you go.
Beautiful.
Yeah. If you say OG too much, you're going to invoke Chris Vecchio showing up with talking about the hand of OG in the Knicks, man. Just be careful.
That's it. That's
unbelievable. Oh, your Boston Red Sox. I watched that game last night. That was nice.
Hey, man, we swept them. I don't even know how we did it, man.
Yeah.
That's crazy stuff, guys. That's crazy stuff.
The only reason you guys ended up winning that game?
Oh, yeah.
Weren't you up 2-0?
Oh, the game last night? Yeah.
Oh, no kidding. And then the the Yankees came back and it was 4-2, right?
Yeah.
In the 10th, that's what I saw. I didn't know. You guys ended up winning that? Wow.
Yeah, Duran got pinched and he got, I think he was the reason they won, really.
No, he got the game-winning hit.
Yeah, he got the game-winning hit. And then the only reason I knew they swept was because I saw those the mascots with the brooms out. I'm like, oh, this must have been a sweep.
Yeah.
But no, great game. That was fun.
Yeah, I saw when it was 4-2 in the 10th. I didn't realize they came back. Wow, that's crazy. Wow, what a game.
But yeah, appreciate you, Dr. Jim. Good insights for sure. Definitely for retirement accounts and certainly for near-term delta replacement positions like zebras. I think the shorter term you go, the more leverage you get because you're paying a lot less relative to the notional value to get 100 deltas. But I think
I'm winding down here, man.
I know. Couple minutes. Yeah, a couple minutes.
Well, Gus was on this morning and he talked about the names that he's noticing, but the one that stuck for sure was the deal between Charter and SpaceX, and that's having reverbs through the industry. TP came on and bookended that, talked about some of those names, AT&T and Verizon, and so that kind of forced my hand when I saw TMUS, a big name, a very well capitalized name, but that's struggling from this news, and it's down, and the stock looks ugly. I decided to sell a put in there. I couldn't resist myself with Micron and SanDisk. These names are down quite a bit. I did put on some cheap call butterflies, did one in Micron, did one in SanDisk earlier as well. And like you, Rocket Lab short put, closed that out today. And I think that's mostly it. I bought back a short call spread in AMD. So those are the trades so far. I am going to be looking to close stuff. But again, a lot of stuff that I am I'll be looking to close as if we're up a decent amount on it, and it's just I'm kind of paying attention to how much capital I'm using as we're heading into the new quarter here. So watching that stuff, as it were.
Yeah. Last night I put on this neutral iron condor in the E-mini futures. It was a chicken iron condor, 73.20, 73.10, 75.50, 75.60. That was a $200 credit, 4-point credit here, but $200 real dollars, risking $300 real dollars as well. Rocket Labs closed that 80 strike short put, like you mentioned, for $155 winner. Uber closed a $135 winner with that call diagonal spread, the 75.85. And then Apple closed the $200 winner after the small rally today. We saw a bounce after the liquidation event we saw last week, and we bought the dip there. And that was a quick $200 winner in like 3 days or whatever it was. But long September, short July. So we had a lot of time. But again, I want to just free up some capital, prep for a couple of days being away. And I think really the only other thing as we scan through this portfolio, Microsoft, I definitely want to hold on to. I'm just looking at the green PNL open here. Micron Iron Condor from that Butterfly Iron Condor trade. 18 days left. We're right in the middle of the range now. This is when I want to kind of keep on and see how much I can get out of this thing. It's up $200 right now. $325 would be 50% max profit. So I'll keep my eye on this, but we have plenty of room to the downside and upside now.
Either way, this is perfect for that.
Yeah. So I think really my big pain point here is going to be this micro crude position. It's down $200 right now, but I've just continuously rolled. I had the 76 strike short put. If we look at the order chains, sold that for $3, rolled it to a straddle at the 76 strike when it went from the 1 day to the 21 day here at 255. So I have a total credit of 555 here, and there's still $200 of extrinsic value to decay in these options, but my next move will just be to close this one 17 days and then roll it out to the 49 day. Now, the nice thing is because this backwardation is gone, I don't have to really change anything, because before we were looking at like a last price of 73 and then the next one's a 70. So I would have had to roll this strikes down 3 points to match it.
Yeah.
But because these are all the same price now, I could just roll from the 17 day to the 49 day straight up, and rolling to the same strikes right now would yield about a $300 credit into this little rally here. And before the week ends for me, which is on Wednesday, I will be making this adjustment just to add more premium to the position. It'll bring me up to $850 if I get filled at $3, and that will bring my break even below 70, all things considered. So that'll be the move that I will for sure make before the end of this week, but I'll continue to just find some choppy trades if we can find them.
Yeah, I think at this point for me, the bulk of my portfolio is in August, mostly in 53 days. It's with most of my positions. I do have a few things that are left over in the 18 day. Some of them are strangles. Intel is one of them that I probably end up closing out this week. CoreWeave is another one. Cerebrus is another one. And I think there's one more. Is that it? Maybe that's it. Yeah, those are mostly the things that I have, at least in the 18-day. Other than that, the few other 18-day things that I have are like calendar spreads where I was selling upside. I'm not even worried about the upside for the most part. And again, they're part of a calendar spread. So yeah, that's kind of the risk management factor I got going on for the week as we go into a slow week here. But no, it's been a great morning, man. I mean, just talking with the people again. Tim Knight is probably upset once again now that the market is back up. He came on basically around the lows of the market, which was very fascinating. And again, TP came with some great ideas, especially in those telecom names, and that's kind of fascinating. I mean, this is something that remains to be seen. I think it's fascinating because I remember when I saw that news a little bit this morning, and as Gus talked about it, I'm thinking about SpaceX, and it's already affecting a lot of different names. Now it's affecting names in the telecom sector. Last week it bought Cursor, which was an AI name. It's in the space, sort of realm. So there's a lot going on there, and you're starting to see how this name is affecting other names in the market.
Yeah, it's interesting. I never had that on my bingo card. I mean, I knew they had the internet and all that jazz, but new cell phone provider, like that would be, I never would have thought.
It's a disruptor, essentially, is what it is.
Yeah.
And that's at the heart of it. That's everything that Elon has kind of been about. I mean, Tesla was a disruptor, big time, for the car market, right? And everybody's like, oh, this is not going to work. What are you doing? And he just finds ways. So I think that's what the interest in SpaceX is. That's why we've gotten these positions where we sold a put to buy calls further upside. Like I think that's the value add right there for SpaceX, because you just don't. There's no limit to it. They can figure out any multitude of ways to be viable and make money at some point.
Yeah. If you join us on the YouTube chat, we appreciate you. Why don't we pop over there, see if there's any last minute questions, trade ideas in the chat. But yeah, it's been a crazy day, like you said. And the markets have been chopping around like crazy, but we are right back where we started at 7:30, 8:30 Central. So, wild day.
Let's see. I know somebody asked about grouping positions. Can I group? Any thoughts on Netflix? That's one. I got long Netflix last week. I got long Netflix via, I think I sold what did I do? I sold a put in there in the August cycle at 75 strike. And then I also did a super bull trade in October, longer term. Again, just looking at the way the stock's been trading, I think it has to be a little bit longer term. There's a lot going on in that area. Not sure, but that's what I did.
Yeah. When you look at this chart, you zoom out here, we are back at 2024 levels here.
Mm-hmm.
So multi-year lows, we're going to go more long-term. I think that's a classic setup. It's what we did in Nike. It's what we've done in Microsoft. And Netflix, I think, is just another one where they're doing enough to where I think they can stay afloat. But the premium is there, 40%, 50% IV. You can do a lot of different things there. But yeah, in terms of grouping positions, I always group by order chains. That's the only way you can see your holistic view of a position. So like if I look at my MES position up $1,600, all of this with 10 rolls, if I group by symbol, you see a very different P&L open, because if you group by symbol, every time you roll or make an adjustment, the P&L resets back to zero. So group by order chains is a really unique feature of Tasty Trade's platform where it keeps track of all your rolls. And you can see my order chains here. If we look at MES, my order chains match my total P&L on the positions tab if I'm grouped by order chains. But yeah, if you want to do like customized groupings and whatnot, you can do that in certain scenarios if you group by custom, I believe is the way to do it. Yeah, so if you go by group by custom, you can group your positions, name them, and do stuff like that. But again, I like doing the preset order chains just because I'm rolling these positions constantly and I want to see where we're at.
Yeah, you brought me around to that last year. I like that. I use that as well now. So, but yeah, great morning, man. We got, again, it's holiday shortened week. We'll see how it ends up. And, we'll talk to the people tomorrow for sure.
Yeah, absolutely. So just a quick reminder, Friday, the markets are closed. So Thursday is the last day to make adjustments or trade. But like Jermal said, it's been a wild morning. Thanks for joining us this whole time. But stay tuned on tastylive.com as well as the Tastylive YouTube channel. Keep your trade ideas, questions rolling in there. We've got Liz and Chris on the other side of this break. You're watching Tasty Live.
Ready to take your trading skills to the next level? Dive into the world of stocks, options, and futures with Tasty Trade courses. Whether you're a beginner or more advanced trader, our courses can empower you with the knowledge to succeed. Watch as our team in Chicago shows you how to use the Tasty Trade platform and go over the basics of trading. Perhaps you'll learn about a new strategy or a potential product for your portfolio. To find our courses, go to the Manage section of our web platform or head to courses.tastytrade.com. Start taking control of your financial future. Visit our courses today.
Twitter versus Facebook. A rap battle. First up, Facebook.
Twitter, I'll snuff you out like I did to MySpace. I'ma have to erase your little Twitter face. Warm it up, Facebook, I'm about to. Did they make an Oscar-nominated movie about you? Check my school out, I'm at the top of my class. My main interest is listed as kicking your ass. I help dictators get thrown over. You help the cast of choices, you'll get overexposure. I'm too Titanic for you Twitter and twist. You bird-ass tweets, stick to the branches. I'm root deep, universal expansive. Twitter better get lost before you get poked. What? What?
Yeah, this is Twitter. Check it. At Facebook, can I attack you? Yes, and I could do it in 140 characters or less. Brevity's the soul of wit. I'll make this quick. Hash mark. Facebook is a dick. Retweet. Yeah, I'm backing that ass, and I'm young and I'm brash, and I'm packing that cash. Stick with the kid, I'm an early adapter. Your old Facebook played out like Napster. I make it real easy for family to talk. I make ex-girlfriends real easy to stalk. I show you life in real time is completely amazing. I show you which celebrities are totally crazy. From Blitzer to Sheen to Kanye to Rom. I run with stars, Facebook is a place for your mom. What's the matter, Zuckerberg? Don't like how that sounds? I got 1 million customizable backgrounds. It's so totally boring. My card's on the table, hash mark. Facebook is disabled.
First thing about Tasty Trade is how easy it is.
It's a very quick, light platform. It's all on one page.
and with 1 or 2 clicks, you can be anywhere on the platform.
Being able to see graphically where your profit and loss zones are.
Whether it's a pool, a puddle, or a sea, you can navigate your way out of it with the Tasty platform. So I love that. You guys have the most unbelievable customer service in the business.
Email support, call support, get through right away.
They actively listen to the customers to make changes to the platform to make it better.
In fact, I've never seen anything like it in any corporation in the United States.
Liz, we are back. You're still watching Tastylive. Liz Deerking, Chris Vecchio here for the next 30 minutes or so as we wrap up this first half of the trading day. Liz, how are you?
I am doing excellent. Chris, I need to jump right into this because it is June 29th, right? And
All
so
day.
you discussed the June swoon, and then you said something that I'm very intrigued in, the Christmas in July.
Christmas in July. The final 3 days of June plus the first 9 of July, according to the Stock Traders Almanac. They call it Christmas in July because since 1985, the market's gone up, I believe, 78% of the time in that window to a tune of 2.5% on average. And here we are, day one, NASDAQ up 1%.
I wholeheartely agree with this. And I'm not saying, Farmer's Almanac, I'm never going to the Farmer's Almanac.
Stock Traders Almanac, it's a different thing.
The Stock Traders Almanac, I would never go against it. But in my heart of hearts, and I was screaming this from the rafters, that typically June, there's a lot of money that goes out, but except the end of June, the very, very end of June is sometimes a rocket ship to the upside.
End of month, end of quarter, stocks finding some support here at the start of the week. We can go right to the charts, Laura, and I know we're going to do some confirm and send here. People continue to send us those questions, Liz, and we've heard some feedback. You want more of the questions answered here, so we're trying our best to make sure that happens. But, when we go to these charts today, it's a day of distribution again, and I think the most important relationship that we're seeing in play here today, the Mag7s are finally bouncing back. They're up by more than 2.8% here right now. Liz, have you been bargain shopping in your Metas, your Microsofts? Is this an opportunity, or do you still dislike some of these charts that are vertical to the downside?
Okay. Hi, my name is Liz. I'm a trading junkie, and I have been dabbling. So, yeah. I can't stop. So it's fun to see those ones. So Microsoft, I have been dabbling. I'm always a dabbler, but right now I look at this as an opportunity when they aren't up as much as the rest, and it's fun to play. Now, I will tell you, I'm an options trader, so I'm using the 2-day options, which I've also come to love as the short term. I'm like an instant gratification person. So in Microsoft, I'm selling that at the money put until I can put the stock. I'm doing that Wheel of Fortune, and then I'm selling a call against it. So it's pretty interesting with these because there's a lot of premium. I have some faith in them, and yes, I'm dabbling.
Okay, you mentioned this last week on the show about the Wheel of Fortune strategy. Obviously, the goal isn't necessarily to get put the stock, but if it happens, what's the plan thereafter? Do you mind explaining that? Because maybe this audience isn't so familiar with Pat Sajak and Vanna White.
Yes, okay, so there you go. So the Wheel of Fortune, you're selling a very aggressive put. And I'll do this when I want to get rid of my stock as well. So just kind of bear with me for a second. I'm selling a very aggressive put, meaning I'm getting the most juice that I can in the nearest term month. And Microsoft is a great example because you can get about $500, between $400 and $500 every 2 days in Microsoft. So if you just sell like the legit super, super tight, just out of the monies or just in the money put right there, then you get put the stock, you come in, and within the next days, you sell the aggressive call for another $500 to $400 to $500, and then the stock can get called away from you. Then you lather, rinse, repeat, where then you just go in and sell another aggressive put. So you're following the stock. It is bullish, but you're using that very aggressive premium to take advantage of it.
Sure. Volatility today has come in a little bit. It's we've had this really interesting relationship in recent sessions where you're getting stocks that are down 1.5% to 2.5%. And then the VIX isn't closing above 20. And it feels like the next day, because the VIX isn't above 20, people are reflexively buying back the market. Today, we have another session where we start the day a little bit higher on the gap open, and we trade lower, 1830 right now in the VIX. You've mentioned this is kind of the no man's land in the market, where when you're in that 17 to 20 zone, really, you can go either way. You can get the vol expansion or the vol collapse when you look at the distribution of
VIX returns, so to speak, at these levels historically. So how do you operate in this market now? We're getting to the end of June. You mentioned that there tends to be a big rip. Is an 1830 VIX enough fuel for vol to come back in a little bit over the next few days here as we look into the end of this first half of the year?
I mean, I think so. I do, right? We talked about that last week about how this is that in-between level. But I do think that we've been in a weird market too, Chris, where even if you get the up move, we haven't seen vol go back down in your 15, your 14 levels like we have in the years past. So I think if we do get what I'm looking for in the market's a big up move, you will get a pullback in volatility, but I'm expecting a very, very huge pullback. We're keeping, with everything that's going on right now, the volatility seems to kind of want to stay in this range instead of those long-term where it goes up. Now, that being said, even today, we had a wild ride, right? So we opened up pretty high. We rallied down, came down all the way to almost unchanged. So given the swings intraday in the market, the volatility should keep its wings up a little bit.
At least in the short term, perhaps. And one of the more fascinating things when you look at the VIX chart, not that we're doing any technical analysis on volatility, it's a non-stationary time series, so you cannot do technical analysis on it. But I will point out that even though stocks have pulled back in over the past week and a half or so, right, June 17th, 18th, they peak out, they go through a little bit of the June swoon on that very specific calendar through June 26th, and now the market's rebounding into Christmas in July. Volatility never came unstuck or ripped higher. VXN here, 18.5, 19. It's been steady state. So if there's real panic in this market as a result of the June swoon, we would be looking at vol that would be pushing higher right now. It feels like a lot of folks taking winners off the board and redistributing capital across the market after what had been a tremendous run for tech stocks. This is going to be the second best quarter in the NASDAQ's history. That begs for reallocation at some point in time.
Yes, it does. It does, right?
It has to.
Yeah, absolutely. Okay, so I asked the boys this question. I want to get your opinion on this too, and I know we'll get into questions. So SpaceX is going into the NASDAQ on July 7th, I believe, but it is not going to the S&P. So does that gives us a little bit of an opportunity for more diversification between those two indices, because they do hold a lot of the same names. Now, don't get me wrong, different percentages. I'm well aware that the NASDAQ is more tech heavy, but they still bleed over into the other one. But this is going to be the biggest, I would say, component that is in one, not in the other. And S&P is holding firm with their rules. So that gives you a little bit of, more of a pairs trade where it's not as correlated as they once have been.
And that's so necessary. I mean, if you're looking at the correlation between the South Korean Kospi and the NASDAQ over the past month has been higher than the relationship between the S&P and the NASDAQ, right? And so it's just something else to provide some diversification. So it's not just all mega cap tech, AI infrastructure. I think that's going to be a welcome reprieve for traders. We could get into that situation, right? Yeah.
I give you a gold star for bringing up that reference. How you worked that into conversation was amazing.
I have no idea.
Good job. Yeah.
But we can go to some of the questions that we've been receiving here over the course of the morning. It's confirm and send after all, so there's a point to what we're doing here. Liz, why don't I start this off with the first question for you here, because we've both been through so many of these episodes. On shorter trading weeks like this one with the holiday, volume usually dries up. Is that the kind of setup where you put on an iron condor expecting the market to stay in a range, or does low volume actually make the move less predictable?
I am whoever wrote this, I want to give a big heart to, and the Taylor Swift heart. So I don't know. I'm going to see how Chris does it with his daughter. But so love this, because I think, and I don't know if it's popular opinion, when I answer questions, you have to understand this is only coming from my experience and zero to do with any, Chris will come up with the facts that come behind it. I'm going to give you my trading experience. I think these shortened weeks, your Thanksgivings, your 4th of July's, the ones where there is a day off, I think it makes it much less predictable. I've seen wild and violent swings because it's almost like when you have more players in the game, the more liquid the products are, and right, people are going to take a step back. You get less swings. So with the less players in the game on holiday weeks, you'll see if you're going to get a movement, sometimes it can pick up steam in one direction or the other. That's my opinion, but I know you're going to give me the facts behind it. Oh no.
I'm with you. I mean, low volume means less conviction, but maybe there's a difference. I mean, the liquidity to me is the most important thing in the market, right? If you're getting liquidity that's coming in, then usually asset prices go up. But when you have thin or marginal liquidity conditions like this, that is the chance or the opportunity, the window where some event, some binary risk can produce that outsized flow. And that's what brings me to the Thursday non-farm payrolls report this week. If this was a regular trading week, when we think about like Juneteenth a few weeks ago where we had that Friday off, you don't really have any significant major economic data that's arriving on the Thursday beforehand. And so when you kind of go into the weekend, you're gliding into the weekend. Whereas the first 3 trading days this week, you could throw that all away with a big dislocative non-farm payrolls print Thursday morning. So if I'm setting iron condors for this trading week, I'm not using a Thursday expiry here. I think we're going out to next Friday at a bare minimum, because we want to have time to operate and not get crushed with a gamma move against our favor, because non-farm payrolls gives you a 200K or a minus 200K print, and all of a sudden the market's belly up in thin conditions. So watch the calendar when you go into these holiday weeks. If there's big events, the marginal buyer or seller can push things around a lot.
Okay, so non-farm payrolls is Thursday. What time? That's 7:30ish, right?
8:30 Eastern, 7:30 Central.
So that will be interesting, and you and I will be together during that. And then number 2, isn't there a jobs report, or is there not a jobs report?
Well, that's our jobs report. We have JOLTS on Tuesday. We're going to have ADP Wednesday, non-farm payrolls, and initial claims Thursday. But that begs, if you're going to trade the market range bound going into the jobs report, it could be something where the market chops around Tuesday, Wednesday. Everyone keeps their powder dry. Non-farm payrolls comes out. Everyone pushes around their chips. Folks then fly out to the Ozarks, go out to Lake Michigan, the Hamptons, and then Thursday afternoon, it's kind of like a steady state once you get to that initial reaction.
Yeah. Okay. I like it.
We can go on to the next one. And then, this really seems like a question for you, but I've been doing a little bit of learning here about jade lizards the last few days. So why don't you ask this of me? Let's see what I know.
Let's see what you got here. A jade lizard eliminates upside risk entirely while still collecting a credit, which means the risk profile is completely asymmetric. What does that asymmetry actually do to your expected value versus a strangle? And when does the math differ one over the other?
Well, I don't think we want to confuse no upside risk with free money, right? And that's what a lot of traders think initially when they go into positions like this. Yes, you are eliminating the naked call tail risk, but we are paying for that by giving the upside credit and concentrating the risk on the downside, if I understand this correctly here, because this is your jade lizard trade after all. But versus a typical strangle, a jade lizard then usually has a prior probability of profit, because you can't lose the upside if you structured for a net credit greater than the call spread width. But the expected value is not the same as probability of profit. Right. That's the trap that a lot of traders fall into.
And that is very well said. And it says, when does the math favor one over the other? I mean, strangles are great. Strangles have their time and their place. They truly do. But as far as the math goes, and I'm using math as the research from the past, right? So you're looking at, and they've done study after study. They used SPY, they used IWM, they used GLD. And on the road one year, I asked for a 10-year back test for all those that have dollar-wide strikes that it was easy to do, whether it behooves you to mechanically each day do a strangle or a jade lizard. And the jade lizard won time and time again, because of the fact that the risk profile is, you don't make any money to the upside in that, but you don't lose. And that actually turned the math in the favor of the jade lizard. And that was studies that have been done over years and years and years. So you
want skew is rich on the put side then?
Well, all of those, the ones that they studied, had normal skew, right? So a jade lizard makes no sense in something with call skew, because then what you're doing is you're buying the option with the most expensive call on the board. The jade lizard works with regular skew, meaning that the puts have a higher volatility than the calls as you go up. So the jade lizard does take advantage of volatility skew in the normal fashion. Now, these were also created well before you had all these products that have crazy call skew, right? So you have to take that into account as well. But those were the ones. It was GLD, SPY, IWM, DIA, and I want to say something else, but something that had dollar-wide strikes. That's when it makes sense, when you have like a regular skew.
Do you do this when IV is high or low is usually a follow-on question that we have. And we talked about this a bit last week, but you never know who was listening.
Well, so if you're selling premium, it's a premium selling strategy. So you want high implied volatility. But when you think about it, you're going to get a lot farther with high implied volatility. If you've got a low IV, I'm not going to do a premium selling strategy. Strangles and jade lizards have the same principles in the fact that they're both selling premium. When you've got a very low IV, I change my strategy into something else.
Right. So from my understanding, and I'm starting to dabble with this, it's not in the follow page yet because I want to make a fool of myself here, but once I get my hands on this, because I'm trying to incorporate some of these new strategies into how I express myself, particularly when it comes to single stocks. The indexes, I feel like I've got down pat and how I operate around them. I've noticed that when I try to bring some of my futures index strategies over to single stocks, you know what? It's not always working out the right way here. So, looking at this for me, my first blush here, I want vol that's overpriced because I don't want to deal with gap risk, so that the credit received is enough to absorb any gap risk, particularly in the short term. So, Liz, I have some learning to do here with the Jade Lizards, as it were. Jade Lizards, zebras. I'm going to go through the whole zoo here at Tastylive.
Yeah,
one of these days.
Welcome to the jungle.
Welcome to the jungle. Liz, let's go to the next question. When the VIX curve flips into backwardation versus sitting into contango, should that actually change which expiration you are selling, or is that a futures market signal that doesn't translate into equity options the way people think?
I'm going to toss this to you. This is your wheelhouse, your futures options.
I could actually expect. This is a really actually good question because it tests your intuition as a trader. When I find the market sitting into backwardation, no, it does translate into equity options the way that people think. I mean, you see in the short term, when you get that backwardation in the VIX curve, particularly in like ES or NQ, it causes a lot of that single stock risk to spill over. The indexes can have the situation where you have like a lot of low index volatility, but then high volatility in the single stock names. But rare is the occasion where you have high index vol and low single stock volatility. That's pretty rare.
I don't know that I've ever seen that, to be honest with you.
I'm saying it's rare. I'm not going to say it never happens. I'm thinking of like Jessica Chastain in Zero Dark 30, where she says, I know you guys don't like 100%, so I'm going to say 95%. But like, I don't think I've ever seen that happen. I can't say that it's never happened before. So yes, if you see that futures market volatility in ES or NQ flips from contango into backwardation, that usually is a bad omen for single stocks. Single stocks flipping into like a Microsoft or an Amazon, that could be idiosyncratic or sector specific, and you may not be able to get a read on what's happening in the broader market that way.
Yeah. No, but it is true. So keep an eye on the volatility. And I know the boys in the morning, so I use boys loosely. I apologize for that. But so Mike and Jermal have been keeping an eye on that as well with just the VIX curve, right? And Mike really hangs his hat on the fact that that is a precursor to what the market is going to do. Now, but we've seen it flip back immediately. You can kind of see it flatten or steepen as the market is moving. So to me, I look at this kind of like when you just kind of break it down into something a little bit simpler. Call skew, right? So if you see a call skew in a single name product, it doesn't necessarily mean it's going up, but it does mean there are more people buying calls than selling calls. So it's kind of a different way to look at it. That doesn't mean the stock price is going up. It just means that they're increasing the implied volatility in those, saying that it could possibly happen. The risk is there. So the VIX and the volatility curve are good measures to look at and understand, but there is no X plus Y equals V with when the curve backwards and forwards.
Right,
So,
and if you were looking at the volatility curve this year, for most of this year, we've had some fairly steep contango in VIX futures.
Yeah.
Or if you look at ES or NQ, and if you were using that as a guidepost for how to trade Microsoft or Meta or Oracle, you'd probably be out on your butt right now. So it's not one for one. You can use them to help make informed decisions, but not for single stocks all the time.
But you know what, though, Chris? Everybody seems to want to know, and I get it, because I've got two kids that are getting into this, and they're just like, tell me what it is, tell me what this means, and you just kind of need to understand everything as a whole. Volatility is part of the picture; it's not the entire picture, right? You use it to make decisions. You use volatility to make decisions, and you don't try to fight the volatility. That's the one thing that I keep saying. We talked about this with toddlers. You have to take what you're given. Your kids have two different personalities. You can't try to raise your son the way that you raise your daughter because they're different. So you need to understand like the basic principles behind it, but don't fight what they're giving you.
I love that. Identify the market conditions, choose the correct strategy.
Yeah, and look at them as a big...
I was talking about parenting, of course.
Yeah. But everything's got like a small piece into it. It's just not the whole picture. Volatility isn't the whole picture.
Before we get to the last question, just a quick check on markets. S&P 7460 up 0.8%. The Nasdaq up 1.15% here. A little bit of a meander since we started the show. Can't say we've done really much of anything for the past 30 minutes at this point in time. But European session has ended. Liquidity's coming out. It's a holiday week. Volumes here are actually fairly meaty today. 819,000 contracts traded in ES so far. We still have what, 4.5 hours of trading to go, Liz? So that's not too terrible.
So let me
Sure, go.
One thing about the European markets closing. So what say you about when the European markets close? Because I think sometimes we get, the markets can shake out until the European markets close, in my opinion, and then it kind of levels off.
Depends what's happening in Europe. I mean, a lot of Europe recently, over the past, say, few years, you've been dealing with decent economic issues, political issues, and so once Europe closes, then U.S. stocks are kind of untethered and allowed to go up. More recently, that hasn't been the case because a lot of the gains that we've seen in the market have come overnight, but particularly in the Asian session, where you look to Korea and Japan and China, and okay, a lot of this is AI trade related. So Europe, to me, has been just an albatross. I don't necessarily view the European close as a bad thing. Most days it's like, finally, we don't need to worry about Europe. We can focus on America again and our air conditioning.
Yes, because it is right about now. Doesn't it close now?
Just about 6 minutes.
Yeah, 6 minutes.
Okay. Laura, we have one more question here before we wind down this show. This feels like a question for me. Why don't you take this one?
It does. This is for sure got your name written all over it. The 2-year yield hit a 52-week high last week. The dollar has been strengthening, and oil just repriced on the Iran deal. How does that cross-asset picture factor into where you want to be positioned in options right now? Take it away, Craig.
So last week we were talking about the 2-year yield and how it kind of leads what the Fed is going to do. You can use it as a market-derived measure of Fed expectations in a sense. And so when you see that we have oil coming in, the 2-year yield going up, and a stronger U.S. dollar, this is probably not an environment where you want to be blindly short volatility across the board. Because oil being down to this degree is not a sell everything moment, but it also, oil going up is a problem for markets. How come it's coming back in and is not providing a big boon or benefit to a broad swath of assets? So when we have higher short-end yields and a stronger dollar, that can pressure duration. It can pressure valuations. Companies that are more rate sensitive, for example, smaller cap companies that don't have moats on their balance sheets, those are the ones whose value gets hit hardest and first. So perhaps there's a read-through here. Maybe we should be a little bit more discerning about what's happening, like the Russell or the RSP, the equal-weighted S&P 500. But in this environment, right, maybe I'm wrong here. We want to sell premium selectively. We want to define risk. Frequently, this is not buying naked calls or puts or selling naked calls or puts. And I think that we need to focus on the fact that given the overnight headlines, there's been a lot of gap risk, not just on the weekends, but over day to day, right? How many days recently, Liz, have we woken up to a SK Hynix or South Korea headline and their limit down there, and all of a sudden SMH is down 5 or 6% here, and then it reverses the next day? So I think that's perhaps one way to go about this in the thinner conditions during the summer with what's happening with the Fed. Avoid trading strategies that would leave you exposed to meaningful gap risk, particularly in tech stocks. And if you can do that, then you're able to survive on a day-to-day basis and keep that powder dry and try to find the opportunity for the next big trade.
Would you kind of look more towards the Russell in this environment then?
If rates are coming in, the Russell probably has more upside convexity in the short term, right? I mean, think about the structure of a balance sheet. When rates are high, there's basically no layer of no cushion whatsoever. Rates come down, all of a sudden margins scream higher. So residual income that pours over into equity, the equity was worth zero. Now there's a lot of money that can be poured over from retained earnings, right? So that equity shoots up first and faster. That's why the crap tends to rally, not the big names, okay? Yeah. So we got to keep these relationships in mind. The Russell is not something I love here if we're talking about the Fed potentially raising rates. But, Ilya had a really good point. Kevin Warsh's task force probably mean the Fed has a 6-month runway to not actually enact any policy changes. And our SR3 contract back to 4%, not 4.25 for year end. I rest my case.
You heard it here first.
Liz, final word, and then we got to go to break.
I actually, looking at the close, we've rallied a little bit into it. I think we're gonna hold, and I'm a fan of Christmas in July. Is that what it's called? Christmas in July.
Christmas in July.
I'm a believer.
Christmas in July. Final 3 days of June. First 9 days of July. 2.5% gain on average over the past 40 years. What do you do with it? Market's going higher with it, but we'll be back later, of course. Tastylive programming continues next after a brief break. We have Gus and Errol coming on here for the morning show. We'll see you there. Thanks, Liz.
In the world of investing, a beast lurks between the numbers, ready to pounce. Some traders hide from it, some ride it. If that's you, join us on Tasty Trade. Genius loves company.
Coming up on Bad Money with Jim Blamer. Blamer's hot stock tip of the day.
Trade ideas? Trade ideas? You're coming to me for trade ideas? I'll give you a trade idea. Trade me for tastytrade.com. Those guys are great. I love those guys.
Investors Business Daily raves about us. Stockbrokers.com says we're best in class for futures trading, and Broker Chooser thinks we're pretty great too.
So what else can we say other than trade like a trader? Tasty Trade.
Tasty Trade's active trader interface makes futures markets your arena. Built for the bold, not the bored. Trade CME futures with a single click. From micro contracts to major ideas. And go even further with futures options. Tasty Trade lays out multiple ladders and charts for total visibility. Plus, hundreds of built-in indicators for traders who want a broader view. Tasty Trade, pro-level tools, intuitive design, total control.
Whew, let's make this quick. I gotta get going. I make $4.97 every second that I work, and if I don't clear $145,000 by the end of the day, I'm gonna go crazy.
Okay.
It's a cute dress. Where'd you get it?
Oh, thank you. H&M.
$23, 10% off sale.
That's pretty good.
Probably not worth more than $4 now. That's too bad. You got to be aware of these things. Everything has value.
Well, not everything is value.
Everything has value.
I am pretty sure I can name a couple of things that don't have value.
Go ahead, go for it.
Okay, caution.
5 cents.
Feebleness.
That's a sad one. $1.12.
I have a toughie for you.
All right.
What about us?
Me and you?
Yeah, did we have a price?
Yeah. 2 cents. We should have sold that one a long time ago.
2 cents?
Yeah, we could have made a lot of money on that one. Oops.
2 cents?
Yeah,
I wouldn't even pick that up off the street.
Exactly. I think that's more on you than it is on me. Lord knows I'm trying. Hey, you know what, though? There's money to be made everywhere. Take you, for instance. Look at you. You're a young buck. What are you, like 37? I'm joking. How old are you?
I'm 26.
With your genetic makeup, you know, you're not putting on too much weight. I think you could sell those little lady eggs of yours and make quite a profit online. But I wouldn't wait too long. Next month, those would go down big time, especially if you keep eating the way you're eating. I gotta take off. Time is money.
Are you serious?
Yeah. Hey, look, can you get the check on this? I left my wallet in the car. I don't like to carry around bulky things. It slows me down.
What is going on, everybody, and welcome back to Risk and Reward. Happy Monday to you. It's the beginning of a new week and another short week. Juneteenth and July 4th back up to each other pretty closely here, so it feels like every other week right now we're getting a short week. It is a synthetic Tuesday. I'm going to be joined by Errol today, but he is on the floor at the CBOE. We can bring him on in right now. There he is, looking sharp as always. Got on the sweater with the jacket layered over it. Who is this guy?
I'm trying to keep up with you, brother.
Is this my
I gotta
quant?
keep up with you, man. I gotta keep up with you, Gus. I got to. So, no, it's been a pretty wild market so far this morning. I know as the market opened up, we had a lot of volatility to the upside, to the downside. Now back to the upside, might test a new high in the day. So it's been pretty wild. A lot of volatility. I know it's going to be a shorter week. Maybe we see a little bit less volume in this next 4 trading days. I know you just mentioned we just came off of another 4-day trading week, and this is a second one. I'm really not the biggest fan of 4-day trading weeks, but that's just the trader inside of me. Go touch some grass. 3 days will be fine. So I'm looking forward to it.
You know, I think, I don't know. I think it's interesting. I'm fine with the 4-day trading weeks when it's the Friday, but I feel more apprehensive to it when it's the Monday. I don't know why. I don't know why I feel like that's more aggressive than the Friday. But in my experience, I have a much easier time trading the 4-day weeks if it's the Friday that's the market is closed and not the Monday.
That's fair. That's fair.
Yeah, I don't know these inexplicable things, but
that's fair.
Yeah, we can dive into the Tasty platform here, and we'll just we can pop around the market before we get into too many.
You had a good
specifics.
weekend, by the way.
Yeah,
As we get into the craziness. Yeah,
yeah.
Good.
Back's getting better, so I'm pleased with that. Still far from 100%, but getting better every day. I went to the pool, went to a White Sox game, and enjoyed myself.
There we go.
I was down there in your neck of the woods near the White Sox stadium, actually.
We had a little bit of the UV rays coming through. I went outside for a little bit. I didn't get much of a tan this weekend, but it was a little cloudy, but I'm looking forward to a little bit more sunshine over the next few days.
Yeah, it's tough. I did the beach last weekend and the pool this weekend, and in both situations, it was partly cloudy, and it's like perfect when the sun is out. But when the sun goes behind the clouds and you're wet, all of a sudden you're shivering. It's it's quite the 100%. Difference.
What do we got standing out so far today for you?
Yeah, looking at some things here. I mean, obviously, as Errol already alluded to, broader market has been really choppy today. It's interesting the way that we've gone back and forth. You can see very wiki stuff happening on the daily chart here. But yeah, we are just slightly green on the day right now, a little under 1%. I shouldn't say just slightly. If we go a little bit more granular, though, it makes that a little bit more clear. We ran up really aggressively off the open immediately. These are 5-minute candles, so this is very aggressive. Immediate aggressive sell-off, pretty much to exactly Friday's close before returning back to just through entry and back towards the highs here. Oil market continues to work down, I believe, at least last that I looked. Does it really want me to put the slash in here? Okay, I will. Yeah, actually working up a little bit intraday today, up from Friday's close as well. Zooming out a little bit to get the bigger picture here, as I feel that's a little more valid with oil. Clearly still sliding off, but we are. I don't want to say bouncing yet, but moving up from Friday's close. Do you still have some short oil exposure going on or long oil exposure? I forget. You took the long side, right?
Originally, there we go. I was using the futures contract to get on a little bit of long delta, got out of that, started utilizing USO, sold an out-of-the-money put spread there. We also bought an out-of-the-money call. So those expire in about 21 days, I think, the call, and then the put spread, I think I have about 40-something days on that. So it's nice that the volatility to the downside is at least slowing down. We haven't really seen any type of reversal or any type of relief pop yet. But again, a little bit of sideways movement is a start to moving in the right direction, just for a brief moment. So that's what I got going on in oil on my end, Gus.
Yeah. If I have to read a headline with Strait of Hormuz in it one more time, I'm going to lose my mind.
I know. I don't think it's over yet,
but I agree. I mean, it just every time it feels like things might be ending, it just stirs right back up. It's an abusive relationship we got going on here. It feels like we're ready to break up and get some closure, and then suddenly we're just right back in it, on again, off again with the Strait of Hormuz. So yeah, I continue to have. Go ahead.
Not to beat a dead horse, Gus, I don't know if these headlines are done with the Strait of Hormuz. You know, it still kind of feels like we've kind of thrown around the term fake headlines, you know what I'm saying, left and right, but it does seem like we could still be in the middle of whatever it is that we were in the middle of. So I know we've seen a little bit more downside action, but we might beat that horse a few more times before we throw it away.
Yeah, I would definitely be shocked at this point to see a return to the highs. Like something really insane would have to happen for that. But I'm not shocked if we see, like you're kind of saying, a relief pop or even just a shift in the headlines that pushes USO back to like the 125, 130-ish level, kind of in the middle of the run. But if all of a sudden we're back over 150 on USO, I would be shocked by that. That would take quite an aggressive headline or somebody
quite a headline.
Rolling
it would
back
take a real headline.
Yeah, it would take a real headline. Yes, precisely. Not a fake headline, the real one. I still do have my short USO exposure. This is one that I always have to go scrolling to the bottom for. There it is. As we work back,
we're getting there.
Yeah, we're kind of getting there. As we work back a little bit higher today, obviously hurting me pretty much just giving back Friday's gains, but plenty of time left on these. Just need need some kind of quick move. I mean, I'm going to need put side expansion really is the issue because I, again, ignorantly bought these at a time when the put side was already expanded. So I would need some kind of expansion on that side just to even make the playing field level again and kind of bring validity back to this thesis. Or if we want to, over the next 100-ish days, take a really slow churn down to like 70. That would also be like work for me. But these little tiny things, theta is already coming into play even this far out. So monitoring that closely. Don't really want to get even shorter. I agree with Errol's logic because the temporary pop. So just kind of bag holding those. It's not like they're not zero. There's not no bids. We absolutely could recover. But I would just need. I would need a real headline myself, really, is what would need to happen. I need a gap down in 95 or something like that to kind of expand this put side and give me a chance to get out there. What about metals? I have not had a look at metals at all today. Do you have any metals exposure going on?
No metals on my end. After we had put in a little bit more legs to the downside on those, a little bit more air coming out of those, they've kind of been off my radar. I think the indices in the oil markets, and then I think SpaceX really took my attention off of the metals for a little bit there, but seems like they still have some volatility to them. I know we're pretty far off the highs that we had sold off from. So again, I'm not too interested in the metals at these levels, but if we somehow got a rip to the upside, I think it would warrant a little bit of short delta, considering the fact that my bias is based off the fact we may not see another new all-time high. So until then, I'll probably just be sitting sidelines. But it's looking like it's been a little quiet over the last few days in the metals there.
Yeah, I almost tried to get cute towards the end of the week last week when I saw these green candles starting to bloom on the 1-day chart to get just a little bit long, like super aggressive into the end of this week. And just look for like I don't know. Let me use GLD so my prices are a little more grounded. This is the product that I was looking at. But yeah, these green candles are starting to come through, and I was thinking, maybe I could just play something for a little pop to over 380 because we have seen that throughout the entire drawdown. There are these little pops that come through pretty routinely. Most recently on just earlier this month, this gap is on the 15th of this month, so two weeks ago to the day. So as we started to get these couple of green candles, I was like, do we take a quick pop over 380? Can I take advantage of this? I decided to lay off, and I'm pleased with that decision at this time. It's just too hard for me to be bullish on these metals for longer than like a day or two, and even the 6 days that I was considering being long for just felt like too long, and that has worked out for me here.
No, yeah, I see that completely. And the metals trade was one that I wish I was kind of in with you a little bit earlier on. I know I was mentioning like a month ago. But it'll be on the sidelines for now. Keep paying attention to it.
Yeah, as far as headlines catching my eye today, I'm interested in SpaceX. The main SpaceX headline happening today, well, there's basically two of them. What I would consider to be the more major one is that NASDAQ has expressed interest in adding SpaceX to the NASDAQ 100, for months now, since pre-IPO. They have announced that they are going to add it to the NASDAQ 100 on July 7th, before trading July 7th. So July 7th will be the first day where it is in the NASDAQ 100. So catching a little bit of a pop on that. I don't really think that that's any surprise, and in fact, I'm surprised that this was not already priced in. It felt like a foregone conclusion that SpaceX was going to be added to the NASDAQ here sometime very soon. But then the more exciting, arguably more exciting piece of news with SpaceX is they are in exclusive talks with Charter Communications, which I believe is CHTR. Yes, Charter Communications, about rolling out a SpaceX mobile phone. Charter has quite the network of satellites, telecom infrastructure.
Starlink.
Yes, also kind of feeds into Starlink, which is internet, but could those also be broadband satellites? I don't really know enough about the technology to give an educated opinion on that. But Charter, obviously moving up since this news has broken. And I think the concept of a SpaceX smartphone is very interesting to me. I don't know. New smartphone providers, it just seems like, suicide isn't the word, but it feels like you are a something of a masochist trying to get involved with that. It feels like it's only going to hurt.
You definitely have a vision.
Yeah, the existing companies just have such a stranglehold on the smartphone market, and it's a really tall ask to try to break into that market. And we've seen giant companies try it before and fail. Microsoft being the most clear example. And then we now have Meta sidestepping things entirely and saying we're not even going to try phones. We're gonna bet that the future is in glasses, which I think that's a little smarter than trying to enter the market with a new phone right now. But if there's any company that could make it happen, it would need to be one of the 10 largest companies in the world, one of these giant big tech players, and SpaceX is now a part of that group. So I think it's possible, but it's going to be very challenging.
It's a great point that you bring up. I mean, well put. I don't even think I need to put it another way. Extremely competitive market to get into. So it's a pretty audacious move to even step into that landscape. So curious to see how it pans out. I mean, I'm all for innovation, new technology. I'm all for a new competitor coming along whenever one is kind of sleeping at the wheel. I think Apple's been comfortable for a long time in that space, but maybe they think that they have the monopoly on the phone market and it's going to stay within their reins. So we'll see. I'm excited about it. Very audacious, so I'll put it that way.
I agree, and I think you make a great point there as well. And that thought has crossed my mind today that I don't think I'm gonna have any interest in buying the SpaceX phone. I mean, maybe it'll be amazing and really cheap, and they'll have their own self-service built in, and it all makes sense. I don't know. There is a way to do it where I could be at least moderately interested. I would entertain it, but I'm mostly excited because if they're going to pour billions of dollars into trying to develop and get a new smartphone to market, that will at least make Apple have to get off their butt and do something.
It's a great point, right?
So,
absolutely.
yeah.
Read a little bit more. Yeah, light a fire under them a little bit. I want a new screen. I want to see Apple do something innovative. I think Apple's at the place to where they could take some shots. They could get pretty creative. Maybe that was the Vision Pro that they were focused on for a little bit of them taking their shot. But
I agree.
Would love to see them
and
do
they used to
something
always
new.
just try little stuff too, like the iPhone 5C. They were like, oh, let's roll out this slightly less powerful phone with some fun colors. And they tried the SE as well. I know that was like an interesting thing when they rolled out the smaller ones. And I actually do think there's a place in the market for smaller phones right now if they wanted to try that again. But yeah, you got to give me something. It can't just be camera, slightly better resolution, slightly better battery life every time. You're Apple. Innovate. Do something. It's what you're built on.
You got the funds. Let's do it. Let's get creative.
Exactly. Speaking of Apple, I did put on, I believe, while we were at the CBOE last week on Wednesday, I got long some Apple off the bottom of this dip here. Maybe that was Thursday, but I said I felt obligated to do it. When you see Apple take a gap down and slide this much, it just feels like it has to be too much downside. So kind of got long some Apple in a brain dead way there, but it did work out. Almost fully engulfed with bullish action the next day. Is sliding a little bit today after opening up 1%, but we're very close to unched and obviously above those levels. That position specifically, I think I'm around 285 on that. No, I have the 285, 290 short put spread. July 24th, 25 days left on that one. So yeah, feeling pretty good about chasing down the 290 level in the next 25 days after that instant gap up that we got, even with the slight downward action today.
No, great reversal. You're kind of in the driver's seat already in terms of how that position is going. So love it.
Yeah, 290, not even the full gap either. I always like when I can do that, get disproportionate risk, and I don't even need the full gap fill. I just need a test of it sometime. So,
you are in the driver's seat for sure.
Yeah, closely watching that one. And that's kind of all the excitement for me today. Otherwise, just tracking things. Meta logging a good day for me, but still a long way to go on that one. Rivian logging a fairly good day, but you guys know how I feel about Rivian. Rivian giving me 5% off the 15 level is just I expect it at this point. This is table stakes that we get this little bounce off of the 14 up into 16, and we'll go up and we'll test 19 and we'll come right back down because it's all Rivian ever does. But I'm going to do the same thing I did last time we tested 19 and get short again. That worked really well for me. I think as long as this channel stays valid, it's my duty to keep trading this channel profitably. So I'm looking for the 19 level, and I will get short and write it straight back down to 14 because, I mean, look at this. You can just zoom and zoom and zoom, and we are, not except for the big 2020 spike, but or 2022, whenever that was. But I mean, look at this. This is July of 2024 is basically when this channel started, and we have just stayed right in it. I mean, 19 range at the top with one exception where it still came right back down. And then we've seen as low as 9, but I mean, really this like $10, $11 level is the absolute bottom. And this year it's been closer to 13, 14. But yeah, Rivian just loves this range. And when you find things that are range bound like this, especially that move this quickly, always good to take directional advantage of those things. And I could also express this with doing, strangles or iron condors that are wider than this, but on a $16 product, I would be talking about something like a 14, 20 strangle, and that's going to take a lot of capital. So as long as I know that it's, you never know anything, but as long as I can reasonably assume that we're going to keep getting these big directional moves, I'd rather just play the directionality within this.
Yeah, no, absolutely. I mean, its reputation has definitely shown it stays within those ranges. So nice to see that it's staying true to course as we speak for now.
Yeah. So That's kind of where I'm at. We can kick it over to your platform if you've been slinging some scalps today or anything fun like that.
Yeah, a little bit. I thought we could get a little bit more involved again with these scalps. So we can jump to the Trading View platform here briefly. But we've seen a lot of volatility in the market. We have these levels of value marked off again. We did a little bit on the Sunday night open, and then we did a little bit this morning. Super volatile in both directions. But when we just zoom out here, these are the higher time frame levels of value that we're going to be paying attention to for this week. Interestingly enough, whenever we had this massive rally to the upside, we had a ton of buy order, a ton of liquidity hitting the tape if you watch order flow around these levels. And interestingly enough, we had a lot of volatile moves to the upside and downside. And after we sold back off to the downside, we had another massive dump of sell orders coming into the market. So that doesn't mean we're going to be bullish or bearish. It just lets us know something is going on within these areas. And we could see a little bit more reactions or trades that you can kind of get on board with around these levels. But as the Sunday night market was opening up, we were experiencing a little bit of volatility. Let me see if I can turn these executions on just so we can get a better idea of what we were looking at. But I was being a little bit stubborn here, Gus, at first to start. I mean, I think I took 5 losses in a row. So we were a little bit stubborn as the market opened up Sunday night. But as we started to trade near our value area low, we wanted to start getting short. And what happened was I was getting on some short contracts, and then I was putting my stop on at the highs. So every time we made a new high, it stopped me out of the position. And this was one where I was kind of fighting with NASDAQ a little bit here. I was like, I want to get short here. I want to get short here. Even though we kept popping to a new high, we were able to manage our risk, and we ended up losing a total of 32 points within this range right here. I think we took about 5 trades to the downside, and we got stopped out of all 5 of them. I think that's 1, 2, 3, 4, 5. And then we ended up selling off below our value area low. Things were starting to look pretty weak, and we wanted to target some lower prices. So we ended up shorting a couple more contracts, and then we were able to scoop up about an 88-point move to the downside. So that risk to reward really allowed us to step into the market and really clean up all the prior mistakes that we made. Because I think sometimes trades can work against you, and then you can also have your own mistakes that get in the way. So whatever the market did give us the opportunity we were really looking for, that was able to cover our losses and some. So that was really nice to see, especially after getting a little frustrated as the Sunday night market opened up. But we started getting a little bit more velocity to the downside. The range started to open up a little bit more. And we even sold off a little bit lower to lower prices. But then you got to ask yourself, if we reverse on here, if we reverse this position after we're up 88 points, right? Of course, we could have held a little bit longer, caught more to the downside, but I got to ask myself, after just taking 5 losses in the span of 10 to 15 minutes, if this comes back against me, how is that going to affect my psychology, my performance, and just my overall emotions to get into the next trading day if the market would have reversed on us? So we wanted to hold for lower prices, but that's kind of what we were going through in our head whenever we were getting out of that position there. But that was a Sunday night open. Then come to the Monday open, we're trading off of the same exact levels. So as the futures market is trading overnight, we start to trade inside our level of value. And this zone right here is going to be the zone that represents about 70% or most of the trading activity that occurred specifically last week. So that's the data that we're trading off of right now. And the market opens up, and I mean, you can see we try to sell off outside of that level of value, and then immediately we're bought right back up into that level of value. We sell off, test the value area low, kind of use it as a level of support, and then we rip to higher highs. So whenever we see that this morning, I'm thinking, oh, wow, maybe we're going to keep crawling to a new all-time high. Maybe we're going to come and test this value area high, but we're being patient. After a few minutes, the market sells off all the way down to these lows. I think this is when I was on with Mike and Jermal. The market just flipped upside down in the matter of just a couple minutes. Because keep in mind, these candlesticks are just 15 seconds a candle. So if we really put that into minute form, you can see just how quick the market can really flip upside down. But as we saw off to this value area low, we initially had a lot of buying here. So I wanted to test some longs. I didn't manage my position very well here. So we got stopped out for 50 points, a lot larger than I typically risk on a single trade, but it was only one contract. Also, how quick the market was moving caught me off guard a little bit, but I think sometimes getting slapped as the trading week starts really can make you be on your toes for the next trades. It's almost like USA losing their third match. I'm kind of glad they lost that third one so that they're really ready for the knockout round. So that's kind of how this one felt. It's like it was a wake-up call to manage that risk. Volatility is increasing because this little stop that we took was 50 points. And that's just on one micro contract. So just a testament to the volatility that we're seeing right now. And then as we got stopped out of that long position, things were still looking pretty weak. So we flipped short. Then we were able to catch 131 points to the downside, which helps cover that loss again. But it's like if we can reduce the amount of points that we lose based off of our own errors, then we can still gain a little bit more profit to be able to cover future mistakes that we might make. So with that being said, we were able to take a few trades off of that same level. Oh, and then after the market reversed down here at the lows, we took one more short off the same level just for about 43 points this time. And again, it's really interesting because after you get the move in your favor, you really have to ask yourself how long you want to sit in this trade. And then you got to ask yourself, if this trade reverses on me right now, how am I going to feel about that? How's my trading account going to feel about that? And how's that going to affect the next trades I take moving forward? Because whenever we put this short on, I was thinking to myself, you know what? We put in the lows down here for the day. What if we sell back off to the new day low? You know what I mean? It's like that would be about 100, 150, 200 point move. We could do that. But after recouping the losses from Sunday night and then the couple good trades that we took this morning, I made the decision like, you know what, let's just take the 43 points, take it off the table, and let's wait for the market to get to a new range to trade in since we already took about 8 trades off the same level now. So things have been pretty volatile, a lot of management in place. Now the market's pretty much just crawling to a new day high. But that's pretty much what we did today. It's kind of nice because now we're finally able to finance that SpaceX position a little bit better there now, Gus. But those are some of the trades we took for the day, and we'll sit on our hands until the market provides something else. I know we'll be paying attention to this value area high over here at 29,886. But until then, we'll sit patient. We'll sit patient. But that's what we had going on for the day in the micro NASDAQ at least.
Yeah, I like it. Yeah, it's a great analysis, and yeah, good illustration of the value levels here, of which we are currently chilling right in the middle of one, which means no action per Errol's terms. But yeah, and did pretty well for yourself, and
for sure.
Yeah, financing that SpaceX trade is a nice one too. SpaceX, expensive one to deal with right now. Lots of volume, lots of volatility, lots of skew.
Yeah.
You know,
the SpaceX one really caught me off guard. And I'm not gonna lie, Gus. Like the SpaceX one, even psychologically, like that one just like threw a wrench in my trading for the week. So it was really nice to get off or around the hump on the SpaceX position at least. So
absolutely. Yeah, I've just identified something over here that I think I'm gonna take a swing at if we wanna jump back over. I'm gonna move on AT&T. This is not a company that I usually trade at all. Great dividend stock. Looking to put together an income portfolio out there. Love the dividends on AT&T, but this one is really beaten down over the past couple of months. Zooming out a little bit here, you'll see we're at 2024 lows. The last time this level was seen is October 2024, so almost perfectly 2-year lows. Continuing to slide. I am a little bit concerned about how tightly I'm going to try to time this, just because I'm really catching a falling knife here. Usually on something that's sliding this aggressively, I would like to give a little bit more time horizon, but I wouldn't be surprised to see a little bounce come in like before the end of the week here. I just did 5 seconds of due diligence, and there doesn't seem to be any headlines that make me think like, I mean, AT&T is gonna, really be hurt here. Like this is the new established valuation of AT&T. So I'm gonna take a swing here. I have found this bull put spread 22 and a half. It is AT&T TE, so I'm being aggressive here, but 22 and a half. So I need $1, which I mean, to be fair, is close to 5% on a company this small, but I need a $1 up move in the next 18 days, and this is 10 buying power for 40 in credit. So this feels too good to pass up on. And at 10 buying power, I'm gonna fire, I think, 5 of these. I feel I might as well get some good exposure in that regard. We've moved up to 11 a contract here, but yeah, 11 for 39. I'm gonna see if we can get a fill at this mid price here. I'll let that cook. Don't want to let it slip too much because the risk profile is why I'm feeling so confident in this trade in general. But let's see. What if I let myself go to I don't know, 37. How's that change things? Not too much. See if we can get that through. Okay, there we go. We get filled at 37. I will take that. If that's now what for.
You're scooped up a few there.
Math is hard. 14 of buying power for 37 in credit on each one of those. So much closer to pretty much a 3-to-1 risk profile. Yeah. But yeah, that feels too good to ignore. AT&T, really all these dividend stocks, they're often not great trading vehicles, but when they get beaten down, all the income buyers out there come right through to scoop them up. It's hard to stay down for too long when you have a dividend as good as the one that AT&T is paying. So yeah,
can't keep a good man down. No.
Yeah, so I'm jumping in on this one. That's just too good of a risk profile. But like I said, I understand why the risk profile is the way it is, because I am being very aggressive here. This is showing nothing but bearish action, and I'm going to get long into that on a very tight time horizon. So high risk, high reward, but posting up 50 to get 200 when I only need a $1 move to the upside on a well-established company that's not going anywhere with a good dividend, that feels good enough to me. So I'll have that one posted in the follow feed after we get off air here. But would you look at that? I'm already up $2 a contract. We'll take it.
No, I love it. There we go. We're scalping a little bit of AT&T there, Gus. I see you.
Yeah.
You're not slick, scalping some AT&T.
Yeah. Get involved here a little bit. Yeah. I mean, competition is definitely increasing on them, but I don't know. I just saw one of the Lions defensive backs was saying that he switched to Verizon because he had a bad experience at T-Mobile over the weekend. I saw that was making headlines in the NFL space because we are that deep
wasn't
into
like
the
a plug?
offseason.
It wasn't like a sponsored plug?
It wasn't a sponsored plug. He
organic?
He basically said that he was disrespected at the T-Mobile location, and they wouldn't even. He was just going in to like upgrade his phone, and they wouldn't even look up his account. Like they didn't believe, and then he asked for his ID, and then they tested it like he was going to hand him a fake ID. And so no, he was very much just saying F T-Mobile. I'm going to Verizon, but the Verizon part seemed kind of secondary. So obviously AT&T not involved in that story, but hey. Any bearish news we can get for AT&T's competitors is fine.
AT&T's like, leave me out of this.
AT&T is like, we have no dog in this fight.
Yeah.
But so I'm content throwing that on. And let me throw out the Cope response as well. If I get a sign, I just have a good dividend. There you go. That's how you cope with these sorts of things right there.
There you go. You got to.
So yeah, we'll hold the bag on AT&T. Hope that this is the real run for Rivian. And yeah, other than that, just going to be keeping an eye on everything, keeping an eye on SpaceX and this charter situation. Rocket Lab also moving up today on the acquisition of Iridium. So all kinds of exciting things happening in the space landscape and beyond right now. But that is going to be about all the time that we have for today. You have any closing remarks for the people, Errol?
No, we'll be trading a little bit more NASDAQ this week. Start getting back into that. 6 losses, 3 green trades so far. We're green on the P&L. We're going to just really
the green ones
have
are
risk
bigger.
management top of mind. There we go. That's
the name of the game.
No, we'll stay disciplined to risk management this week. Really keep that top of mind, especially with all the volatility that we could see. Shorter week, maybe the volume is going to be a little bit lacking on Thursday. I don't know. I'll be cautious of that. But other than that, that's going to be it from me, and we'll see what we get the rest of the week. Appreciate you guys taking the time.
Yeah, thanks everybody for taking the time to watch. Errol, thank you for going over to the CBOE and joining us from the adventurous and raucous floor over there. We are going to take a little break here, but we will be back with live programming starting at 1:30 p.m. Central Standard Time from theory to practice with Dr. Jim. Be sure to come hang out. Be sure to like and subscribe to the Tastylive YouTube channel so you don't miss all the great stuff we have coming up next. Thanks for watching. See you guys next time.
Peace.
Jim Schultz here for Calculated Risk, and don't forget, before we get started, the best ways you can help us are by liking the video or subscribing to the channel. Either one of those guys would really help us out a ton. So how do you trade a runaway bull market? If you're watching this video when it was released in June of 2026, it's like, man, this is the market that we are in right now. Sure, we've had a couple of blips and a couple of downdrafts and what have you, but man, it has been incredibly strong to the upside. Well, the truth is, our biggest risk as a premium seller is going to be the outlier move that gets away from us, whether it be to the upside or the downside. So whether you're trading a runaway bull market or a runaway bear market, everything we're going to talk about today for the next 2 or 3 or 27 minutes applies to both of those guys. So let's dive right in. Let's go through 3 things that you can do to help protect yourself against a runaway bull market or a runaway bear market. All right, so day to day, I'm going to say, you may or may not agree with me, the markets are pretty random and pretty unpredictable. And when you start thinking about asset pricing, you start thinking about what's controlling asset price moves. I mean, you've got geometric Brownian motion, you've got the efficient markets hypothesis, you got positive drift, you got your volatility shocks, you got all these different mathematical models that are kind of pointing to, all right, there's a high degree of randomness and unpredictability. So a lot of the time, the market's just kind of wiggling, it's just kind of waggling, it's just kind of moving around a little bit on either side, and that really helps us as premium sellers. And even if volatility ticks up, which is what we want because it makes the premiums on the options that much richer, still, it's very rare that we get caught in a runaway move that just has no signs of slowing down. But that does happen. You get that one-sided move where it's just wiggling and no waggling, or it's just zigging and no zaggling. And so what do you do in that scenario? Here are 3 things that you can do before you ever put the trade on. The first thing is your position size. The second thing is your capital allocation. And the third thing is going to be your strategy selection. Because remember, what price does day to day, it's out of our control. So we need to focus on what we can control. We need to control the controllable. And in my opinion, position size, capital allocation, and strategy selection are all within our control. And all of these things happen before the trade is even live. So number 1, first and foremost, is going to be position size. Right? Everybody wants to talk about, Jim, how do I hedge against a big move against me? How do I hedge against a big drop or a big pop or whatever? And my answer is always the same. It has to begin with position size. This is the most kind of organic way that you can hedge against things that move against you, by controlling that position size on order entry. You want to be small enough such that it frees you up to do whatever you want to do later on. Like if you want to later on and add on additional hedges, you can do that. If you just want to kind of lean into the position size and let the position kind of, meander off into the distance, you can do that too. But if you are too big on entry, it really just kind of handcuffs you in terms of the different things that are available to you and at your disposal. So position sizing is number 1. Because remember, we're out of the money premium sellers, right? We're selling 30 delta, we're selling 40 delta, whatever. But once that position spills over to now where it's in the money, now the deltas begin to grow. So now they're not 40, they're 50. Now they're not 50, they're 60, right? You've got a naked position on, those deltas are starting to grow. So what was a very small, kind of innocent position at 25 or 35 deltas is now all of a sudden 75 deltas, and it's going to feel a lot bigger than it was at order entry. And so if you don't size on entry so that you're okay when the position does go in the money, I think you're doing yourself a huge disservice, and it is going to show up at times when you probably really don't want it to show up. So that's why when it comes to position size, generally speaking, define risk 1 to 3%. That's a great reference point. 1 to 3% if you have a larger account. So let's say you're at 100,000 or more, you could probably even be below the lower end of that range. If you have a smaller account, so let's say maybe 10 or 12,000 or less, then you might be actually above the upper end of that range. You may have to go to 4% or 5% or 6%. But 1 to 3% for defined risk is a great reference point. For undefined risk, 3 to 7% in terms of your buying power allocation. Again, you have more capital, you can probably be below the lower end of that range. You have less capital, you may have to kind of creep up to maybe 8% or 9% or 10%. I probably wouldn't go above 10% because, again, you want to be small enough on entry such that you can go ahead and manage the position objectively and do all the things that you want to do and think with a level-headed, mind all throughout the process and not get emotionally charged up. So the second thing, capital allocation. Right now, ceteris paribus, which is all things being equal for all my Latin groupies that might be watching the show here today, but you guys already knew that. Capital allocation, when it comes to how much capital we're using, obviously we're going to prefer less capital relative to more capital. We would love to get where we're trying to go using less capital rather than more capital. I mean, that goes without saying. That's a given. But there are times when we might have to deploy a bit more capital to get where we're trying to go. So we might need to tick up when it comes to capital allocation. Just be careful that if you're concerned about guarding against a big move against you, whether it's to the upside or the downside, both would apply. You're always going to be better off if you have less capital deployed. And so that's why, generally speaking, we like to live somewhere between 25 to 50% most of the time. There are certainly times and places where you'll be, above the upper end of that range, and maybe even times and places when you'll be below the lower end of that range. But if you are really concerned and you want to guard against and protect against a runaway bull market or bear market for that matter, I would live on the lower end of that range, maybe be around 25 to 35%. And then thirdly, the strategies that you select. So obviously, if you go define risk, if you go vertical spreads and iron condors and diagonals and butterflies, they're going to have built-in mechanisms into the actual strategies that are going to protect you against runaway moves against you. They have kind of outlier risk mitigation built into the structure of the strategy because they are defined risk by nature. So that's going to be the easiest way to protect against the outlier moves against you. You have the gimme of the protection against that runaway move, but of course, we know it's been said before, and I don't know who said it, but let me know. If you know who said it, put it in the comments below this video, because it is a catchy jingle. For every gimme, there's a gotcha. So what's the gotcha? Well, one of the gotchas with defined risk, in fact, I can actually think of two. Number one, you don't have the unfiltered exposure to the Greeks. So you're not going to get, the pure positive theta. You're not going to get the pure negative vega. So that's going to kind of slow down what you're trying to do in terms of your Greek exposure. But then number two, they're going to be much harder to adjust. These strategies are much more difficult to adjust if things do go against you and you kind of want to maneuver a little bit. You kind of want to manage your way out of these guys a little bit. Much harder to do with a vertical spread or iron condor or even a butterfly when it comes to the adjustments relative to undefined risk strategies. But if you do want to do an undefined risk strategy, a great strategy, which is my favorite strategy, is the out of the money short put. Right? Again, specifically if we're in a runaway bull market, a lot of times you're like, man, I kind of want to participate in this. Like, man, I want to be a part of this. Like, I want to take advantage of this super strong market, but I don't really want to buy the tippity top. Like, I don't really want to be the guy that buys the NASDAQ at 31.3 and that's the top tick for the next 7 or 8 years or, 7 or 8 months or 7 or 8 weeks or 7 or 8 days or whatever. And so one of the strategies that you can deploy in this type of market is by selling an out of the money put. It is a naked strategy. You do have undefined risk, but if you're in a scenario where you're like, man, I'd be happy taking the stock or taking the index at that level, then you just collect the premium in the event that the market goes nowhere or it even goes higher. And if you are in a scenario where the option does go in the money and you are going to be assigned at that price, you're still better off than if you had bought the stock at that tippity top price point. So as an active trader, right, we can control a lot of parts of the process, but there are certain things that we can't control. We can't control the price. We don't know what's going to happen. Nobody knows what's going to happen next. But we can control our position size, and we can control our capital allocation, and we can control our strategy selection. And so put those things in place, let the math take over, and give the probabilities a chance to play out. And I'll see you guys next time. Jim Schultz here for Calculated Risk, and don't forget, before we get started, the best ways you can help us are by liking the video or subscribing to the channel. Both of those things really help us out a lot. So one of the things that you guys see us do all the time on the network is rolling our positions. I mean, we're rolling up, we're rolling down, we're rolling out, we're rolling in. This is a very common tactic that we like to deploy to maneuver around the management of our positions. Rolling. And so today I wanted to take a few minutes and let's unpack what it is, why we do it, and kind of some of the inner workings behind a rolling strategy. Okay, so let's start simple. What is a roll? It's actually very straightforward. All you're doing is you're closing your current position, you're picking it up, you're moving it out to a later cycle, and you're reestablishing oftentimes the exact same position or maybe something that is slightly different. So all you're doing is picking it up, moving it out, and dropping it back down. That is a roll. Now, sometimes when we roll a position, we may do it inside the same expiration cycle. So like with the strangle that we're going to talk about here in a couple of minutes, we may not necessarily be moving it out to a later expiration cycle. But most of the time, when you hear us use the term roll, we are referring to moving it out in time and adding days to expiration to the trade. But understand, there are times too where we do roll within a given expiration cycle. All we're doing is we're changing the dynamics of the strategy slightly to kind of maintain the same spirit, but adjust it so that the risk parameters are a little bit more to our liking. But when it comes to rolling out in time specifically, this can be really advantageous to us because, again, remember, what are we doing? Right? What are we doing on the Tasty Network? We're trying to manage our winners. We're trying to engage with high probability trades. So when the market gives us something that works out, we want to close that. We want to close it. We want to be done with it. We want to make sure it's economically significant, of course, but we don't want to stay in the trade too long. But by rolling out in time and giving trades extended duration, we are able to kind of give those losers a chance to come back to us, which doesn't mean it's always going to work. It doesn't mean that every losing trade is going to come back to you, but it does give the losing trades, the ones that don't work, a little bit more time to work out. We just want to tap into the natural ebb and flow of the marketplace. We just want to tap into kind of the natural back and forth nature of the market, which doesn't mean that every red trade is going to turn green. It doesn't mean that every losing trade is going to be a scratch, but it does mean that when things don't work out, we have some things that we can do. Like we have some tactics, we have some adjustment protocols, we have some mechanics that we can turn to kind of give the trade a little bit more life and give the trade a little bit more time. That is what a roll is, just in a nutshell, if we zoom out and kind of look at it kind of broad-based. Okay, so now when do we roll? Well, there are two basic times when we would consider rolling. There may be other times, and there's a little bit more subtlety and nuance when it comes to actually, when we roll. But the two main pillars are going to be when the strike is hit and when we hit 21 days to go. Now, both of these more readily apply to undefined risk rather than defined risk. Defined risk is a special thing, and we'll come back to that in just a couple minutes. But let's talk about when the strike is hit with an undefined risk position. So we sell a put or we sell a strangle, it doesn't matter. These are two great examples. When you put on this strategy, these strikes are out of the money. When you put on this strategy, like the strategy is working, everything is easy, everything is great, the sun is shining, the air is fresher, like everything is absolutely amazing. Well, now all of a sudden, the strike gets hit. Once the strike gets hit, now that out of the moneyness on the trade is gone. Now that out of the moneyness, that buffer that you had has now been evaporated. Which that means that now the strike is getting close to, the strategy is getting close to being in the money. So now we're in a situation where, we've chewed through our buffer, we don't have any wiggle room left, and the strike might be in the money, which isn't necessarily a death sentence. It doesn't necessarily mean this is going to be a losing trade, but it does begin to change the risk parameters of the position rather significantly. Case in point, your directional bias is now going to start to grow. Right? Because at the money options have a delta of 50. And so when the deltas or when the strikes are out of the money, their deltas are below 50. They're 30, they're 25, they're 35, whatever. And so it's not going to feel like that big of a position as it moves around. But once it goes in the money and it spills over that at the money strike, now the deltas grow to 55, to 65, to 75. So now the direction of moves are going to be a lot more significant. And so that's why if we take a strategy like a short strangle, when one side gets hit, the first thing we like to do is actually roll that untested side, roll the other side in a little bit to help to protect the side that is being tested, protect the side that is being threatened. So for example, if I have a short strangle on and the market goes down and my short put is my tested strike, I'm going to be looking to roll my call down and maybe trim my directional bias by about 30 to 50%, because what that does is it protects that tested side. If the market keeps going lower and if the market keeps pushing through that short put strike and goes deeper and deeper in the money on the put side, I have more protection because I brought in more premium by rolling that call down. Similarly, let's say a short strangle, now the market runs up. So now my short call is the tested strike. Now I'm going to be looking to roll my put up. So same basic idea, I'm just on the other side of the ledger, if you will. And so now I'm rolling the put up to protect that call strike. I want to protect against the runaway move higher. I want to protect against, the market running up through that short call strike and it going deeper and deeper in the money on the call side. And so maybe I roll the put up and trim my directional bias by 30 to 50%. What I'm doing is I'm bringing in more credit. I'm controlling my directional bias on that tested side, and I'm actually improving my break-even point on the tested side. And then even with the strategy as simple as something like a short put, now I only have one leg, so I'm not going to be rolling the untested side because there is no untested side. There's only one single side. And if that side gets tested, it is both the tested side and the untested side at the same time. And so what I might do is if that strike is tested, maybe now I just roll out in time. Maybe now I use my rolling mechanics, my rolling tactic to just add duration to the trade. That's going to slow down my Greeks. That's going to improve my break-even point. And it's just going to give me more time and extended duration in the trade. And so when it comes to a short put where the strike is tested, rolling out is typically going to be the first line of defense. You can add a short call and trim the directional bias, but that's kind of a separate project for maybe another time because that's a little bit more involved. And so that sounds like it could be theoretically, hypothetically, a future calculated risk. So you've got to stay tuned for that guy. But also, when it comes to a short strangle or a short put, or really any undefined risk strategy, once we get to 21 days to go, we also are going to be looking to roll out in time. And the reason for this is pretty simple. Once you get within the last couple of weeks before expiration, so anywhere between 14 and 21 is probably a fine time to roll. The gamma on the position is naturally going to be increasing. the gamma on the position is naturally going to be on the rise. Now, gamma is a second derivative of the Black-Scholes model. It's showing you how delta changes when the stock price changes. So it's kind of an added layer of directional risk and directional bias. And so by controlling that, by adjusting and rolling our positions prior to getting too close to expiration, we're kind of naturally putting a lid on just how much damage gamma can do to us. And so this is a no-brainer. If you're at 14 to 21 days to go and you're not where you want to be on the position, just roll it out. Don't think about it. Just go to the next monthly expiration cycle, pick up your premium, improve your break-even point, and slow down those Greeks, specifically gamma. The key thing we want to remember when it comes to rolling, 99 times out of 100, 98 times out of 100, we want to be rolling for a credit. Because when we roll for a net credit, we improve our basis. We widen our break-even points. Now, this doesn't mean that you can't ever roll for a debit, but you just have to understand what you're signing up for. You just have to understand that when you do roll for a debit, you are worsening your basis. When you do roll for a debit, you are potentially kind of shrinking or narrowing that break-even point, which is kind of working against what you want as a high probability kind of premium selling active trader. So just understand, when you pay a debit to roll, it's not exactly in line with what we're trying to do. Now, again, you pay 2 cents, you pay 4 cents debit to roll. That's not a big deal. I'm kind of talking about the more significant debits, but I think as a rule, rolling for a credit is a really, really great reference point. Now, this is really easy to do with undefined risk, because when you roll out into the future, you're capturing a more extrinsic value, so you're pretty much always going to be able to roll for a credit. But with defined risk, so vertical spreads, iron condors, you can't always roll for a credit. And the times when you do want to roll, when the trade is in the money or it's underwater, it's not going to be a credit to roll. It's going to be a debit to roll. That additional time is going to cost you something. And so when it comes to defined risk, a lot of times you just have to control your size on entry and be ready to hold that thing to the very end if that's what it comes to. Don't expect to be able to adjust. Don't expect to be able to roll out for a credit. If you get to 21 days to go and you can do it, then that's fine. But chances are you're not going to be able to do it. So when you trade something like a vertical, like an iron condor, something defined risk like a butterfly, just be ready to hold that thing all the way to the end and don't expect to be able to roll for a credit. If you can, that's great, but I would not bank on it. So rolling is not a magic wand. It's not a get out of jail free card. It's not going to turn every loser back into a winner, and it's not going to give you a 100% hit rate. But it is a nice tool to have in the toolbox to allow us to lean into the probabilities, to allow us to soften the Greek exposure, to allow us to widen out our break-even points, to allow us to improve our basis and kind of slow down that gamma risk that is notoriously on the rise as we get closer to expiration. So again, it's just a tool in the toolbox, and this is why we roll, and this is when we roll. I hope that makes sense, and I'll see you guys in the next video.
What's up, everyone? Mike here from Tastylive, and we're coming at you with another episode of Options in Action. If you've missed this series, it's basically a new series where I take an old whiteboard concept or maybe a strategy that I talked about previously and bring it into an advanced light. We take a look at the platform and we talk through the practical application of some of these concepts. We're going to go through the entire YouTube playlist, the old whiteboard series. So we have talked about call options, put options. We've talked about premium. We've talked about strike prices and expirations, you name it. And today we're talking about the age-old question. Can you make more money trading short premium, or can you make more money trading long premium? And what are the gimmies and gotchas, as Dr. Jim says? What are the trade-offs with selling premium versus buying premium? We're going to take a look today, and we'll break it down on this edition of Options in Action. So we got this SPX chart pulled up here, and this is not the SPX stock or index chart. It is actually a chart of a long call out in December, the 8,300 strike to be specific. You can see here SPX at the top is trading at 7,300. So we're looking at this call option 1,000 points out of the money to the upside. And this is the December cycle. So before we dive into this and before I start spewing nonsense, I just wanted to say, you know, when you're selling premium, there's a difference between selling premium in the S&P 500 products like SPX or MES or XSP or SPY. There's a big difference between selling premium in those sorts of products versus selling premium in the equity space, right? S&P 500 or other indices, even products like SMH that have moved quite aggressively with the tech sector popping off and selling off at the same time, there's things to consider, right? Short premium in the S&P 500, I've said this before, I think if you can trade successively short premium on both sides of a market in an equity, you can definitely do that in the S&P 500 simply because the S&P 500 moves less. It doesn't have the same binary events. It doesn't have the same binary nature of equities. You could have a CEO step down and the stock price be down 20% pre-market or after the market closes, or the opposite can happen. They can announce something that the market likes, and that stock is up or down 20% when the options market is closed. It's not necessarily going to happen in the S&P 500. There's also market stops. Even if there is a big crash in the S&P, there's certain levels where the market stops trading. That doesn't necessarily help you in the case of not taking on risk when it comes to short premium. If we're talking like short puts, for example, into a market move like this, or even strangles. But what I will say is over the years, I've learned that there's a time and place for all strategies, right? I have long premium strategies where I'm buying options. It's a lower probability trade if you're holding trades to expiration. But I like to say if you're buying options, you get what you pay for. I don't really buy options that are near term. I don't buy 0-day options. I don't buy 7-day options. In my mind, you're buying a lot of implied volatility in those cases, and it becomes just that much harder to be profitable on those strategies because you have this super decaying asset that is, if it moves against you directionally, it's basically going to become worthless, and it becomes that much harder for it to reverse and work in your favor. If you're buying a leap option, though, totally different story. Leap options cost a lot of money. You get what you pay for when it comes to long premium. But I think when you're buying premium, it doesn't necessarily have to be a naked option. It can be. I actually have a position on in Nike right now. I bought a leap option out at the 60 strike all the way out almost 600 days away, January of 2028. So this was a situation where, Nike drops to multi-year lows. We're talking decade lows. This Nike hasn't been 45, at least around this price point, since 2015, if I'm not mistaken. So the further a price falls, especially in a product like Nike, where I think we'll still see some upside potential there. Yes, I could sell a put to collect that premium. But at the same time, Nike's already fallen and it's still down at 40. If I sell a put 16 days away for $100, sure, I could sell that. It's a higher probability trade. You can see my probability of profit is nice and high at 66%. But I take on the undefined risk nature of Nike, where maybe they announce something, the stock's not down another 10 points, and now all of a sudden I have a $900 loss on my hands and not much management in terms of what I can do. It also takes a decent amount of buying power, $800 relative to a $40 stock. So for me, instead of selling a put, especially when a product like Nike or any other equity gets to multi-year lows or decade lows, I'd rather just inventory some long-term premium. And you can see here, the further out in time you go, because you're avoiding the implied volatility increase of something like an earnings announcement, something I mentioned earlier, you've got plenty of implied volatility here in the near-term cycles that isn't necessarily reflective of these long-term cycles, right? Look at this expected move for June 30th. You have a plus minus $4.60 implied move with a 60% IV almost, but you look at January of 2028 and it's only a 17-point implied move, and that's because the implied volatility is significantly lower when you get all the way out here on the curve. So will I be trading Nike? Will I be selling premium in Nike around the earnings announcement in a defined risk way? Absolutely. Like I said, there's a time and place for everything. I think for Nike with the upcoming earnings, I'll probably sell something in this 22-day cycle, but I'm going to buy something in July or August. I likely will go to something like a diagonal spread or calendar spread in that sense, because I still want to trade intelligently. I still want to reduce cost basis, which has always been something that we've said here on Tastylive. I want to make sure that I am reducing my cost basis and improving my probability of success anywhere I can. So in this case, if Nike's offering super high premium to sell something against even a long option I'm buying, whether it be a calendar spread or diagonal spread. We can look at this here, like the 45 strike in July, trading for $2.50, we'll call it. The 45 strike in July 2nd, look at that. You have 2 weeks of a difference in time, but only a 40-cent difference in the option prices. I'm absolutely going to be selling something against that long option that I buy if I'm bullish, and same thing if I'm bearish. But longer term, Nike's down to 10-year lows. So what does that mean? It means I'm going to get really far out on the curve here and risk $500. This option hasn't really moved all that much, which is interesting. Nike's still chopped around, and this 2-year leap basically is trading for $500. My whole thesis is, would I be surprised to see Nike go from 45 back up to 50 or 55 or 60? It was just there a couple months ago. So my answer is no, I would not be surprised. And if I'm buying a leap option that has much lower implied volatility, I know, yes, it's a little bit more costly, but I'm out of the IV spike in the near term. I'm inventorying long-term delta, inventorying premium that isn't going to decay against me all that much. And if we get a move in Nike from 45 to 50 or 55 or 60, that option is going to be worth $1,000, $1,500. And we can see this here. If I right click on the option in the chart, the 60 strike, if you right click on the bid or ask, you can have this menu pop up here. View the option in the chart, and here we go. It's been trading for $500 basically ever since I bought it. But back here, when Nike was at 55 and 60, this option was trading for $1,500. So from a risk reward standpoint, as a product like Nike or any other equity gets to decade lows or multi-year lows, I'm going to be inclined to lean into the long-term positioning. I did the same thing in Microsoft, right? Microsoft went from 550 down to sub 400 levels. What did I do? I was buying into some near-term stuff. We set up some short premium trades, of course, but I also did a really long-term calendar spread at the 500 strike. I bought January of 2027 and sold September of this year, and that was like a $500 trade. I was just like, well, I don't know what's going to happen in the near term, but I do feel like over the course of the year, Microsoft's going to be higher than where it is now. And that ended up being the case. We saw a nice bid, got all the way up to 460. And just looking at the order chains here, you can see I've had some decent trades up until that point. And the only trade I have left is that calendar spread in Microsoft. And it's up a couple $100 right now. If we look at the 500 strike, I bought it for $500. It's up $400 right now. So I still want to have it on. I think there's a bullish case for it. But to answer the question, selling premium versus long premium, I think when you're selling premium, you have to be able to withstand all variance within that product you're selling, right? Because from my perspective, the most success that I've had in products where I've sold premium, it's been in products where I've traded small enough or the product size was small enough to where I could manipulate the strikes, manipulate my time and expiration, or a combination of both, right? That's the beauty of undefined risk. You have the flexibility to be like, you know what? I'm done with this strike. I'm done with this expiration. I'm going to buy this back and I'm going to move it out a month. I'm going to move it out 2 months and move my strike and collect a credit still. So that is how I approach undefined risk these days. It's going to be a much higher probability of success naturally, because when you're selling premium versus buying premium, if you sell an option, you just need the stock price to stay out of the money, or in this case, above your 37.5 put. If you're buying premium, you need a directional move in the stock price, and that's as simple as that. So when you think about that, if I'm selling premium and I just need my strike to be out of the money, I'm going to be much more inclined to sell near-term premium because I know that implied volatility is higher. There's not enough time, or there's not as much time for the product to move against me in a big way. It can still happen, of course, but that 30 to 60-day window is where the implied volatility is nice and high relative to a nice blend of time value as well. So that's why we are selling premium in that window. We have research that shows that that's kind of the sweet spot of implied volatility value plus time value. So selling premium in that 30 to 60-day window. Buying premium, I prefer to be outside of that 60-day window. Honestly, I would rather buy premium in a 90-day, 100-day option cycle if it's something I can afford. In the case of Nike, I can do that in a 25K, 30K account, of course. Even smaller, you have the ability to do it because the stock price is so low. But in something like SPX, $7,300 stock price. I don't have the ability to sell premium in here. I can trade spreads in here. I can do calendar spreads, some diagonal spreads in here, but sometimes the stock price is the determining factor of your strategy. So keep all this in mind and just really make sure if you're selling premium, you need to be able to withstand the variance of any kind of move. I prefer to, if I'm selling a put or a strangle, let's talk about puts. If I'm selling a put, I would rather sell it in a product where I can just hold that premium or take the shares. I would rather not exit at 2 or 3 times the loss of that short put, because if I'm selling an undefined risk put, I kind of want to have that bullish delta anyways if it does get down there. I don't want to be stopping myself out and then 2 weeks later see that it could have moved out of the money. So that's just me. But to summarize, if you're buying options, you get what you pay for. I think in this kind of market environment, I'm always going to have something against it. Like if I'm buying a 60-day option, I want to be selling something in the 30-day cycle or maybe the weekly cycle against it. If there's an earnings announcement where that premium is really juicy and I can reduce the cost basis on my long option, because the more you can reduce the cost basis on your long option, the more flexibility you have going forward to have that long option be profitable or even a scratch. If I'm selling premium, I'm very cognizant of the fact that it is a higher probability trade. You're going to have a lot of winners when you're selling premium, but you should also understand how to manipulate that trade. With defined risk debit trades, when you're buying premium, there's not a lot of things you can do. There are certain things like with calendar spreads and diagonal spreads where you can manipulate that short option by moving the strike or moving it out in time. But with short premium, undefined risk short premium specifically, you can do a lot of different things. You have a ton of flexibility in the ability to manipulate strikes. And if you look at my order chains for the MES position, this is my year-long strategy for 2026. I've clearly manipulated this position over and over and over. And every single time I do it, I collect more credit. I started with 93 points in credit. I now have 700 points in credit overall, which means my break-evens are 700 points beyond my strikes. And this is a profitable trade because I've been selling premium to offset any kind of intrinsic value losses that might show against me. So short premium, I like to reserve it for either products that I can afford any variance in, or something in like an index, like MES is a great example, or IBIT even, the Bitcoin ETF. That was my year-long trade from last year. So I think when you compartmentalize these things, it puts you in a good spot to be able to withstand variance. And again, if you have a day like today and you're like, my account is really suffering, then I think your trade size might be off. I think maybe the strategic decisions might be a little bit off. Again, we want to be able to withstand as much variance as possible. With undefined risk, I think it's got to be any variance. The trade size has to be small enough to where you can withstand any variance. It just sets you up for success in the future, and it gives you that flexibility to manipulate the trade as the markets move. And with defined risk, same story. I like to keep them within $500 to $1,000. I think that's a healthy level for me. But again, if I'm doing a diagonal spread or calendar spread, I have a plan for if things go wrong. I know I can move that short strike out in time. I know I can move that short strike up or down depending on the strategy. But yeah, let me know what you think in the comments below. That was a long-winded segment. Wasn't expecting to go that long, but hopefully that kind of mental shift helps a little bit. Again, if I'm selling undefined risk premium, it's usually in an index product or a micro futures product, and it's sector based. It's not something that's going to move 20% pre or post market. But if I am involving myself in those types of products, it's going to be in a product size that is small enough to where I can withstand any variance. I can manipulate the strikes up and down. And I think that's another interesting and important point is undefined risk trading, super high probability if you're doing out of the money sales of options, but understand what you can do to manipulate that risk profile. And that's just going to give you another leg up in the future of trading as the markets move and things go wrong for you. I mean, you're going to have your winners, you're going to have your losers, but you got to know how to manipulate and adjust those losers if they are undefined risk trades. But thanks for tuning in. Let me know what you think in the comments below. Please like this video, subscribe to the Tastylive channel, and we'll see you on the next episode of Options in Action. What's up, everyone? Mike here from Tastylive with another episode of Options in Action. If you've missed the previous episodes, this is a series where I'm talking about old whiteboard videos where we're looking at concepts and strategies, but we're giving it more of an advanced twang, and we're looking at the platform itself, talking about certain concepts that I'm using today and how it applies to everyday trading. We talked about expirations last time, and today I wanted to talk about letting an option expire in the money and ultimately taking shares of stock. Also, we can talk about expiration risk and assignment risk and how it's not something that I'm worried about at all. I think we can wrap those up into one and kind of just give you a nice package of ways to think about expiration and why not to be afraid of assignment risk, especially if you have defined risk spreads or an in-the-money short put or in-the-money short call, something like that. So let's dive into the Tastytrade platform and we'll break it down for you. So we're looking at SPY right now. As you can see, SPY has had a massive rally from the lows of this year. In April, we were all the way down at 635-ish. Now we're sitting at 755. Just an insane run to the upside. And maybe that has resulted in the money options. So for those that don't know yet, if you have an in-the-money option, it's ultimately going to expire and turn into shares of stock. So if I have a 760 put, for example, that is in the money, I will ultimately be assigned 100 shares of SPY at 760. Same thing with the opposite side. If I have an in-the-money call, a short option that's in the money, and it is assigned or it expires in the money, I will be basically have 100 short shares of stock at 750. Now, a lot of times we're not really dealing with assignment risk because we're rolling our options positions out in time. And really, assignment risk is highest when you don't have a lot of extrinsic value in your option strike. So even with a 750 call that's in the money, 15 days to go, there's still $600 of extrinsic value that somebody would be giving up to exercise this option and turn it into shares of stock. In other words, they're taking $600 and lighting it on fire. That's why I don't really worry about assignment risk, because it just doesn't happen all too often. I've been trading for over 10 years and I've been assigned maybe 3 times, 4 times maybe. And one of them was a celebration. In this case, it was literally like I had an in-the-money option that had $200 or so of extrinsic value, and I woke up the next day, I was assigned on it, I got the shares and kept that money, the extrinsic value. I closed the shares and I just resold the option, and I basically doubled my credit overnight. So that's another thing. If you are assigned early and there's plenty of extrinsic value associated with your option still, it can actually be a benefit to your position. The only situation where that would not be the case is if you had a dividend that you had to pay. So like with an in-the-money call at 730, for example, let's say SPY had a dividend of $400, there's $288 of extrinsic value here. The counterparty would give up their $280 of extrinsic value to get the $400 dividend. So in that case, it's a net positive for that counterparty. And that is the circumstance where you can get assigned early. Your options can be converted to stock early if there's a dividend where the dividend exceeds the extrinsic value left in the option. But other than that, like you can look at these options here, like this is a 715, 720 option. It's 35 points in the money and it still has $200 of extrinsic value. This is still an option that has a low assignment risk here. So not really worried about options that turn into shares of stock. What I do want to bring up is how it can actually change your risk profile for the better in a lot of cases. So yes, if you have a spread, so like let's say you've got a 755, 750 put spread, right? You're kind of teetering on this short option here. This is a defined risk trade. However, if SPY drops significantly and over time someone exercises this short put, you're still left with the long put here that protects your risk, right? Because a short put converts into 100 shares of stock. A long put represents 100 short shares of stock beyond the strike to the downside. So even if I have a short put spread and I'm assigned 100 shares of stock in SPY, If I can hold that buying power, that's the big caveat. If I can hold that buying power, that would certainly be increased relative to this $300 buying power here for this narrow spread. It actually increases my max profit substantially, potential max profit substantially. And that's because the most I can make from this spread is just the credit I received on entry. However, if SPY drops like a rock and I'm assigned on this short put and I still have this long put, as long as I have the long put, my risk profile doesn't change on that package. But I would now have 100 shares of SPY with a static delta of 100, which means if the market dropped dramatically and I get assigned on the short put, I still have the protective long here. If the market rebounds and now all of a sudden we're back at 755 and beyond, I'm making money on those 100 shares of stock where I wouldn't have been making that money on the shares, because with just this options trade, I can only make the credit received. So another situation where that makes a lot of sense is just like take the shares and just use the shares as a static delta lever is in products that are smaller priced, and maybe you've sold a put and you're trying to roll the put forward. Under Armour stands out to me because I already have 100 shares of Under Armour for this exact reason. But let's say you sold a put and these options expirations, there's not too many here, but let's just say you sold the 7.5 put or like the 10 put. You can see there's very little extrinsic value here. The deltas are super high. And if you were assigned 100 shares of stock in Under Armour, yes, you can only make the amount of the put if you sell this put. And I think that's the big key here. If you're assigned 100 shares, you now have unlimited upside potential on how much you can make if the market does recover to the upside. So the deeper in the money a short put goes, the closer it gets to 100 delta, the less extrinsic value you're going to have. So if you're thinking of rolling a deep in the money put and you're trying to roll it, let's say from July to August or something like that, and you're not picking up a lot of credit, but you have a really high delta on your short put, it actually might make sense to consider taking the shares of stock where you no longer have a option that you can only make as much as the option's worth. You would have 100 shares of stock where you can make a lot more to the upside. So that's pretty much it when it comes to options that expire in the money. I mean, again, I don't really hold things to expiration to risk that. That is one of the things that we should talk about, though. Like if you have a spread that's teetering in the money and out of the money, if you let the spread expire and you're assigned on the short put and your long put goes away, now you don't have the same risk profile. You still have the 100 shares that you're assigned on the 755, but you would no longer have the protective put down here. So something to consider, but deep in the money options that have no extrinsic value, if you take the shares instead, you have a higher max profit going forward, and you have the same risk profile as you did with the deep in the money short put or deep in the money short call. But you now have the static delta in the shares, where a short option that's deep in the money, if it starts to rise towards the at the money price, you can only make the amount of the option itself. So again, deep in the money options, close to 100 delta with no extrinsic value. In almost all cases, your max profit is higher if you just convert the shares, if you're willing to do that. If not, you'd have to manipulate the strategy and change the risk on it by rolling out in time and moving it if you can. But those options that are super far in the money are trading like stock basically anyways. So let me know what you think in the comments below. Please like this video, subscribe to the Tastylive channel if you haven't already. But yeah, let me know if you've ever been affected by a short option that had a couple $100s of extrinsic left, not a dividend stock, but like maybe someone made a mistake. Maybe the counterparty made a mistake. They converted to shares. You get to keep that premium. You sold out of it again. It's only happened to me once in 10 years. So hopefully that kind of stuff happens to you guys more often. But let me know what you think in the comments below, and we'll see you on the next episode of Options in Action. We do have a fun little research piece, though, hosted by our only, one and only, Julia. Julia, how you doing?
Hi, guys. How's it going?
Good. Your hair is shiny
know,
and
right?
wavy today.
Right.
What's going on?
I washed it yesterday, and now
That's
I'm
good.
wearing it. Yeah, it's a little wet still from last night, so the curls are coming out. We usually wear it in a bun, so.
Hell yeah. Love to
I've
see
never
it.
seen you in a bun.
You've never seen me in a bun? Really, dude?
No. Have I? Maybe I have. I don't know. I can't remember.
if I wear my hair down in the office when it's like full fro, it's going to get like caught and stuff. People are going to be running into it. It's going to be causing problems. So yeah, I'm more of a braid person. Actually, I've been more of a braid person these days.
Oh, so.
It's for safety. It's for office safety.
It's for safety.
for the
Workplace
people.
hazards. We're trying to reduce the OSHA inquiries.
Yeah. What do you got for us today?
Speaking of up and down and not sure where it's going, talking about SpaceX today, we're just kind of checking in on where it's at. With options coming out kind of recently and a lot of volume since it got options. A lot of people talking about it. We just wanted to check in on where it's at. Is the price any more or less stable? And where are the options in terms of liquidity? Because shocker, the options on SpaceX became liquid very, very, very quickly. I want to do a study on this at some point, but I feel like with a lot of these major IPOs, the options are becoming liquid faster and faster. And want to measure that at some point. So we're just doing a quick little check-in now that we're a little over a week, little over a couple weeks in.
Yeah. It's been super volatile. We've got a couple of positions on butterfly to the upside. I feel like it's too cheap. The 180, 160, 200. That was for like $3, 20 points wide. And then a Super Bowl sold the 125 put all the way out in Jan of 2028 to finance the entire cost and more of a upside call. Really, I just think this is going to behave like Bitcoin and volatility products, where if and when you get that big rip to the upside, you're going to see implied volatility expand. And I want to have that naked long call in that situation. So we'll see what happens.
Long term, wow.
Yeah, you like that? Long term.
Really long term. Whoa, that's crazy.
Yeah.
Man, you're in this for the long haul. I can't imagine being that committed to anything.
Really?
Well, let me ask you this, Julia.
Really?
If you had the opportunity to go to space, would you go to space?
Absolutely not.
Ooh, so you're in the...
Absolutely not. I hate space.
Okay, so I want you, and Jermal in my spaceship when we go. You three are going to be screaming. I'm going to be like, hell yeah, let's do this.
Like, we got a perfectly lovely planet. We got air. We got food. We got grass. We don't need to go. I'm cool with it. Interstellar. I should like that movie as a physicist.
And she did science. She knows.
I know. I studied actually a good amount of stars, cosmology, all that stuff. But space is just like Interstellar. I've never been so miserable during a movie in my entire life.
That's a good one. That's a good movie.
It's a shame too. They published 2 general relativity papers just from the simulations of the black hole that they used in that movie. So it is like I call it the most sci that Phi can get while still being interesting. And I still cannot watch that movie again. I'm okay.
Yeah, movie.
So y'all can go to space. Let me know how it goes.
I ain't going to space.
Maybe you'll get Titan submersible. I don't know.
I'm going to sell these puts in SpaceX, and that'll be my way of going to space. I want this thing to go to space. I am not going to space. But yeah, along the same lines of Mikey, I did. She does. Sorry, let me stop yapping.
Yeah, to talk about. No, we could just yap about SpaceX too if you want to, but I do have slides.
I didn't know you had slides. Let's look at your slides.
Let's do some slides. Yeah. Okay. Mission Control. This current state of SpaceX trading. This piece is by Sahil. You want to follow him over on X. We've been writing a lot more articles just between the couple of us on the research team. So give Sahil a follow if you'd like to read more about some of these pieces. But yeah, we're talking about the current state of SpaceX trading, if we can even really quantify the state with how crazy it's been. But we're going to try to. So let's go to the first slide. So options, very volatile. And we're seeing how quickly this momentum is fading. We're seeing it's up a little bit today. We actually saw it flip from the pre-market levels where it was at, but still down 25% in the last five days. So that came and went very fast and still a lot more to go. And what an interesting statistic, looking at the July 17th expiration options on SpaceX. We had 20,000 contracts-ish in open interest during the market close on June 17th, and now it's down to 6830. So just being careful with some of those options. We're seeing a lot of people closing their positions out just with the volatility. So Mikey, maybe with taking your very long-term approach could make sense with getting some exposure to this, but being less exposed to obviously some of these short-term movements as the market is trying to undergo price discovery and as we're seeing a lot of movement, although a little bit less today, which is actually quite interesting for me. Yeah,
I like it.
Next one.
Yeah, next one.
Cool. So this is I call this the Peloton curve, but usually it takes place over a longer period of time. So yeah, just the sheer run up and run down, and then a little bit of a continuation of that, although it's up a bit today, just over the past couple of trading days that we've had with this underlying. So really volatile IPO, and we're seeing also trading volumes dropping off consistently from where we were at. So we haven't had a lot of major IPOs in the last like 10 years. So there's not a ton of data to kind of point to say whether this is exaggerated or maybe like less, I don't know, exaggerated than it would typically be. But certainly like just from pure volume levels, especially relative to like the Mag7 and some other highly liquid underlyings, just really, a lot of interest in this in the option space and in the equity space, and then some of that tapering off. So we're seeing a little bit of cooling as the price is starting to come back down to earth a little bit. Although Jermal, I know you wanted to take right back off.
Yeah, of course.
Yeah, maybe that's the spirit.
I think we'll see some chop. I mean, it's just this is how it works. Like Meta had the same thing. Meta was a dog after an IPO, and now it's multiples higher. So we'll see. But yeah, expect implied volatility and realized volatility for sure.
Yep. And again, we're seeing where these like liquidity levels, kind of consistent with what we see just like across underlyings in general. But when we're looking at average volumes, we see, still a lot of activity like really early in the morning and then towards the close, with liquidity levels being a little bit drier towards the middle. This is generally what we see across the market. More broadly, where we get towards midday, that's when liquidity becomes a little bit thinner. So just in general, when it comes to trading these with something that still has so much volatility associated with it, even though it's becoming more liquid, just bearing in mind trading times throughout the day, especially for short-term trading, this is just something that's good to just note whenever putting positions on in underlyings like this. So just little that. And then this one found very interesting, little comparison on the next slide of just like how liquid is this compared to some other underlyings right now within the option space. So we basically looked at the 59-day options, the at-the-money puts across a couple different underlyings. And we can actually see like, even though this has only had options for like a couple of days now at this point, it's actually showing when we look at spread as a percentage of close, like similar tightness in the bid-ask spread as other names like Oracle, Coinbase, CRM, much more established options markets and other underlyings. So this thing got very liquid, pretty liquid very quickly, comparable to like some other major names that are very actively traded and potentially more to go. Again, as the price becomes more I should say the market becomes more confident of the price moving forward.
Yeah. This is similar to like IBIT too. IBIT was released, bid-ask spreads were somewhat wide, but we were like, this is going to be super liquid going forward. I think implied volatility is going to have a role too. The higher the implied volatility is, the slightly wider the bid-ask spreads will be, but I have no doubt that SpaceX will be one of the most liquid products going forward with the options market too.
It's too big not to be, for sure.
Yeah.
It's huge. Yeah. And just bearing in mind with liquidity, for anybody like considering getting into this, is that liquidity with options is a much more nuanced concept, because like further out of the money you get, for example, the less liquid time, like the time to expiration can change the liquidity level. So just really looking at like bid-ask spreads, looking at open interest, looking at volume for specific contracts can be really helpful, just to make sure that you can easily get in and out of the position. So obviously a lot of SpaceX options are liquid. That's what we're seeing right now, but option liquidity is a little bit more nuanced. So just checking those different, doing a little sanity check can sometimes help when considering getting into a position, especially further out of the money and especially like further out in time. But the takeaway is kind of what we've been talking about. We're seeing SpaceX really move all over the place. Big sell-off, big run-up, big sell-off, and now kind of like a little bit less movement today, but still like the very brief history that is very volatile. And we're seeing that kind of continue to move on. So what we're seeing as well is options are becoming more and more liquid on this now. Just using one contract as a reference point, we're seeing SpaceX options be as liquid as some other major names such as Coinbase. So we're seeing option liquidity make this more tradable, but that price volatility is certainly still there, especially when we're seeing large contract or large positions, large open interest positions getting closed out very quickly. It's just about being careful and being mindful of the price volatility and the positioning, especially in the short term, as this thing is becoming more, as the market is becoming more confident in the pricing and the true value, I guess you could say, of this.
As it matures.
Yeah.
As it matures.
Yeah, I think you'll see chop going forward. You'll have your up days, down days, up weeks, down weeks, but you've got like the inclusion into the NASDAQ. You've got lockout periods ending. So it's going to be some push and pull. So just keep your size in check, but still plenty of premium on either side of the market if you are selling it or creating calendar spreads, diagonal spreads, and whatnot. But appreciate it, Julia. Go get a pack of zebra stripe gum. I'm sure you can find it somewhere.
I can't wait.
It only lasts like a minute, and then it's flavorless. So that's why they give you 100 in the pack.
Of course. And you guys can go get some purple ketchup, which I'm sure the purple ketchup from like the early 2000s is still not expired.
That's just like breaking my brain to think of purple ketchup.
It's like the McDonald's fries that like they were found in like a 50-year bin and they were just ready to go. They just don't age. Yeah, like a fine wine, those McDonald's fries.
Yeah.
Appreciate you, Julia.
Nicely. Thank you, guys.
Absolutely. See you later.
Today we wanted to test trading the dip, contrarian backtesting. We don't always use price signals for short premium trading. More of the time we use volatility signals, but obviously for 0 days, right, you might use price signals more, depending on your style of trading as well. God put this piece together. So if you want to follow him on Twitter, he's Godlytics on X. Gotta stop saying that. But he put this piece together and had some very interesting results. So basically we're going to test like if the market is down some amount and you open up a trade, does that outperform or underperform just kind of trading every day? And we specifically wanted to test like kind of the contrarian assumption. And this is, I would say, a short-term contrarian. So market's down red 1 day between, 0 to 0.5%, 0.5 to 1%, 1 to 2%, or more than 2%, you go open a 30 delta, 15 delta put spread 45 days out. And then we're going to hold that to expiration just to kind of like, capture the tails. We're taking management out of it because people manage things so differently. We're going to say that if you, market's down and you decide to be a contrarian, put on a put spread, short put spread, does that tend to perform better or worse at these different dip thresholds, I guess you could say. Does that make sense?
Makes sense.
So that was funny timing. So we can go on to the next slide, kind of look at the results. And my guess is like you probably have some intuition on this already, just from short premium trading, a whole bunch. But what we can actually see is that when we're trading the put spreads, just like on any given day, these tend to kind of like average to be relatively profitable long term, which makes sense because we've had, especially over the last 20 something years, very strong bear market, especially the last 10. And then what we can see is that when you're kind of trading the noise, so markets down between 0 and 0.5%, which happens a lot, when you're kind of trading the noise, or trading a little bit more than noise, 0.5% to 1%, that actually tends to, if just trading that, underperform kind of trading every day. And we start to see more of an increase in profitability on average when we're trading now the 1 to 2% down days, or even higher, the 2% down days. And what we saw as well, when we looked at all these different thresholds, the pops were pretty much the same between 82 and 90%. Or 82 and 89%. So pop stayed about the same. So this increase in performance was not from the trades being profitable more often, as you guys already know, it's from increases in premium, increases in volatility, all that jazz. Yeah. Makes sense.
I think it's interesting that the down 0 to 0.5% underperforms. Like if you get rid of the bullish days where they just stay bullish, I think that is interesting when you consider it that way.
Yeah. Which I was a little bit surprised by that it actually underperformed just kind of like trading every day. So trading those very moderate down days, we're calling that kind of noise. And that's between like a 0 to 0.5% down, and then as well from 0.5 to 1% down. So broadening those horizons. And then if we go to the next slide, and now we're just looking at ROI. Oh, we can go to the CVAR slide too. This one's fine. So when we look at extreme risk instead, what this one was actually a very interesting result, because as the market becomes more volatile, as you have these big down days, right? Like you have more volatility, so your losses can be larger, but your premiums are also significantly larger, right? So what you actually saw when you looked at CVAR as a dollar value is that the dollar value of CVAR, your kind of extreme risk or your extreme losses, I should say, didn't actually increase. Which I found very interesting. And that again kind of goes to show you like when premiums increase, how much more compensation there is. And that tail risk, like once volatility is already, increased, kind of normalizes out regardless of where SPY kind of lands on the day. Does that make sense?
Yeah. And when I remember a piece many years ago, but it was about buying power risk. So like how often your loss exceeds your buying power requirement. And when you did it for equities, the percentage was significantly higher than when you did it for SPY or SPX, because these markets just don't move as much. So I think this speaks to that exactly.
Exactly. And now this is where the piece to me got very interesting to kind of look at it because we're kind of testing like this very short-term contrarian approach. Market's down 1%, 2%. Or more, right? And now you're, trading put spreads, you're taking a directional contrarian assumption. And so we're seeing this contrarian approach, right, giving you better results as the market's down more and more. Trading the put spreads give you richer and richer results. But that's not really from the directional assumption being more correct, as you guys might expect. It's not from the directional assumption being more correct when the market is down. If you look 45 days out after SPY is down 2% or more, the probability of a rebound, it's not any more performant, I guess, or any more likely compared to any given 45-day period in the S&P. So, right, we're not looking at markets down 10, 20, 30%. We're looking at very short-term movements in the S&P and trading those. What you kind of see is like it's more from the premium increasing and more from the volatility increasing rather than the directional assumption being more correct. And we know that the market just generally tends to drift upwards. So, like with this case, it kind of makes sense. But what I found interesting in this is that like just from your CVARs being relatively constant, just from your POPs being relatively the same and your premiums increasing, it's more from the volatility rather than the directional assumption being more correct when we're looking at these very short-term scales. Does that make sense?
Yeah.
Cool. So that was my fun little contrarian piece. So what we found kind of interesting, when you're trading kind of the noise, so markets down less than 1%, actually tends to underperform just kind of trading on any given day. Large dips tend to outperform. But this is primarily due to increases in volatility and premium prices rather than the contrarian directional assumption being directionally correct, noting that we're looking at very short-term price movements in the S&P. This is down 2% in a day, not 20% in a month, right? So when we're looking for higher than average performance, that sweet spot is really between like 1 and 2%. The S&P being down, just because those occurrences tend to happen a lot more often. And that tends to be a high enough move or a large enough move to the downside to drive volatility up enough to provide that extra compensation. So that tends to deliver the richer returns while also occurring often enough to be something that can be systematically implemented. So yeah.
Serendipitous day for that.
Serendipitous.
Quite really.
Serendipitous, was that a pun?
Serendip. It is.
I see what you did there. I see what you did there. Yeah. I didn't even mean to do that.
It.
Love it. Thank you so much, Julia. Appreciate you.
Thanks, guys.
There, of course.
That's going to become a question soon. That's going to become the question soon. What color tie does Gad have on?
Oh, it's a black. So. Yeah.
How you doing, man?
I'm good. I'm doing great. And nice to see you right now.
Good to see you, my friend.
Yeah.
Earlier this week you were with us and you were talking to us about the IPOs and SpaceX and kind of be careful. You get a little pop at the beginning, but maybe that's not how it works out for the average stock moving forward. Mm-hmm. What do you have for us today?
So today I'm going to come with another research study. So recently we received so many emails. And also yesterday, we went into comments of YouTube comments. Destinations were asking about IWM, small caps, and we're like, oh, this is a great topic to talk about right now. What's the difference between large caps and small caps? What traders need to know about these kind of two competitive caps, small caps and large caps? So let's dive into our study right now and see what traders need to know and how it can be actionable to traders. So, as everyone knows right now, IWM is kind of overpassing or like dominating the small caps. Right now, it's when you compare like last year to year. So right now it's 40%, and the SPY is only SP500 is 25%, which can bring so many traders to be interested in trading IWM and say, there's so many joys, there's so many opportunities of growing, there's so many volatility. So that's why this study is going to bring statistics behind this logic. Is it really happening? IWM or small caps is overtaking large cap in terms of like bring joys to the table for traders. So this graph shows like 1 year, 3 years, 5 years, 10 years, and since 2000s. And when you compare 1 year, you see SP500 large cap is already dominating. 5 years, 10 years dominating. But when you compare since 2000s, there is no like big difference between their returns, year-to-year returns, when you do the average, which is like interesting stats we saw as a research, and we can deep into after this. So the next slide. So for the last 13 years, we have seen like when you compare 5 lowering these kind of IWM minus SP 500, there's the positive one is like where the small cap outperforming the large cap. You will see since 2006 up to 2014. I mean, since 2000, early 2000, after .com recovery, IWM had like 8% annual edge over the SP 500 over the 5-year roaring, which is interesting. And right now, you will see here in 2014, went way back, and it's like rolling down, and everyone is like, what's going on? And right now, because we AI and this kind of crazy movement in the market, we kind of see like small caps is coming to the recovery. Right now is on like 3.8% recovery, which was there in 20 years ago. So, which is interesting stats to see, and how these small caps is heading in the future. So we're gonna see in following slides. So when you go to the next slides, you will see IWM price divided by the SPY price. This is a kind of ratio which shows the dominance, which one is dominating right now, and which one is like spreading the ratio, the strength of the ratio. So the rising, the small ratio, or the rising is like indicate like the small cap is outperforming the large cap, which means like if you have the higher ratio, that means the small cap is outperforming the like in terms of the price, outperforming the large caps. You will see this graph demonstrate perfectly since 2000s. The large cap dominates the small cap dominates the large caps until 2014, and it started going way down, where large caps just take it over and dominate that. It's interesting to see last year, April, during like the rate shocks, it's where we see the bounce back of the small caps. But we see why this bounce back happened last year. Most of the time is because the small caps, it's more sensitive to the market, like 48% sensitive to the rates, to the change of rates. But we see why it happens. Because like almost like 80% of the small caps, the component of small caps, 80% of it depend of internal US economy, while only 40% of the large caps is the only depend on the US economy change, and especially these rates. So we see in the stats on the following slides. So, but this is like a great understanding of how small caps and large caps really operate, and how they do help each other or interfere to each other in terms of ratios. Chris, what's your comment on this?
I'm thinking about IWM and small caps have had such a tough run of luck recently.
Mm-hmm.
I like to think of them as kind of like a sentiment gauge. I trade Russell from time to time, but I'm having just such a hard time trying to think of a world in which small caps outperform like the Mag7.
The Mag7. Yeah.
Right? Or the Mag10 or whatever we want to call it. But it's just because of what's in that, what's in the bucket of Russell 2000 stocks.
Mm-hmm. Yeah, I understand.
Anyway, keep going.
Yeah, I understand. Yeah. So this is like the slides. I'm sure like Chris will like it more because it's kind of like more micro. Why small caps dominate or respond more? Why? It's the same thing I said earlier. So it's like 70% of it, like it reflects to the banking system, these interest rates. So when there's rate cuts, reduce borrowing cost for the small caps. So this 70% of it consists of the small caps rather than 30% on the large caps. And as I said, small caps the component of small caps, 80% of it, it's US-based economy and also benefits directly from the US growth or stimulus, which is interesting rather than like 40% of the large caps. So regional banks, like almost like 70% of small caps, they are already priced in IWM because it's like the components of it. So if there's any change in the rates, it affects like vigorously the IWM small caps. Another factor is that 48% of the components of the IWM or these small caps, it's really sensitive to the market, to the bigger market, to the SP 500. I took an example like if SPY move like 2%, IWM can move closer to 3%, which is like more almost like 8%, which is like a significant number. If you're gonna trade any component to IWM or IWM as ITF, note this factor, like you will have like 40% or 8% of moves more than large caps. And also I put some kind of stats behind like these meetings, events, how it affects both SPY and IWM, just for you to understand deeply. So when you go to the next one, so we saw kind of like IWM dominates a little bit, and we saw like this downside, how the daily drawdowns really kind of works in IWM and these large caps. You will see like 58% of it has like the way max drawdowns ever. So when you compare to the large cap and small caps have a 59% drawdowns more than that. And also, as I said, it's 48% more sensitive to the market. So it's more dangerous when you don't understand this and you are trading these ETFs. You gotta understand how better to take risk and how to size your positions according to drawdowns, because any sell-off in the market, it's bigger than you think. So to the next slide. So this kind of other stats I put behind this logic, and forward P ratio is kind of like considered price when you divide by the next year earnings. This will take like 12 months. So the lower the cheaper the stock is, and I put the different kind of results on the next columns, where you see where the IWM is so cheap than SP 500 or SPY as an ETF, of course, but when you compare the risk, you can't compare because IWM is more riskier to trade in more than SP 500, and also the volatility in IWM is more people are interested in kind of like stocks or ITF, which kind of like bring volatility. So when you go to the takeaways, so this is a kind of a summary of everything I said. Right now, we kind of see like IWM kind of dominate the SP 500. I mean, small caps dominate large caps, but initially, when you go on average, large caps still dominates, which is a good thing to know, and the stats behind can show. So another thing I can conclude this study with, when IWM pays more premium than SP 500 or than large caps. So, but when you want to size it, try to size at 20 to 25%, because when you don't follow the sizing portions, because the risk in you follow the premium, you're gonna take like 48% risk more than you're gonna take into large caps. Yeah.
And that's a really important point, Jermal, right? You know, not everything is created equally. And so when you look at the volatility metrics, just got to be aware when you're doing one size in ES, it's a different level of risk than when you're doing it in RTY. And understanding that difference is important. That way you set your strikes at the appropriate levels.
Yeah. My takeaway, Gad, we're raising rates, so therefore I'm going to get short IWM and 2000. Thanks, Gad. Thanks for that. I appreciate that.
Yeah. That is also one of the takeaways there. Gad, thanks for joining us. I need to get on your Stitch Fix subscription. That way I can fix, because right now it's like all Viore, which is pretty nice. It's comfortable.
No, you look nice.
I need to get it.
Jim Schultz here for Calculated Risk. And don't forget, before we get started today, the best ways you can help us are liking the video or subscribing to the channel. Either one of those really helps us out a lot. Okay, so around here, you guys already know the drill. Like, you already know that we are premium sellers. You already know that we want to live on the short side of the option contract. We want to play time. We want to play volatility. We want to play probabilities. We want to do all those kinds of things. But time to time, every once in a while, we want to venture off onto the other side of the contract and maybe buy a little premium. Well, today, that's what I want to talk about. When does it make sense to maybe consider being on the long side of the option contract? Well, I can think of 3 specific scenarios, and I want to unpack those in detail right now. So again, by and large, we want to be on the short side of the contract, right? We want to play the higher probabilities. When you sell premium, especially out of the money premium, you're going to have probabilities of profit that are in excess of 50%. Could be 60, could be 70, could be 80, could be 97 for my 3 delta put sellers out there. I probably wouldn't do that myself, but you've got to blaze your own trail. We want to trade the high probabilities of the marketplace. Okay. We also like being out of the money because that gives us room to be wrong. That gives us a little bit of buffer and a little bit of wiggle room on the position when it comes to not needing to be right historically. And then lastly, we've got the implied volatility, overstating realized volatility on average over time. Doesn't happen every single time, of course, but that is what we're hanging our hats on. So when it comes to why we're on the short side of the contract, those are the main reasons why. But when does it make sense to be on the long side of the contract? Well, here's the first scenario. When the VIX is super low. Like, you've got a VIX at 11, 12, 13, 14. You're just not really getting paid to sell premium. You're just not really getting paid to be on that short side of the option contract. And so in these markets, when volatility is at these levels, it's now going to make a lot more sense to be on the long side of the contract because A, option prices are cheaper. So whether you're buying the options outright, again, something else I don't know that I would necessarily suggest, or even buying your spreads, they're going to be relatively cheaper than they would be if volatility was higher. But then also remember, volatility has a tendency to mean revert. Like, volatility has a tendency to move back towards its long run average. So with a long run average VIX at like maybe 16, 17-ish, when you've got a VIX at 13, 14, like, there's some upward pressure for volatility to expand. Now, volatility can live on the lower end of the range for a very, 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 very long time. And so it doesn't mean that it's going to revert back, today or tomorrow or the next week. But statistically, this is a decent time to take a shot by buying premium and playing for that volatility expansion. Okay, so scenario number 2, earnings. Right? If you've been around the Tasty world for any length of time, you know we love to trade earnings. There's high volatility, there's lots of movement, lots of action, and honestly, it's just fun. Like, you want to do something in your favorite stock, you want to do something in, some hot stock in the marketplace, you want to take a shot, whatever, upside, downside, doesn't matter. It's fun, it's engaging to trade earnings. Well, earnings can be a little, I don't know, man. I mean, it can be a little crazy. Right? The moves after an earnings event can be rather significant. So it can make a whole lot of sense to maybe buy options going into earnings rather than selling options. By and large, we do think the opportunity is still on the short side of the contract, even for earnings announcements. But I respect the fact that some people might look at the scenario and the situation and say, man, I'm looking at AMD earnings. I'm looking at Amazon earnings. Hey, maybe you're trading NVIDIA earnings. And you're like, hey, I don't want to do this from the short side. I would much rather do this from the long side. That's totally fair. That's very reasonable. That's going to be a great time and a great scenario for you to lean into the long side of the options contract and consider buying some premium. You could buy vertical spreads. Hey, you could buy expected move butterfly. Shout out to yesterday's calculated risk. You could buy a lot of different strategies, diagonals, calendar spreads even, around earnings and play that long side of the option contract in a much more controlled way. Okay, scenario number 3. It's also going to give you a little bit of strategic diversification. Right? When you've got a portfolio, when you've got a book, as the pros call it, and it's mostly short premium, it's mostly short options, it's like, that's all well and good. You got the probabilities, you got the theta, you got all those things. But just to smooth things out a little bit, just to smooth out your directional bias, just to smooth out your exposure, and smooth out the different strategy sets that you might be using, it can make a little bit of sense to add in some long options and add in some long spreads and add in some debit strategies that really kind of balance everything out. Now, let's be clear about this. You're buying verticals, you're buying calendars, you're buying diagonals. In my humble opinion, those are not going to be the things that move the needle. Those are not going to be the things that ultimately kind of get you where you're trying to go. And so we can't expect too much out of our long premium strategies and put too much pressure on them to carry the load and carry the weight. That's what the short premium is supposed to do. And so it definitely allows us to strategically diversify, but we just have to temper our expectations. Make sure that we're not asking too much out of these strategies, things that they were really never intended to do. Because remember, when you buy options, especially naked options, but oftentimes even with spreads, what are you giving up? What are you sacrificing? What are the gotchas, as they say? Well, effectively, you're not going to have high probability. You're either going to have like a 50-50 shot, like an at-the-money spread, or you're going to have very low probability, 10%, 20%, 30%, with like a butterfly or something like that. And you also don't have time working for you. So the two primary pillars of what we like to lean on as a premium seller are essentially going to be either A, non-existent, or B, working against you when you buy premium. So hopefully now you can kind of see we can't really expect too much out of these strategies in the end in terms of being a really significant needle mover. And that's why at Tasty Trade, we lean on the probabilities, we lean on theta, we lean on the short side of the option contract, because we do feel like that's where we're going to be able to tap into the big needle movers. Those are going to be the things that get us where we're trying to go and move the portfolio forward. But still, there's a time and a place to add a little bit of long premium to your portfolio, and hopefully now it's a little bit clearer to you what those times are and where those places are, and I'll see you guys next time. Jim Schultz here for Calculated Risk, and don't forget, before we get started, the best ways that you can help us are by liking the video or subscribing to the channel. Either one of those guys really helps us out a lot. Alright, so earnings season is here, and we all know what that means. Everybody wants in on the action. We're like, you want to get going, I want to get going, we want to trade our favorite stocks, we want to get in on the big names, use our favorite strategies, take our directional shots, and what have you. But we all know that earnings, man, it can go either direction. I mean, these events are binary in nature for a reason. There is most likely going to be a very explosive move in the stock one way or the other. And so when it comes to earnings specifically, a lot of times using a strategy that is defined risk is going to make a lot of sense. I mean, hey, you guys know, if you follow me for any length of time, you know that I don't love defined risk strategies. You know that I think there's a lot more opportunity with undefined risk strategies. But still, we have to be aware of kind of the potential quagmire that we're walking into. And so around earnings, I definitely have a greater love, at least a greater like, for defined risk strategies. So today, I want to walk through my all-time favorite defined risk strategy for earnings, the expected move butterfly. So most of the time as premium sellers, like we're trading time and we're trading volatility, right? We're selling premium, we're playing time passing, we've got the positive theta, we've got the time decay, we've got all those things working for us. Okay, that's great. We're also trading volatility. We're trading volatility's natural tendency to contract. We're trading volatility's natural kind of grind lower over time. And so these two things are non-directional in nature, and that's typically what we're hanging our hat on as a premium seller. Okay. But every once in a while, we might want to trade direction. Like every once in a while, we might want to take a bullish shot. Every once in a while, we might want to take a bearish shot. And around earnings, one of the metrics that can be really nice to kind of have an objective view of the analysis around that stock or the market at that given time or what have you is the expected move for that cycle. So looking at the expected move, using the expected move for that cycle in that stock can really give you an unbiased look at what the market is pricing in for the upside or the downside. And the really cool thing is we can use the expected move alongside the expected move butterfly to set up a really nice directional shot that's relatively cheap to play earnings and play it to the upside or the downside however we see fit. So let's hop into Tasty Trade now and let's set one of these guys up. Alright, so I'm inside of my Tasty Trade platform and I picked a real doozy of a time to do an expected move butterfly around earnings because it's not really earnings season right now. And so if you go to like the Tasty default watch list, I mean, you can look at the all earnings. I was looking at this before the video, and it's like, man, we've got Len. Like Len has earnings today. Never heard of them. Right? We've got Adobe coming up maybe later today or this morning. I guess we could potentially trade Adobe. But you've got Kroger next week and JBL on ACN, and it's like, okay, this is not exactly the season for the heavy hitters. Like if I go into the Tasty default watch list and I sort by earnings just by clicking on the earnings column, you're going to see that, I mean, there aren't really any decent ones coming up that we like to trade on a regular basis until later on in July. And so really, this isn't the best possible time to do a video like this, but we are so far into it now, we can't turn back. So we're going to go ahead and still use the same basic principles of trading an expected move butterfly like in the front week around a binary event. And so that way you are ready come time July when there are more earnings opportunities. Okay, so let's use Google for the purposes of this example. Now, I may not have done a good job from a calendar standpoint in terms of the best possible time to do a video like this. However, it is a Thursday. So today is a Thursday, and oftentimes using an expecting move butterfly, I'm looking to set that guy up in the front week, so using that Friday's expiration. And the reality is this: Thursday into Friday butterflies are really, really nice because with a butterfly, you want to nail the direction of move close to expiration. That's going to allow you to achieve the most profitability out of the strategy. And so by choosing an expected move butterfly on Thursday going into Friday, if you do get the move that you want, you're going to be in a situation to potentially make a decent amount of money in a pretty short amount of time on that following day's opening bell. Whereas if you did a butterfly, the previous week, or even like a Monday or a Tuesday going into Friday, it's a little bit more challenging to make significant profits on the strategy because with a butterfly, you want all the extrinsic value to come out of the options. You want all the extrinsic value to drain out of the options, and butterflies oftentimes cling to their extrinsic value until the very end. And so Thursday into Friday butterflies, Wednesday into Friday butterflies using the front week are going to be my favorites. Monday into Friday and Tuesday into Friday, I'll still do them because they do give you more opportunities to make money, but you're not likely going to make that much money. Okay, so if we pretended that Google had earnings tonight, let's say, and I wanted to set up a butterfly to take advantage of that, then what I might do is, let's say I wanted to play Google to the downside. So a lot of times the way that I'm going to set up my butterfly is I want to situate my strike right around where the expected move cuts off. So this copper strip is the expected move for this cycle. So it's only a one-day cycle. The expected move obviously is only plus or minus about $5. And so if I bought a 345 and I sold a 340 and I went ahead and bought a 335 because the butterfly has to be a 1 by 2 by 1. So I go back into the center and I double that guy up. And you can see that is a very, very cheap way to take a directional shot, right? I'm only paying 90 or 91 cents for a $5 wide butterfly. And so again, very cheap way, take your directional shot. If you miss and if you're wrong, and in this case, if Google rallies, then you're only going to lose what you paid. Like you're not going to lose any more than the debit that you paid. And if we were to set this guy up on the call side, you're going to see a very, very similar setup. If I buy a 345, I sell a 350, I buy a 355, I double up on the 350. Again, it's 95 cents. It's basically a symmetric market right now with Google being right around 345. And so with us kind of starting at that 345 market, we essentially have the same pricing on both sides of the market. So whether you want to play it down or up, it's effectively going to be the same risk in both trades and the same risk return dynamic. And generally speaking, what I want to do here is I want to size my butterfly such that it fits with my position sizing parameters, right? Remember, with defined risk, we want to be typically 1 to 3% of our account. Now, in this account that I'm trading here, the From Theory to Practice account, this is about a $35,000 account. So this is a very small position relative to my account size. I could easily go up a few more dollars, no problem. But generally speaking, somewhere between 1 to 3%. If you want to live on the lower end, you want to live on the higher end, that's completely up to you, of course. But generally speaking, that's going to be a pretty good range where we can live. Now, the wider you make your butterfly, the easier it's going to be to make money. That is just the truth. But of course, we've heard it before, and here it is again. For every gimme, there's got to be a gotcha. And so if I'm going to widen out my butterfly, then I'm going to have to pay more for that additional width. So for example, if I just stay on the call side here, just to make this a bit simpler, let's say I move my 345 strike down to 342.5, and I move my 355 strike up to 357.5. Look at what happens with to the debit that I pay. It's gone up to $2.32. But now I have a lot more money that I could potentially make. Now my maximum profit is over $500, whereas before it was only about $400. My probability is higher than it was previously because, again, the market understands and the metrics understand that this is going to be an easier trade to manage if it moves in my favor. If you have a super tight butterfly, like $1 wide or $2 wide, like, yes, it's going to be dirt cheap. Like, yes, it's not going to cost you anything. Like, you're literally not even going to know that it's gone if you lose it. The problem is those are very, very hard to manage. Those are very difficult to manage. You have to thread that needle, you have to get the perfect price at the perfect time. And so I much prefer to widen out my butterflies to give them kind of more room to breathe. So I would probably settle on this butterfly, whether it's to the upside or the downside, doesn't really matter. It depends on, the directional bias that I might have. But this is going to make a little bit more sense. Give me a little bit more kind of meat on the bone when it comes to, the risk return dynamics. Give it a bit more economic significance. And so when you're setting up your butterfly, your expected move butterfly, I should say, pin the expected move with your short strike, and then choose the width of the butterfly relative to your position sizing parameters in your account. And again, this is a great strategy for a binary event like an earnings release. So there you go. That is an expected move butterfly. Now, again, it's not technically around an earnings event because I couldn't really find one today, at least in terms of a stock that we all know and trade and are familiar with. And so save this in your repertoire for when earnings season comes around in just a couple of weeks. And so you will be ready to go because we want to hang our hat as premium sellers on time and volatility. But still, from time to time, taking a directional shot, it's fun. It's fun, it's part of the game, and you might even make a little bit of money. And now you have a really, really cheap way to do that, relatively speaking, with the expected move butterfly. And I'll see you guys next time. Jim Schultz here for Calculated Risk. And don't forget, before we get started, the best ways you can help us are by liking the video or subscribing to the channel. Either one of those guys really helps us out a lot. So generally speaking, here at Tasty, we like to sell premium, right? We want to play into the high probabilities. We want to play into the positive theta. We want to be on the short side of the option contract, generally speaking. But every once in a while, we also like to flip the script. Like every once in a while, we like to buy volatility. Every once in a while, we like to use debit strategies and kind of play for volatility rising. And one of the classic strategies to set up for that type of play is a calendar spread. So what I want to do today is hop into the platform and let's set up a calendar spread. But before we set this guy up, let's just talk in general terms. What does a calendar spread look like? Well, it is going to be a multiple expiration cycle strategy where you're selling the front month and you're buying the back month. You're choosing the same strike in both months. So it's very much an overlapping feature of the strategy between the short option in the front month and the long option in the back month. And the reason why you set the strategy up this way is because you want to take advantage of two elements. You want to take advantage of time decay, even though it's a debit strategy, and you also want to take advantage of any potential volatility expansion. So the time decay comes from the simple fact that that short option that you're selling in the front month, it's going to burn faster than the back month. It's going to decay more quickly than that long option that is sitting in that back month. And for the volatility aspect, the back month option is going to have a higher vega than the front month option. And so by having that higher vega in the back month, if there is any volatility expansion in that underlying stock, you are likely going to see a pop in your P&L from that volatility expansion. This is why we typically like to do calendar spreads when volatility is on the lower end of the range. So all right, let's hop into Tasty Trade and let's set one of these up. All right, so here I am inside of my Tasty Trade platform and I've got Meta pulled up. And this is a $600 stock. Okay, so the first thing you want to understand is we really like to use calendar spreads on higher price stocks. So not necessarily $600, but the price of the stock doesn't necessarily kind of preclude you or prohibit you from doing a calendar spread in that stock, because the higher price of the stock really plays well with the more aggressive management style that we typically deploy with calendar spreads. We're typically managing the spreads at 10 to 20 to 25% of our debit paid. And so if you choose a really low price stock, like a $50 stock or a $75 stock, it's going to be a super cheap calendar spread, which is nice because that is indeed your maximum loss, but it's just not going to give you a whole lot of economic significance when it comes to the profit potential on that strategy. So, okay, so I'm in Meta. The way that we would generally set up a calendar spread is going to be, again, I'm selling the front month and I'm buying the back month. Don't worry about the earnings right now for the purposes of this illustration. We'll come back to that at a later date. Usually, we like to be at about a 1-to-2 ratio between the front month and the back month. So you can see we're at about that ratio right here with this Meta calendar spread. So when I go to set this guy up, I'm going to open up my July cycle first. Now, in terms of the strike selection, remember, we're going to be selling and buying the same strike. So the 580 in both cycles or the 560 in both cycles or what have you. Usually, calendar spreads, the spirit of the calendar spread is a more of a neutral strategy. So you're usually typically choosing a calendar spread with some strike around where the stock is currently. Now, you want the stock to pin the strike. So whatever you choose, that's where you want the stock to go. So if you want to be more directional, then you can certainly choose strikes on the low end. You can certainly choose strikes on the high end if you want to be more bearish or more bullish. But usually, the spirit of a calendar spread is more of a neutral strategy. On that note, we typically prefer put calendars relative to call calendars. It's not a huge difference, but remember, this is a volatility expansion play. This is a long volatility play. So if volatility rises, that's going to help our calendar spread. Well, we know, or maybe you don't know, and maybe this is the first time you're hearing it, but market prices and market volatility typically move inversely. So when market prices are down, volatility is typically up. You can even see it on a day like today where the market is down huge and volatility is up pretty significantly. And so we typically observe this relationship across the board with a lot of individual stocks as well. So if I'm playing volatility to expand, I'm playing volatility to the upside, then I want to position myself to potentially extract as much benefit from that volatility expansion as I possibly can. So choosing the put option slightly below where the stock currently sits, even if it is mostly neutral, choosing a 580 or a 575, that's going to allow me to situate my strike such that if there is volatility expansion and the stock price moving lower, that's going to really help me. So right here, let's say I sell a 580 strike, which is just slightly below where Meta is right now in July, and then I close up July, I go to August, and I buy the same strike, the 580 strike. And so notice how this is a debit of $14 on this strategy. So this is a fairly significantly priced calendar spread. You would probably want to have, I would say, maybe $30,000 in your account or so, or maybe even more than that, or maybe a little bit less. But this is not going to be a strategy for a tasty bite-sized account. But if I'm managing this at 10% of debit paid, that's $140. 20% of debit paid, that's $280. So it's pretty significant when it comes to the management. When I'm selecting my strikes, I want to make sure that the extrinsic value in the front month is over and greater than the debit that I pay in the strategy. This gives me the best possible chance to make money from time decay, because I know if nothing happens and the stock just sits here, which we know that it won't, but if it just meanders around and ends up back here when all is said and done, then all that extrinsic value that came off of that front month is going to cover the debit that I pay in the strategy, and it's going to effectively make it a little bit easier for me to make money. So this $14 and some odd cents, if we go back to July, where my front month is, you can see I'm collecting over $22 in extrinsic value. I know that that's all extrinsic value because this option is out of the money. And so the way that this calendar spread is setting up in Meta looks pretty good. This would be a great candidate for a calendar spread. And so hopefully this kind of makes sense from the higher priced stock preference to the put preference. It's mostly a neutral strategy, managing aggressively at 10 to 20% or even 25% of debit paid, and then making sure that front month extrinsic covers the debit. So, okay, so that is a calendar spread. Hopefully that makes sense. And we kind of covered the major points of setting up a calendar spread. Now, in today's market, with the VIX skyrocketing and volatility rising, this may not be the best market to sell or put on a calendar spread in, but when volatility eventually collapses, when volatility eventually contracts, as we know that it will, if history is any guide, now hopefully you are ready with a strategy that can take advantage of that low volatility, and I'll see you guys next time. Jim Schultz here for Calculated Risk, and don't forget, before we get started, the best ways you can help us are by liking the video, subscribing to the channel. Either one of those guys would really help us out a ton. So how do you trade a runaway bull market? If you're watching this video when it was released in June of 2026, it's like, man, this is the market that we are in right now. Sure, we've had a couple of blips and a couple of downdrafts and what have you, but man, it has been incredibly strong to the upside. Well, the truth is, our biggest risk as a premium seller is going to be the outlier move that gets away from us, whether it be to the upside or the downside. So whether you're trading a runaway bull market or a runaway bear market, everything we're going to talk about today for the next 2 or 3 or 27 minutes applies to both of those guys. So let's dive right in. Let's go through 3 things that you can do to help protect yourself against a runaway bull market or a runaway bear market. All right, so day to day, I'm going to say, you may or may not agree with me, the markets are pretty random and pretty unpredictable. And when you start thinking about asset pricing, you start thinking about what's controlling asset price moves. I mean, you've got geometric Brownian motion, you've got the efficient markets hypothesis, you got positive drift, you got your volatility shocks, you got all these different mathematical models that are kind of pointing to, all right, there's a high degree of randomness and unpredictability. So a lot of the time, the market's just kind of wiggling, it's just kind of waggling, it's just kind of moving around a little bit on either side, and that really helps us as premium sellers. And even if volatility ticks up, which is what we want because it makes the premiums on the options that much richer, still, it's very rare that we get caught in a runaway move that just has no signs of slowing down. But that does happen. You get that one-sided move where it's just wiggling and no waggling, or it's just zigging and no zaggling. And so what do you do in that scenario? Here are 3 things that you can do before you ever put the trade on. The first thing is your position size. The second thing is your capital allocation. And the third thing is going to be your strategy selection. Because remember, what price does day to day, it's out of our control. So we need to focus on what we can control. We need to control the controllable. And in my opinion, position size, capital allocation, and strategy selection are all within our control. And all of these things happen before the trade is even live. So number one, first and foremost, is going to be position size. Right? Everybody wants to talk about, Jim, how do I hedge against a big move against me? How do I hedge against a big drop or a big pop or whatever? And my answer is always the same. It has to begin with position size. This is the most kind of organic way that you can hedge against things that move against you, by controlling that position size on order entry. You want to be small enough such that it frees you up to do whatever you want to do later on. Like if you want to later on and add on additional hedges, you can do that. If you just want to kind of lean into the position size and let the position kind of, meander off into the distance, you can do that too. But if you are too big on entry, it really just kind of handcuffs you in terms of the different things that are available to you and at your disposal. So position sizing is number one. Because remember, we're out of the money premium sellers, right? We're selling 30 delta, we're selling 40 delta, whatever. But once that position spills over to now where it's in the money, now the deltas begin to grow. So now they're not 40, they're 50. Now they're not 50, they're 60, right? You've got a naked position on, those deltas are starting to grow. So what was a very small, kind of innocent position at 25 or 35 deltas is now all of a sudden 75 deltas, and it's going to feel a lot bigger than it was at order entry. And so if you don't size on entry so that you're okay when the position does go in the money, I think you're doing yourself a huge disservice, and it is going to show up at times when you probably really don't want it to show up. So that's why when it comes to position size, generally speaking, define risk 1 to 3%. That's a great reference point. 1 to 3% if you have a larger account. So let's say you're at 100,000 or more, you could probably even be below the lower end of that range. If you have a smaller account, so let's say maybe 10 or 12,000 or less, then you might be actually above the upper end of that range. You may have to go to 4% or 5% or 6%. But 1 to 3% for defined risk is a great reference point. For undefined risk, 3 to 7% in terms of your buying power allocation. Again, you have more capital, you can probably be below the lower end of that range. You have less capital, you may have to kind of creep up to maybe 8% or 9% or 10%. I probably wouldn't go above 10% because, again, you want to be small enough on entry such that you can go ahead and manage the position objectively and do all the things that you want to do and think with a level-headed, mind all throughout the process and not get emotionally charged up. So the second thing, capital allocation. Right now, ceteris paribus, which is all things being equal for all my Latin groupies that might be watching the show here today, but you guys already knew that. Capital allocation, when it comes to how much capital we're using, obviously we're going to prefer less capital relative to more capital. We would love to get where we're trying to go using less capital rather than more capital. I mean, that goes without saying. That's a given. But there are times when we might have to deploy a bit more capital to get where we're trying to go. So we might need to tick up when it comes to capital allocation. Just be careful that if you're concerned about guarding against a big move against you, whether it's to the upside or the downside, both would apply. You're always going to be better off if you have less capital deployed. And so that's why, generally speaking, we like to live somewhere between 25 to 50% most of the time. There are certainly times and places where you'll be, above the upper end of that range, and maybe even times and places when you'll be below the lower end of that range. But if you are really concerned and you want to guard against and protect against a runaway bull market or bear market for that matter, I would live on the lower end of that range, maybe be around 25 to 35%. And then thirdly, the strategies that you select. So obviously, if you go define risk, if you go vertical spreads and iron condors and diagonals and butterflies, they're going to have built-in mechanisms into the actual strategies that are going to protect you against runaway moves against you. They have kind of outlier risk mitigation built into the structure of the strategy because they are defined risk by nature. So that's going to be the easiest way to protect against the outlier moves against you. You have the gimme of the protection against that runaway move, but of course, we know it's been said before, and I don't know who said it, but let me know. If you know who said it, put it in the comments below this video, because it is a catchy jingle. For every gimme, there's a gotcha. So what's the gotcha? Well, one of the gotchas with defined risk, in fact, I can actually think of two. Number one, you don't have the unfiltered exposure to the Greeks. So you're not going to get, the pure positive theta. You're not going to get the pure negative vega. So that's going to kind of slow down what you're trying to do in terms of your Greek exposure. But then number two, they're going to be much harder to adjust. These strategies are much more difficult to adjust if things do go against you and you kind of want to maneuver a little bit. You kind of want to manage your way out of these guys a little bit. Much harder to do with a vertical spread or iron condor or even a butterfly when it comes to the adjustments relative to undefined risk strategies. But if you do want to do an undefined risk strategy, a great strategy, which is my favorite strategy, is the out of the money short put. Right? Again, specifically if we're in a runaway bull market, a lot of times you're like, man, I kind of want to participate in this. Like, man, I want to be a part of this. Like, I want to take advantage of this super strong market, but I don't really want to buy the tippity top. Like, I don't really want to be the guy that buys the NASDAQ at 31.3 and that's the top tick for the next 7 or 8 years or, 7 or 8 months or 7 or 8 weeks or 7 or 8 days or whatever. And so one of the strategies that you can deploy in this type of market is by selling an out of the money put. It is a naked strategy. You do have undefined risk, but if you're in a scenario where you're like, man, I'd be happy taking the stock or taking the index at that level, then you just collect the premium in the event that the market goes nowhere or it even goes higher. And if you are in a scenario where the option does go in the money and you are going to be assigned at that price, you're still better off than if you had bought the stock at that tippity top price point. So as an active trader, right, we can control a lot of parts of the process, but there are certain things that we can't control. We can't control the price. We don't know what's going to happen. Nobody knows what's going to happen next. But we can control our position size, and we can control our capital allocation, and we can control our strategy selection. And so put those things in place, let the math take over, and give the probabilities a chance to play out. And I'll see you guys next time. Jim Schultz here for Calculated Risk, and don't forget, before we get started, the best ways you can help us are by liking the video or subscribing to the channel. Both of those things really help us out a lot. So one of the things that you guys see us do all the time on the network is rolling our positions. I mean, we're rolling up, we're rolling down, we're rolling out, we're rolling in. This is a very common tactic that we like to deploy to maneuver around the management of our positions. Rolling. And so today I wanted to take a few minutes and let's unpack what it is, why we do it, and kind of some of the inner workings behind a rolling strategy. Okay, so let's start simple. What is a roll? It's actually very straightforward. All you're doing is you're closing your current position, you're picking it up, you're moving it out to a later cycle, and you're reestablishing oftentimes the exact same position or maybe something that is slightly different. So all you're doing is picking it up, moving it out, and dropping it back down. That is a roll. Now, sometimes when we roll a position, we may do it inside the same expiration cycle. So like with the strangle that we're going to talk about here in a couple of minutes, we may not necessarily be moving it out to a later expiration cycle. But most of the time, when you hear us use the term roll, we are referring to moving it out in time and adding days to expiration to the trade. But understand, there are times too where we do roll within a given expiration cycle. All we're doing is we're changing the dynamics of the strategy slightly to kind of maintain the same spirit, but adjust it so that the risk parameters are a little bit more to our liking. But when it comes to rolling out in time specifically, this can be really advantageous to us because, again, remember, what are we doing? Right? What are we doing on the Tasty Network? We're trying to manage our winners. We're trying to engage with high probability trades. So when the market gives us something that works out, we want to close that. We want to close it. We want to be done with it. We want to make sure it's economically significant, of course, but we don't want to stay in the trade too long. But by rolling out in time and giving trades extended duration, we are able to kind of give those losers a chance to come back to us, which doesn't mean it's always going to work. It doesn't mean that every losing trade is going to come back to you, but it does give the losing trades, the ones that don't work, a little bit more time to work out. We just want to tap into the natural ebb and flow of the marketplace. We just want to tap into kind of the natural back and forth nature of the market, which doesn't mean that every red trade is going to turn green. It doesn't mean that every losing trade is going to be a scratch, but it does mean that when things don't work out, we have some things that we can do. Like we have some tactics, we have some adjustment protocols, we have some mechanics that we can turn to kind of give the trade a little bit more life and give the trade a little bit more time. That is what a roll is, just in a nutshell, if we zoom out and kind of look at it kind of broad-based. Okay, so now when do we roll? Well, there are two basic times when we would consider rolling. There may be other times, and there's a little bit more subtlety and nuance when it comes to actually, when we roll. But the two main pillars are going to be when the strike is hit and when we hit 21 days to go. Now, both of these more readily apply to undefined risk rather than defined risk. Defined risk is a special thing, and we'll come back to that in just a couple minutes. But let's talk about when the strike is hit with an undefined risk position. So we sell a put or we sell a strangle, it doesn't matter. These are two great examples. When you put on this strategy, these strikes are out of the money. When you put on this strategy, like the strategy is working, everything is easy, everything is great, the sun is shining, the air is fresher, like everything is absolutely amazing. Well, now all of a sudden, the strike gets hit. Once the strike gets hit, now that out of the moneyness on the trade is gone. Now that out of the moneyness, that buffer that you had has now been evaporated. Which that means that now the strike is getting close to, the strategy is getting close to being in the money. So now we're in a situation where, we've chewed through our buffer, we don't have any wiggle room left, and the strike might be in the money, which isn't necessarily a death sentence. It doesn't necessarily mean this is going to be a losing trade, but it does begin to change the risk parameters of the position rather significantly. Case in point, your directional bias is now going to start to grow. Right? Because at the money options have a delta of 50. And so when the deltas or when the strikes are out of the money, their deltas are below 50. They're 30, they're 25, they're 35, whatever. And so it's not going to feel like that big of a position as it moves around. But once it goes in the money and it spills over that at the money strike, now the deltas grow to 55, to 65, to 75. So now the direction of moves are going to be a lot more significant. And so that's why if we take a strategy like a short strangle, when one side gets hit, the first thing we like to do is actually roll that untested side, roll the other side in a little bit to help to protect the side that is being tested, protect the side that is being threatened. So for example, if I have a short strangle on and the market goes down and my short put is my tested strike, I'm going to be looking to roll my call down and maybe trim my directional bias by about 30 to 50%, because what that does is it protects that tested side. If the market keeps going lower and if the market keeps pushing through that short put strike and goes deeper and deeper in the money on the put side, I have more protection because I brought in more premium by rolling that call down. Similarly, let's say a short strangle, now the market runs up. So now my short call is the tested strike. Now I'm going to be looking to roll my put up. So same basic idea, I'm just on the other side of the ledger, if you will. And so now I'm rolling the put up to protect that call strike. I want to protect against the runaway move higher. I want to protect against, the market running up through that short call strike and it going deeper and deeper in the money on the call side. And so maybe I roll the put up and trim my directional bias by 30 to 50%. What I'm doing is I'm bringing in more credit. I'm controlling my directional bias on that tested side, and I'm actually improving my break-even point on the tested side. And then even with the strategy as simple as something like a short put, now I only have one leg, so I'm not going to be rolling the untested side because there is no untested side. There's only one single side. And if that side gets tested, it is both the tested side and the untested side at the same time. And so what I might do is if that strike is tested, maybe now I just roll out in time. Maybe now I use my rolling mechanics, my rolling tactic to just add duration to the trade. That's going to slow down my Greeks. That's going to improve my break-even point. And it's just going to give me more time and extended duration in the trade. And so when it comes to a short put, where the strike is tested, rolling out is typically going to be the first line of defense. You can add a short call and trim the directional bias, but that's kind of a separate project for maybe another time because that's a little bit more involved. And so that sounds like it could be theoretically, hypothetically, a future calculated risk. So you've got to stay tuned for that guy. But also, when it comes to a short strangle or a short put, or really any undefined risk strategy, once we get to 21 days to go, we also are going to be looking to roll out in time. And the reason for this is pretty simple. Once you get within the last couple of weeks before expiration, so anywhere between 14 and 21 is probably a fine time to roll. The gamma on the position is naturally going to be increasing. The gamma on the position is naturally going to be on the rise. Now, gamma is a second derivative of the Black-Scholes model. It's showing you how delta changes when the stock price changes. So it's kind of an added layer of directional risk and directional bias. And so by controlling that, by adjusting and rolling our positions prior to getting too close to expiration, we're kind of naturally putting a lid on just how much damage gamma can do to us. And so this is a no-brainer. If you're at 14 to 21 days to go and you're not where you want to be on the position, just roll it out. Don't think about it. Just go to the next monthly expiration cycle, pick up your premium, improve your break-even point, and slow down those Greeks, specifically gamma. The key thing we want to remember when it comes to rolling, 99 times out of 100, 98 times out of 100, we want to be rolling for a credit. Because when we roll for a net credit, we improve our basis. We widen our break-even points. Now, this doesn't mean that you can't ever roll for a debit, but you just have to understand what you're signing up for. You just have to understand that when you do roll for a debit, you are worsening your basis. When you do roll for a debit, you are potentially kind of shrinking or narrowing that break-even point, which is kind of working against what you want as a high probability kind of premium selling active trader. So just understand, when you pay a debit to roll, it's not exactly in line with what we're trying to do. Now, again, you pay 2 cents, you pay 4 cents debit to roll. That's not a big deal. I'm kind of talking about the more significant debits, but I think as a rule, rolling for a credit is a really great reference point. Now, this is really easy to do with undefined risk because when you roll out into the future, you're capturing more extrinsic value, so you're pretty much always going to be able to roll for a credit. But with defined risk, so vertical spreads, iron condors, you can't always roll for a credit. And the times when you do want to roll, when the trade is in the money or it's underwater, it's not going to be a credit to roll. It's going to be a debit to roll. That additional time is going to cost you something. And so when it comes to defined risk, a lot of times you just have to control your size on entry and be ready to hold that thing to the very end if that's what it comes to. Don't expect to be able to adjust. Don't expect to be able to roll out for a credit. If you get to 21 days to go and you can do it, then that's fine. But chances are you're not going to be able to do it. So when you trade something like a vertical, like an iron condor, something defined risk like a butterfly, just be ready to hold that thing all the way to the end and don't expect to be able to roll for a credit. If you can, that's great, but I would not bank on it. So rolling is not a magic wand. It's not a get out of jail free card. It's not going to turn every loser back into a winner. And it's not going to give you a 100% hit rate. But it is a nice tool to have in the toolbox to allow us to lean into the probabilities, to allow us to soften the Greek exposure, to allow us to widen out our break-even points, to allow us to improve our basis and kind of slow down that gamma risk that is notoriously on the rise as we get closer to expiration. So again, it's just a tool in the toolbox, and this is why we roll, and this is when we roll. I hope that makes sense, and I'll see you guys in the next video.
What's up, everyone? Mike here from Tastylive, and we're coming at you with another episode of Options in Action. If you've missed this series, it's basically a new series where I take an old whiteboard concept or maybe a strategy that I talked about previously and bring it into an advanced light. We take a look at the platform and we talk through the practical application of some of these concepts. We're going to go through the entire YouTube playlist, the old whiteboard series. So we have talked about call options, put options. We've talked about premium. We've talked about strike prices and expirations, you name it. And today we're talking about the age-old question. Can you make more money trading short premium, or can you make more money trading long premium? And what are the gimmies and gotchas, as Dr. Jim says? What are the trade-offs with selling premium versus buying premium? We're going to take a look today, and we'll break it down on this edition of Options in Action. So we got this SPX chart pulled up here, and this is not the SPX stock or index chart. It is actually a chart of a long call out in December, the 8,300 strike to be specific. You can see here SPX at the top is trading at 7,300. So we're looking at this call option 1,000 points out of the money to the upside. And this is the December cycle. So before we dive into this and before I start spewing nonsense, I just wanted to say, you know, when you're selling premium, there's a difference between selling premium in the S&P 500 products like SPX or MES or XSP or SPY. There's a big difference between selling premium in those sorts of products versus selling premium in the equity space, right? S&P 500 or other indices, even products like SMH that have moved quite aggressively with the tech sector popping off and selling off at the same time, there's things to consider, right? Short premium in the S&P 500, I've said this before, I think if you can trade successfully short premium on both sides of a market in an equity, you can definitely do that in the S&P 500 simply because the S&P 500 moves less. It doesn't have the same binary events. It doesn't have the same binary nature of equities. You could have a CEO step down and the stock price be down 20% pre-market or after the market closes, or the opposite can happen. They can announce something that the market likes, and that stock is up or down 20% when the options market is closed. It's not necessarily going to happen in the S&P 500. There's also market stops. Even if there is a big crash in the S&P, there's certain levels where the market stops trading. That doesn't necessarily help you in the case of not taking on risk when it comes to short premium. If we're talking like short puts, for example, into a market move like this, or even strangles. But what I will say is over the years, I've learned that there's a time and place for all strategies, right? I have long premium strategies where I'm buying options. It's a lower probability trade if you're holding trades to expiration. But I like to say if you're buying options, you get what you pay for. I don't really buy options that are near term. I don't buy 0-day options. I don't buy 7-day options. In my mind, you're buying a lot of implied volatility in those cases, and it becomes just that much harder to be profitable on those strategies because you have this super decaying asset that is, if it moves against you directionally, it's basically going to become worthless, and it becomes that much harder for it to reverse and work in your favor. If you're buying a leap option, though, totally different story. Leap options cost a lot of money. You get what you pay for when it comes to long premium. But I think when you're buying premium, it doesn't necessarily have to be a naked option. It can be. I actually have a position on in Nike right now. I bought a leap option out at the 60 strike all the way out almost 600 days away, January of 2028. So this was a situation where, Nike drops to multi-year lows. We're talking decade lows. This Nike hasn't been 45, at least around this price point, since 2015, if I'm not mistaken. So the further a price falls, especially in a product like Nike, where I think we'll still see some upside potential there, yes, I could sell a put to collect that premium. But at the same time, Nike's already fallen, and it's still down at 40. If I sell a put 16 days away for $100, sure, I could sell that. It's a higher probability trade. You can see my probability of profit is nice and high at 66%. But I take on the undefined risk nature of Nike, where maybe they announce something, the stock's not down another 10 points, and now all of a sudden I have a $900 loss on my hands and not much management in terms of what I can do. It also takes a decent amount of buying power, $800 relative to a $40 stock. So for me, instead of selling a put, especially when a product like Nike or any other equity gets to multi-year lows or decade lows, I'd rather just inventory some long-term premium. And you can see here, the further out in time you go, because you're avoiding the implied volatility increase of something like an earnings announcement, something I mentioned earlier, you've got plenty of implied volatility here in the near-term cycles that isn't necessarily reflective of these long-term cycles, right? Look at this expected move for June 30th. You have a plus minus $4.60 implied move with a 60% IV almost, but you look at January of 2028 and it's only a 17-point implied move, and that's because the implied volatility is significantly lower when you get all the way out here on the curve. So will I be trading Nike? Will I be selling premium in Nike around the earnings announcement in a defined risk way? Absolutely. like I said, there's a time and place for everything. I think for Nike with the upcoming earnings, I'll probably sell something in this 22-day cycle, but I'm going to buy something in July or August. I likely will go to something like a diagonal spread or calendar spread in that sense, because I still want to trade intelligently. I still want to reduce cost basis, which has always been something that we've said here on Tastylive. I want to make sure that I am reducing my cost basis and improving my probability of success anywhere I can. So in this case, if Nike's offering super high premium to sell something against even a long option I'm buying, whether it be a calendar spread or diagonal spread, we can look at this here, like the 45 strike in July, trading for $2.50, we'll call it. The 45 strike in July 2nd, look at that. You have 2 weeks of a difference in time, but only a 40-cent difference in the option prices. I'm absolutely going to be selling something against that long option that I buy if I'm bullish, and same thing if I'm bearish. But longer term, Nike's down to 10-year lows. So what does that mean? It means I'm going to get really far out on the curve here and risk $500. This option hasn't really moved all that much, which is interesting. Nike's still chopped around, and this 2-year leap basically is trading for $500. My whole thesis is, would I be surprised to see Nike go from 45 back up to 50 or 55 or 60? It was just there a couple months ago. So my answer is no, I would not be surprised. And if I'm buying a leap option that has much lower implied volatility, I know, yes, it's a little bit more costly, but I'm out of the IV spike in the near term. I'm inventorying long-term delta, inventorying premium that isn't going to decay against me all that much. And if we get a move in Nike from 45 to 50 or 55 or 60, that option is going to be worth $1,000, $1,500. And we can see this here. If I right click on the option in the chart, the 60 strike, if you right click on the bid or ask, you can have this menu pop up here. View the option in the chart, and here we go. It's been trading for $500 basically ever since I bought it. But back here, when Nike was at 55 and 60, this option was trading for $1,500. So from a risk reward standpoint, as a product like Nike or any other equity gets to decade lows or multi-year lows, I'm going to be inclined to lean into the long-term positioning. I did the same thing in Microsoft, right? Microsoft went from 550 down to sub 400 levels. What did I do? I was buying into some near-term stuff. We set up some short premium trades, of course, but I also did a really long-term calendar spread at the 500 strike. I bought January of 2027 and sold September of this year, and that was like a $500 trade. I was just like, well, I don't know what's going to happen in the near term, but I do feel like over the course of the year, Microsoft's going to be higher than where it is now. And that ended up being the case. We saw a nice bid, got all the way up to 460. And just looking at the order chains here, you can see I've had some decent trades up until that point. And the only trade I have left is that calendar spread in Microsoft. And it's up a couple $100 right now. If we look at the 500 strike, I bought it for $500. It's up $400 right now. So I still want to have it on. I think there's a bullish case for it. But to answer the question, selling premium versus long premium, I think when you're selling premium, you have to be able to withstand all variance within that product you're selling, right? Because from my perspective, the most success that I've had in products where I've sold premium, it's been in products where I've traded small enough or the product size was small enough to where I could manipulate the strikes, manipulate my time and expiration, or a combination of both, right? That's the beauty of undefined risk. You have the flexibility to be like, you know what? I'm done with this strike. I'm done with this expiration. I'm going to buy this back and I'm going to move it out a month. I'm going to move it out 2 months and move my strike and collect a credit still. So that is how I approach undefined risk these days. It's going to be a much higher probability of success naturally, because when you're selling premium versus buying premium, if you sell an option, you just need the stock price to stay out of the money, or in this case, above your 37.5 put. If you're buying premium, you need a directional move in the stock price, and that's as simple as that. So when you think about that, if I'm selling premium and I just need my strike to be out of the money, I'm going to be much more inclined to sell near-term premium because I know that implied volatility is higher. There's not enough time, or there's not as much time for the product to move against me in a big way. It can still happen, of course, but that 30 to 60 day window is where the implied volatility is nice and high relative to a nice blend of time value as well. So that's why we are selling premium in that window. we have research that shows that that's kind of the sweet spot of implied volatility value plus time value. So selling premium in that 30 to 60 day window. Buying premium, I prefer to be outside of that 60-day window. Honestly, I would rather buy premium in a 90-day, 100-day option cycle if it's something I can afford. In the case of Nike, I can do that in a 25K, 30K account, of course. Even smaller, you have the ability to do it because the stock price is so low. But in something like SPX, $7,300 stock price, I don't have the ability to sell premium in here. I can trade spreads in here. I can do calendar spreads, some diagonal spreads in here. But sometimes the stock price is the determining factor of your strategy. So keep all this in mind and just really make sure if you're selling premium, you need to be able to withstand the variance of any kind of move. I prefer to, if I'm selling a put or a strangle, let's talk about puts. If I'm selling a put, I would rather sell it in a product where I can just hold that premium or take the shares. I would rather not exit at 2 or 3 times the loss of that short put, because if I'm selling an undefined risk put, I kind of want to have that bullish delta anyways if it does get down there. I don't want to be stopping myself out and then 2 weeks later see that it could have moved out of the money. So that's just me. But to summarize, if you're buying options, you get what you pay for. I think in this kind of market environment, I'm always going to have something against it. Like if I'm buying a 60-day option, I want to be selling something in the 30-day cycle or maybe the weekly cycle against it. If there's an earnings announcement where that premium is really juicy and I can reduce the cost basis on my long option, because the more you can reduce the cost basis on your long option, the more flexibility you have going forward to have that long option be profitable or even a scratch. If I'm selling premium, I'm very cognizant of the fact that it is a higher probability trade. You're going to have a lot of winners when you're selling premium, but you should also understand how to manipulate that trade. With defined risk debit trades, when you're buying premium, there's not a lot of things you can do. There are certain things like with calendar spreads and diagonal spreads where you can manipulate that short option by moving the strike or moving it out in time. But with short premium, undefined risk short premium specifically, you can do a lot of different things. You have a ton of flexibility in the ability to manipulate strikes. And if you look at my order chains for the MES position, this is my year-long strategy for 2026. I've clearly manipulated this position over and over and over. And every single time I do it, I collect more credit. I started with 93 points in credit. I now have 700 points in credit overall, which means my break-evens are 700 points beyond my strikes. And this is a profitable trade because I've been selling premium to offset any kind of intrinsic value losses that might show against me. So short premium, I like to reserve it for either products that I can afford any variance in or something in like an index, like MES is a great example, or IBIT even, the Bitcoin ETF. That was my year-long trade from last year. So I think when you compartmentalize these things, it puts you in a good spot to be able to withstand variance. And again, if you have a day like today and you're like, my account is really suffering, then I think your trade size might be off. I think maybe the strategic decisions might be a little bit off. Again, we want to be able to withstand as much variance as possible. With undefined risk, I think it's got to be any variance. The trade size has to be small enough to where you can withstand any variance. It just sets you up for success in the future, and it gives you that flexibility to manipulate the trade as the markets move. And with defined risk, same story. I like to keep them within $500 to $1,000. I think that's a healthy level for me. But again, if I'm doing a diagonal spread or calendar spread, I have a plan for if things go wrong. I know I can move that short strike out in time. I know I can move that short strike up or down depending on the strategy. But yeah, let me know what you think in the comments below. That was a long-winded segment. Wasn't expecting to go that long, but hopefully that kind of mental shift helps a little bit. Again, if I'm selling undefined risk premium, it's usually in an index product or a micro futures product, and it's sector based. It's not something that's going to move 20% pre or post market. But if I am involving myself in those types of products, it's going to be in a product size that is small enough to where I can withstand any variance. I can manipulate the strikes up and down. And I think that's another interesting and important point is undefined risk trading, super high probability if you're doing out of the money sales of options, but understand what you can do to manipulate that risk profile. And that's just going to give you another leg up in the future of trading as the markets move and things go wrong for you. I mean, you're going to have your winners, you're going to have your losers, but you got to know how to manipulate and adjust those losers if they are undefined risk trades. But thanks for tuning in. Let me know what you think in the comments below. Please like this video, subscribe to the Tastylive channel, and we'll see you on the next episode of Options in Action. What's up, everyone? Mike here from Tastylive with another episode of Options in Action. If you've missed the previous episodes, this is a series where I'm talking about old whiteboard videos where we're looking at concepts and strategies, but we're giving it more of an advanced twang, and we're looking at the platform itself, talking about certain concepts that I'm using today and how it applies to everyday trading. We talked about expirations last time, and today I wanted to talk about letting an option expire in the money and ultimately taking shares of stock. Also, we can talk about expiration risk and assignment risk and how it's not something that I'm worried about at all. I think we can wrap those up into one and kind of just give you a nice package of ways to think about expiration and why not to be afraid of assignment risk, especially if you have defined risk spreads or an in-the-money short put or in-the-money short call, something like that. So let's dive into the Tastytrade platform and we'll break it down for you. So we're looking at SPY right now. As you can see, SPY has had a massive rally from the lows of this year. In April, we were all the way down at 635-ish. Now we're sitting at 755. Just an insane run to the upside. And maybe that has resulted in the money options. So for those that don't know yet, if you have an in the money option, it's ultimately going to expire and turn into shares of stock. So if I have a 760 put, for example, that is in the money, I will ultimately be assigned 100 shares of SPY at 760. Same thing with the opposite side. If I have an in the money call, a short option that's in the money, and it is assigned or it expires in the money, I will be basically have 100 short shares of stock at 750. Now, a lot of times we're not really dealing with assignment risk because we're rolling our options positions out in time. And really, assignment risk is highest when you don't have a lot of extrinsic value in your option strike. So even with a 750 call that's in the money, 15 days to go, there's still $600 of extrinsic value that somebody would be giving up to exercise this option and turn it into shares of stock. In other words, they're taking $600 and lighting it on fire. That's why I don't really worry about assignment risk, because it just doesn't happen all too often. I've been trading for over 10 years and I've been assigned maybe 3 times, 4 times maybe. And one of them was a celebration. In this case, it was literally like I had an in the money option that had $200 or so of extrinsic value. And I woke up the next day, I was assigned on it. I got the shares and kept that money, the extrinsic value. I closed the shares and I just resold the option and I basically doubled my credit overnight. So that's another thing. If you are assigned early and there's plenty of extrinsic value associated with your option still, it can actually be a benefit to your position. The only situation where that would not be the case is if you had a dividend that you had to pay. So like with an in-the-money call at 730, for example, let's say SPY had a dividend of $400, there's $288 of extrinsic value here. The counterparty would give up their $280 of extrinsic value to get the $400 dividend. So in that case, it's a net positive for that counterparty. And that is the circumstance where you can get assigned early. Your options can be converted to stock early if there's a dividend where the dividend exceeds the extrinsic value left in the option. But other than that, like you can look at these options here, like this is a 715, 720 option. It's 35 points in the money and it still has $200 of extrinsic value. This is still an option that has a low assignment risk here. So not really worried about options that turn into shares of stock. What I do want to bring up is how it can actually change your risk profile for the better in a lot of cases. So yes, if you have a spread, so like let's say you've got a 755, 750 put spread, right? You're kind of teetering on this short option here. This is a defined risk trade. However, if SPY drops significantly and over time someone exercises this short put, you're still left with the long put here that protects your risk, right? Because a short put converts into 100 shares of stock. A long put represents 100 short shares of stock beyond the strike to the downside. So even if I have a short put spread and I'm assigned 100 shares of stock in SPY, if I can hold that buying power, that's the big caveat. If I can hold that buying power, that would certainly be increased relative to this $300 buying power here for this narrow spread. It actually increases my max profit substantially, potential max profit substantially. And that's because the most I can make from this spread is just the credit I received on entry. However, if SPY drops like a rock and I'm assigned on this short put and I still have this long put, as long as I have the long put, my risk profile doesn't change on that package. But I would now have 100 shares of SPY with a static delta of 100, which means if the market dropped dramatically and I get assigned on the short put, I still have the protective long here. If the market rebounds and now all of a sudden we're back at 755 and beyond, I'm making money on those 100 shares of stock where I wouldn't have been making that money on the shares, because with just this options trade, I can only make the credit received. So another situation where that makes a lot of sense is just like take the shares and just use the shares as a static delta lever is in products that are smaller priced, and maybe you've sold a put and you're trying to roll the put forward. Under Armour stands out to me because I already have 100 shares of Under Armour for this exact reason. But let's say you sold a put in these options expirations. There's not too many here, but let's just say you sold the 7.5 put or like the 10 put. You can see there's very little extrinsic value here. The deltas are super high. And if you were assigned 100 shares of stock in Under Armour, yes, you can only make the amount of the put if you sell this put. And I think that's the big key here. If you're assigned 100 shares, you now have unlimited upside potential on how much you can make if the market does recover to the upside. So the deeper in the money a short put goes, the closer it gets to 100 delta, the less extrinsic value you're going to have. So if you're thinking of rolling a deep in the money put and you're trying to roll it, let's say from July to August or something like that, and you're not picking up a lot of credit, but you have a really high delta on your short put, it actually might make sense to consider taking the shares of stock where you no longer have a option that you can only make as much as the option's worth. You would have 100 shares of stock where you can make a lot more to the upside. So that's pretty much it when it comes to options that expire in the money. I mean, again, I don't really hold things to expiration to risk that. That is one of the things that we should talk about, though. Like if you have a spread that's teetering in the money and out of the money, if you let the spread expire and you're assigned on the short put and your long put goes away, now you don't have the same risk profile. You still have the 100 shares that you're assigned on the 755, but you would no longer have the protective put down here. So something to consider, but deep in the money options that have no extrinsic value, if you take the shares instead, you have a higher max profit going forward, and you have the same risk profile as you did with the deep in the money short put or deep in the money short call. But you now have the static delta in the shares, where a short option that's deep in the money, if it starts to rise towards the at the money price, you can only make the amount of the option itself. So again, deep in the money options, close to 100 delta with no extrinsic value. In almost all cases, your max profit is higher if you just convert the shares, if you're willing to do that. If not, you'd have to manipulate the strategy and change the risk on it by rolling out in time and moving it if you can. But those options that are super far in the money are trading like stock basically anyways. So let me know what you think in the comments below. Please like this video, subscribe to the Tastylive channel if you haven't already. But yeah, let me know if you've ever been affected by a short option that had a couple $100s of extrinsic left, not a dividend stock, but like maybe someone made a mistake. Maybe the counterparty made a mistake. They converted to shares. You get to keep that premium. You sold out of it again. It's only happened to me once in 10 years. So hopefully that kind of stuff happens to you guys more often. But let me know what you think in the comments below, and we'll see you on the next episode of Options in Action. We do have a fun little research piece, though, hosted by our only, one and only, Julia. Julia, how you doing?
Hi, guys. How's it going?
Good. Your hair is shiny and wavy today. What's going on?
I washed it yesterday, and now I'm wearing it. Yeah, it's a little wet still from last night, so the curls are coming out. We usually wear it in a bun. So,
hell yeah, love to
I've
see
never
it.
seen you in a bun.
You never seen me in a bun, really, dude?
No. Have I? Maybe I don't know. I can't remember.
If I wear my hair down in the office when it's like full fro, it's gonna get like caught and stuff. People are gonna be running into it. It's gonna be causing problems. So. Yeah, I'm more of a braid person, actually. I've been more of a braid person these days.
Cool. So
it's first.
Okay, well, this is me. Thank you so much for tonight. I've never been to the Hard Rock Cafe before. That was really fun.
Bow, bow.
Okay, well,
This is a song for the broken hearted. Bow, bow.
Okay.
Hey.
All right.
Why don't we get up there and you can lay some hands on me, and I'll see if you're slippery when wet.
That's really inappropriate for a second.
I want to lay you down on a bed of roses and send you off to Slumber Town in a blaze of glory.
No, don't say things like that, because my boyfriend was an aerial artist and he used to do things like that.
I might be Monday now, but someday I'll be Saturday night. You give life a bad name. Whoa, shake it up just like bad medicine. Bad medicine is what I need. I'm going out in a blaze of glory. Take me now, but know the truth. 'Cause I'm going out in a blaze of glory. Lord, I never
First thing about Tasty Trade is how easy it is.
It's a very quick, light platform. It's all on one page.
And with 1 or 2 clicks, you can be anywhere on the platform.
Being able to see graphically where your profit and loss zones are.
Whether it's a pool, a puddle, or a sea, you can navigate your way out of it with the Tasty platform. So I love that. You guys have the most unbelievable customer service in the business.
Email support, call support, get through right away.
They actively listen to the customers to make changes to the platform to make it better.
In fact, I've never seen anything like it in any corporation in the United States.
All right, so I've got some good news, and I've got some bad news. Let's get that bad news out of the way first. You are going to have some losing trades. Like every trade you place, despite your extreme optimism that it's going to work out, is not going to work out. That's the bad news. The good news is at Tasty Trade, man, we are ready to adjust and defend and roll our positions if that's what it takes. And that's what this entire crash course is all about. A 5-episode crash course all about rolling. So I will see you inside of episode number 1.
Tasty Trade has crypto, and you can trade with 0 commissions, Bitcoin, Ethereum, Litecoin, and more. Diversify in one place. Crypto, we got it, we get it.
It's time to trade smart, post PDT rule elimination. Now, traders of all account sizes have more flexibility than ever before. With rapid order entry and bracket orders that let traders manage entry, profit target, and stop loss, all in one ticket. Tasty Trade.
In the world of investing, a beast lurks between the numbers. Some watch from the safety of the sidelines, but others saddle up and ride that 1-ton rowdy ribeye for all he's got. If that's you, join us on Tasty Trade. Named best online broker for options trading. Genius loves company.
So why are we all doing all the things that we do inside of the active trading space? Simple. To make money and generate returns. Well, inside of the Tasty universe, there are essentially 5 keys to making those returns. And in this crash course, we're going to break down all the details of each one of those keys. So I'll see you inside. I'm Jim Schultz, and this is From Theory to Practice. Welcome to the show today. Welcome to the broadcast, man. Welcome to the Monday edition of what it is that we are trying to do. We did it, guys. We did it. We won the U.S.-Iran war for the 18th time, so it is over. And by over, of course, I mean this thing is just getting started. So welcome to the show. I'm glad that you are here. If you're watching over on the Tastylive network, then I would actually bounce on over to YouTube. If you bounce on over to YouTube, then you can join the conversation and join the discussion and communicate with your brethren who are also watching the program. Man, today, man, you can celebrate if you are a bull. You can commiserate if you are a bear, but I'm pretty sure it's going to be a good time had by most. So, Laura, bring us into the market. Let's take a look at what is going on out there. And, oh, by the way, don't forget, hop in the chat, ask me a question, pump it for the algo. Just put characters in the chat window. That's all you got to do. They don't even have to make any sense. Just put a bunch of gibberish in there. Just put a bunch of rigmarole in there. Put it in the chat because I want to know and the algo is dying to know. EME S&P is up 91. EME S&P is up pretty strongly on there. You got the risk-free instrument doing some risk-free things, up 634 with the NASDAQ futures. That's an extremely high-risk product if you are brand new to the show. And you just started trading, that is a very mediocre attempt at internet sarcasm. The NASDAQ is extraordinarily high risk. I mean, it doesn't even take very much, man. One little MNQ, and you are in it. Got the boomers up 399. You got the Russell 3000 down 3 on the day. And you got bonds are pretty much unchanged. You got notes are pretty much unchanged. You got oil up $1.50, which makes sense because we won the war, so why wouldn't oil be up? Why wouldn't oil be up to celebrate America winning the war? UB40 up a point. You got the Shifties down 60, getting smacked around a little bit. Got the Hunt Brothers. Whew, man, I don't know. I heard they had a pretty good weekend with the cheese and pepperoni. But, silver down 93 cents. All right, so silver down 93 cents and gold down 60. That makes sense. For a second there, I was like, wait, gold is up. No, gold's not up. They're both getting hammered. And so it's a good thing they got that cheese and pepperoni to kind of offset some of the silver contract losses. You got the British pound is down. You got the euro is down. You got volatility futures also down, which makes sense with the market being so strong. Volatility futures down 60 cents. Spot volatility down 72 cents, all the way down to 17 and some change on the day. And so it is indeed over. Volatility back in the 17 range. I mean, that's around the historical average. I mean, historical average is somewhere around like 16 to 17. It depends on where you start and stop kind of collecting the data. Some people think it might be as high as 17. I've even heard as high as 18. Historical average? I'm like, I don't know how y'all are manipulating this data, but I don't think it's 18. 18 seems a little bit high to me. 16 to 17, I think, is about right. Because 18, it's like things are moving. 18, it's like my underoos are not completely dry. I got to be honest. But it's like if it's 16, 17, that's pretty much go back to bed type of stuff. And so anyway, there's some market commentary for you. That's not going to help you in any way, shape, or form, but we already did it. Like it's over. Like it's over. You don't even have to worry about it now. And so so let's go into the portfolio. Let's take a look at what's going on here. I see you guys in the chat. Man, look at you guys in the chat. Wow, look at you guys. I see you guys in the house. Man, where are you guys at? Yeah, there you are. Ryan LP's in the house, man. Ordenu is here. Joel James is here. Sam L. SC Golfer is here. BBB Fine is in the house. Man, look at Point B in the house. MP 5850 is in the house. That's crazy. Man, that's Brian Rakuten is here. Lors is here. Man, I appreciate you guys. We even got some spammers in the house, it looks like. Man, that's good stuff. Man, I'll take whatever you guys got. Like, I'll take the real comments. I'll take the spam comments. Like, I'll take the good comments. I'll take the troll comments. Like, I will 100% take them all day long. So, okay, let's take a look at what's going on in the portfolio. MES, we have a short strangle on. And, I'm not really, I don't know, man. I mean, should we take a victory lap? Like, should we take a 4-game sweep victory lap? Like, should we do it? Like, should we go ahead and it's like, okay, we already won the first 3. We're about to win the 4th one, but then it looks like we're going to lose it. We're down 4-2 in the top of the 10th. Like, okay, it's over. And then we come back and win 5-4. Like, should we take one of those type of victory laps? Like, shut the lights off in the stadium type of victory laps? I mean, maybe. It's only a 50% short strangle, but we might have to partake just a wee little bit here. So MES, this was, if you've been following the show for any length of time, I mean, you've seen us a lot of stuff with MES. We've been short, we've been static short. I mean, lots of things to the downside with MNQ and MES. We'll talk about MNQ here in just a second. But right now we have a short strangle on, and I'm no Julia Spina, but it does appear that we are beyond 50% of max profit. Like, it does appear that we have hit our profit target and then some. Like, I mean, we sold this guy for 88.25. So if we do some quick Final Jeopardy math, if I sell this guy for 88.25 and I'm looking for 50% of that, which, by the way, for you math majors out there, is the same as dividing by 2. If I divide that guy by 2, that brings me to approximately, because you can never be sure, 44 points. Well, I can buy it back right now for 39. That's actually better, right? I mean, if I'm going to buy something, I want to pay a lower price. If I want to sell something, I want to receive a higher price. And so if I could buy it back for 44, that would be 50% of max profit, but I can actually buy this back for 39 and some change. And so it looks like we're going to actually squeak out of this thing with a little bit over 50% of max profit. So I will take it, you will take it, and we will move on indeed. So let's go ahead and close this guy down. And then we can be done with MES, at least for the time being. We'll probably get something else on here in the next, 8 to 485 minutes. So if I go into MES here, let's see here, I do 39.75. No takers, man. The MES pits are kind of illiquid today. That's a little bit surprising. I mean, MES is a pretty liquid deal. It's pretty unusual that, wow, look at that. They won't even give us 40. What is going on out there, man? So now I want you guys to see this. So look at this. I just went in at 40, right? Am I doing this right? Is this how you actually buy back a strangle? Like, I have to double check everything now. Look at the mid price. The mid price is 39.25, right? I just went in at 40. I did not get filled. I'm about to go in at 40.25. I mean, are my eyes playing tricks on me? I'm not doing the monovision anymore. Like, we're doing multifocal, baby, all the way. Which that takes a little getting used to, but it really gets to a point where you don't really think about it. And if I don't think about it, I'm usually like, that's a little bit fuzzy. But if I take a look, oh, it changed on me now. Did that just change on me? I think it did. So the offer price was $415, if I'm not mistaken. And I was about to go in above the offer to see if I get filled. We should never have to do that, right? In theory, the offer is the most you should have to pay if you want to get into a position, a stock, an option, a future, whatever. And then the bid is the low, that's the instantaneous sell price if you want to get out of your position. And so that is what the posted quote is supposed to represent. But right now, we just went in at just under the offer and we did not get filled. And again, we're not talking about some stock you've never heard of. Like, I'm not talking about B-Fly. Although B-Fly is looking pretty good today. I'm not talking about some small biotech company out of Silicon Valley that nobody's ever heard of. We're talking about MES. We're talking about the micro S&P 500 future. This is an extremely liquid product, and we can't get a good fill. Okay, so here it is. Hang on. Let me grab my magenta. Oh, they did it again. Rats. The offer was right there at like 420 again. It was underneath. It was underneath where I'm about to go in. I kind of want to wait a second. Oh, there it is. Look, there it is. Let's go in. Let's see if we can do it. I want to go in. Hang on. Look at that. I'm going to go in above the offer. Look at that. I'm going in above the offer. And I got filled above the offer. Man, it's all manipulated. It's all made up, man. It's 100% made up. Did you guys just see what happened? I had to go in above the offer. What are we doing? Like, what are we doing? Well, why do we even have quotes? Don't even have them at this point. Like, somebody just tell me where I'm at. Like, let's go verbal style. Go back to Tony and Tom were trading in the pits. I think they just shouted back and forth at each other. That's actually exactly what they did. Let's just go back to that because apparently the quotes in MES, man, that's crazy stuff. I can't believe that. I mean, I expect that out of MNQ. We know that MNQ is craptacular. Like, I already know that. You already know that, but not MES. It's like, MES, man, we got the handshake agreement. We're going to have some pretty liquid markets in there, but au contraire, mon frere, that was not the case at all. And so thankfully, we did have a little cushion to work with to where we still got out for a little over 50% of max profit. But I don't know what's going on in the MES pits out there, but somebody is sleeping on the job. And by somebody, I mean there's a robot that malfunctioned somewhere. And yeah. And so MNQ, we go to MNQ. We're at 18 days to go. So we're just inside of 21 days to go. And I think right now, let's go ahead. So I kind of like this trade where it is. I don't even really want to adjust it. I mean, we basically have a pretty tight strangle on now. This was a short call that was static short delta. We then sold the put to kind of control our bias and do things. When I think we were going to be out for a couple of days. Which, oh, by the way, don't forget, I am going to be out next week too, because my sister-in-law, they are formally adopting their little foster boy on Tuesday. Monday is the 6th, right? It's whatever July 7th is, that's the day that they're doing it. So we 100% want to be up there. Like, everybody's going to be there. And I'm like, I don't want to miss out on this. Like, this is going to be so cool and so amazing. So I am going to be out next week because we're going up to South Carolina. So you guys need to try to keep it above zero for me, which looks like you're doing okay for yourselves. NASDAQ over 30,000. Give me the hat. Give me the keychain. Give me the t-shirt. Like, I am 100% ready. But MNQ, we sold that put against it to kind of control the bias. And, it would have been a bit easier had we not done that, because when the market fell, we would have had an easier time getting out of the trade. But because we had the short put in the mix now you've got kind of the stick in the mud type of phenomenon. And so it didn't make it as easy to get out of that position. And so we're still in the trade as it stands right now. And you can see, we're down. The Penal Open Bros can tell you this. They've got all this stuff committed to memory. But you can see that we are actually down about, actually, hold on a second. Wait a minute. Wait, what? This can't be right either. The Penal Open's only down 159? That's not right. There is no way that's right. Man, I don't know what to believe anymore. Is that really right? Hang on, because we don't have anything else to do today. B-Fly is amazing. Starbucks is hanging in there. SpaceX is coming back. Verizon stinks. We already knew that, though. There's no surprises today. Hold on. Let me go back. Let me go to so we could go to the chains, and I will look at the chains here really quick. If I look at MNQ and I look at my chains, that's okay for me to kind of see where I'm at. Apparently, I'm up on the trade, which I don't know if I believe that. I don't know if I believe that. Let me go to the activity tab. We're going to go straight back to like the archaic times, like caveman stuff. So this is like 2007. Let me go to MNQ. Let me go back like 120 days. When did this guy begin? Hold on. I'm going to use both of them together. This trade began. Was it here? It was here. It was 5-6. That's right. That was it. We sold the call. I remember. I just did a calculated risk today about selling calls. And so this kind of is on the front of my mind when it comes to, naked short calls and like what you're signing up for and all that kind of stuff. And if you have followed the show for any length of time, what I'm going to say in the calculated risk episode is not going to surprise you. It's going to be all the same things that we've been shouting from the rooftops for the last, 4 years, 6 years, 7 years, whatever. So none of it's going to be new. None of it's going to be earth shattering, but you still got to watch it because your boy needs that watch time. Like, you still got to watch it. I would watch it on 0.5x speed. Like, watch that guy on a quarter speed so I get 4 times the watch time. Man, that would be absolutely amazing. But we did this on May 6th. Okay, so let's go back to, let me go into, let's go to my activity tab. Where's May 6th? Right here. Okay. May 6th. Maybe we are up on this trade. It's not impossible, I guess. So I picked up 440 and 217. We're really doing that. This might even be like 2004 now. That's 657. This is what I like to do, by the way. This is genuinely what I like to do. Like, the technology is amazing. Like, the technology is incredible. But sometimes if it doesn't make sense to me, which doesn't mean that it's wrong, it just means it's not making sense to me in that moment. If I ever get to that point, I literally go back to the roots. I'm like, okay, let me get the pencil and the paper out and let me work this out. Let me just kind of sketch out some notes. Let me do some chicken scratch and try to figure out like where I'm at in space here. And that's exactly what we're going to do here together on the show. So 657. And then we paid 32 and a quarter. I'll come back to that in a second. And then I collected another, what is that? 775. It looks like it's more than that, but we'll leave the decimals out of it for just a second to make this a bit simpler. So that's going to be what, 1432 I collected? 1432 points. And I got to take off 32. Oh my gosh, look at how feng shui this is. Look at this. I had no idea this was going to happen. And that's what typically happens with feng shui stuff. Like, it finds you. You don't find it. Like, it finds you. Look at this, man. This is amazing. It's so amazing. We're going to use a different color. 1400. Look at that. It's incredible. So we've collected 1,400 points on this trade package. Okay, so now that I know that, let me go back in and let me see what it's all selling for right now. And then I can reconcile that difference, and that will tell me kind of where I'm at in space. According to where I'm at on the positions tab and the P&L Open Bros, I should only be down like 100 points. But I don't know that that's true. Yeah, see, that's not, well, actually, hold on. Wait a minute. This thing is marking for, if I go to close this guy, well, look at that. Man, I don't know why I doubted the P&L Open Bros. I don't. They were right. They were right the entire time. I really genuinely can't believe it. So you guys just saw it. Like, you saw it in the activity tab. You saw the Final Jeopardy pen. You follow me, through the forest there. And it's like, okay, we picked up about 1,400 points. If I buy it back right now, which I'm 100% going to do. I didn't think I was up on this trade. Are you kidding me? I thought for sure we were down. I thought for sure we were still hemorrhaging cash. But now I'm like, man, that's like, what is that? Like 8 BEUs? I mean, that's a nice little payday on something that really gave us a lot of fits for pretty much the majority of its life. Right now, we were kind of strategic about it. Like, we were short with premium instead of being short like static with the future, which, I mean, that has its own set of gimmies and gotchas, of course. But, we sold the put and we did all the different things. And I can't believe that we're going to be able to get out of this thing for like a $100, it's a $100 winner. It's not even a loser. Actually, yeah, hold on. The P&L Open Bros are not correct. So once again, I rest my case. This number doesn't mean anything. This number, it is irrelevant. We are not down $180. We're up like $180. So we're actually the mirror image of the P&L Open that you see right here. And man, there you go. Wow, I really can't believe it. I'm a bit surprised here on the show. But let's go ahead and close it down. And let's just do it. Well, I mean, that's if we can get filled. Actually, hold on a second. Hold everything, because I don't know that we're going to be able to get filled. Let's go ahead and what if I do? Yeah, let's do it this way. Now MNQ, I expect to have some problems. Like MNQ, and look at that. We got filled right away. So the robot woke up. Somebody shook the robot, oil that guy back up, spray him with a little WD-40, and he's back doing what we are paying him to do. And by paying him, I mean, we don't really typically give him too much, but we expect a lot out of him. So MNQ, it is over and done with. And then Apple and Amazon, they're two short put spreads. We're inside of 21 days to go. But again, it doesn't matter. We're not going to be able to roll these for credits. I just talked about this last week, so I'm not going to belabor the point here. I'm not even going to labor the point here. Like, we're just going to move on from this point forward. So Apple and Amazon, we do nothing. B-Fly, man, look at B-Fly. So we got our 100 shares. We bought this guy for $761. It's currently marking for $905. So we are up about $140 on the trade. Man, that is a really, really solid trade. I kind of think I want to close it, man. Like, let's close it, and we'll get back in if there's a little dip in B-Fly. Like, let's scalp some B-Fly. I mean, why not? I mean, it's B-Fly. Let's close it down. And 904, sure, why not? I'll take my $150. That's another 6 BEUs. I mean, the whole week has been taken care of now. And so we are good to go, man. Like, this is some really exciting stuff. Microsoft, okay, this one's a little bit trickier simply because, I mean, this is a situation now where we've got our broke wing butterfly on. The stock is down, back around 368 or so. It kind of was showing some signs of life at the end of last week, kind of bouncing back up. But now it's like, okay, this thing is back lower, and that is not terrific, of course. And so for our purposes here, though, we're inside of 21 days to go. We're not going to be able to roll this for a credit. Like, I already know that's the case, but I'll show you guys just so that you can see. Oh, it's a 4-legged strategy. We'd have to roll each piece. So I'll just show you each piece really quick. Like, if I go to roll the short put spread, this is going to be a debit to roll for sure. Like, if I go to, well, that's because it's a ratioed off thing. Yeah, this is going to be a little harder to show from a rolling standpoint. So let's do it. I mean, we're already living in 2004. Let's do it again. Let's go to the July 17th cycle. Let me show you guys what I'm talking about here. So if I go ahead, if I want to roll the 390, 400, I'm sorry, the 400, 390 short put spread, that means I would sell a 390. I would buy the 400. This is what I would do in this cycle. I would close up July. I would open up August, and I would sell the 400 and buy the 390. And that's $1.52 debit. And I'm not surprised by that at all, because this is the side of the strategy that's not working. This is the side of the strategy that's taking on water. And so if you want more time on this, it's going to cost you something. Like if you want to extend the duration on this guy, it's not going to be free. It's not going to pay you anything. You have to pay for that privilege. And so $1.52 to rule the short vertical spread. And then if I go to the long vertical spread, this one is going to be a credit to roll. So I would, let's see, I would sell and buy the 400 and sell the 405. And then I go to August. And I would buy the 405 and sell the 400. So that's about a 60-cent credit. So not significant. I mean, it's not insignificant either, but it's not like we're not collecting like dollars and dollars and dollars. And so, not a huge difference, but just to show you that the net result, it's about $1 debit, maybe a 90-cent debit. And so it's like, all right, that's kind of a significant chunk of risk to add to the trade on a trade when the strikes don't look so great. Like this guy's not exactly on the razor's edge of coming back. Like it looks like we're most likely going to take max loss, on this trade. And so, being mindful of, okay, I want to roll this guy out. I want to roll for a credit. Like that's my default setting. But is there ever a time or a place to roll for a debit? Like I think so, but this is not the time nor the place because A, the debit is pretty significant. So that's kind of a disqualifier on its own merit. But then also secondly, it's not exactly close to coming back. Like I need a pretty significant move out of Microsoft to kind of bring this guy back above water. So for those reasons, I'm just going to sit tight and do nothing. I'm not going to do anything with this guy. So let me clear that out. The only thing I would consider doing again would be closing out of the 405, 400 long put spread if I can get close to maximum value. Right now it looks like it's only 443 on the mid price. I mean, since Microsoft is so low and I'm already at 18 days to go, I'm just going to wait on this a little bit longer. I'd like to get more like 460, 470, 480. Now, that would be, I mean, it wouldn't be quote unquote great, but that would help a little bit if I get more out of the long put spread in the event that Microsoft stays lower. What's the gotcha to waiting? Well, the gotcha is if Microsoft rips tomorrow or Wednesday or Thursday, like if we win the war again tonight, which I mean, it could certainly happen. It's about a 30% chance on Polymarket. I mean, I checked before the show. It's about a 33% chance that we win it again. Now, we already won it this weekend for the 18th time, but I see 19 right on down the chutes, man. Like it could be tonight. So if that happens, this could rocket up to 460, 470. Well, Microsoft could rocket up to 400 or 390 or whatever. And so in that event, I will have wished I got rid of the long put spread, but alas, I will not have gotten rid of the long put spread. And so, so for those reasons, I'm going to sit tight and do nothing on this guy, and we'll come back to it, of course, in the coming days and weeks. But the only other thing I want to go through is Verizon really quick, and then I want to get to you guys, man. I see you guys in the chat, man. Look at you guys, man. You guys are doing it, man. Putting in work, man. Look at you guys, man. I just appreciate you guys so much. Let's go ahead. Let's close out of Verizon. We got almost 50% of max profit. Actually, wait. No, we got more than 50% of max profit. Look at that. Got a clean hundo out of Verizon. Man, that's looking pretty good. Nice little hundo out of Verizon. And there you go. So, all right, let's go ahead and let's close out of Verizon. And, oh, wait a minute. Oh, wait. I was looking at that completely wrong. I'm so used to looking at short verticals that I didn't quite realize this is actually a long vertical spread. And so we're not going to make $100. Man, what is going on with these quotes today? This is crazy. So again, it's helpful to understand the theoretical constructs and some of like what's going on in the world of options, because you can more easily recognize when things look out of whack. Like you can more easily recognize like, wait, I've got to pay more than the offer for this MES trade? That doesn't make any sense, but okay, I guess we'll do it. Hey, wait a minute. My Verizon spread is marking for more than the width of the spread by a rather significant margin. That's not exactly right. That doesn't really make any sense. And so, for this situation, you can see that, we paid 88 cents for this guy. It's currently marking at $1.88. But if I look at the width of the spread here, the width of the spread is only $1.50. So that tells me the maximum value for this spread should be $1.50. It's not going to be $1.88. That's like some P&L open stuff, man. It's going to be $1.50. Now, it could be $1.51 or $1.52 potentially, but never when you're the winner. That's only when you're the loser. Right? Like if you think you didn't have to pay the man at the very end, like you are dead wrong, man. You're paying the man at every step in the process. The beginning, couple of times in the middle, and then one more on your way out the door. So here with Verizon, we've got to we got to close this guy down. And it's not $1.80. I'll try to get max value. I don't even think they're going to give it to me. I really don't. I think we're going to have to close this for like $1.48 or $1.49. I'd be absolutely shocked if they give me $1.50 here. Absolutely shocked. Yeah, that's not surprising. So they didn't even give me $1.50. Now, I think they're going to give your boy $1.48. Like, I really think that we've earned it. Like, I think, we've kind of done some good work today. I feel like we've put in, some solid reps. I think they might give us $1.48. If they don't, I wouldn't be totally surprised. But I don't think we're getting filled for anything under $1.45. But I think $1.48 could get hit. No takers at $1.48. Okay, so let's go back in. So now the mid price is $1.38 actually. So I might need to revise my statement of $1.45. That's not looking too good. But let's go ahead and let's try $1.45. Yeah, okay, that's not going to work either. So it looks like we are going to need to accept. Look at that mid price. Man, what is happening out there? Like for real. The mid price is $1.39 now? Or I'm sorry, $1.36? Wow. Okay. All right. Well, let's go in. I guess I'll go in at the mid price. I guess. I don't know. I don't really know what to believe anymore. All right. So we got filled at $1.36. Still a solid trade. We got 50 cents out of the Verizon deal. But man, I mean, look at that. So if you go to the closed trades, we got MES, we got MNQ, we got Verizon, we got B-Fly. Man, that's some pretty good stuff. All right. So we'll clean up the board there and get rid of that. And then let's go to you guys, man. I see you guys. We're at the middle of the show, a little bit beyond the middle of the show. Let's see where you guys are at. Man, can we surprise and delight somebody? Man, I think we can. Let's go ahead and, man, look at Theta Trader is here. Man, what's going on there at Theta Trader? I appreciate you so much. Theta Trader says you'll get the price you get and you'll like it. That's correct. It happened to us on MES. It happened to us on Verizon. We kind of got a decent price on MNQ there. That was a little bit surprising. But yeah. And so, it's pretty funny though. Let's go to Nayatasha. Hang on. So Nayatasha says, what does portfolio Vega of 515 or portfolio Gamma of 304 represent? What are good numbers for each of these? Also, my daily P&L is plus or minus 3% of net lick. Is that a reasonable range for option trading? Option trading only account, I think you mean. Okay, so a couple of thoughts. So portfolio Gamma, I wouldn't worry about that number at all, honestly. Unless you're doing if you're doing specific Gamma scalping to where and that's where you're typically buying options, oftentimes with very short durations, a lot of 0GT stuff or whatever. That's where you're actually trying to build up appreciable Gamma so that you can get, bigger and bigger moves if the stock goes in your direction or if the index moves in your favor or whatever. What we do is kind of like reverse Gamma scalping, where we're selling premium, we're trying to control Gamma, keep Gamma kind of under a lid. And so because of that, and if you're managing early, if you're managing your trades, around 21 days to go or before 21 days to go, then I don't really think you need to worry about your portfolio Gamma too much. That's not a number. I can't even tell you the last time I've looked at my portfolio Gamma, if ever. I mean, I may look at a position Gamma to understand what the Gamma is for that position, but it's never helped me, not one time, to look at portfolio Gamma. So take that for what it's worth, but I don't think it's necessary. But then portfolio Vega, this is also not as necessary because of the other metrics like portfolio Delta and portfolio Theta, but we can talk about Vega for a minute too. If you have minus 500, you said? Yeah, minus 500. So that means that for every 1 point move in market volatility, so like the VIX, you're going to be looking at about a $500 move in your portfolio. And so when you look at a Vega of minus 500, you want volatility to go down, of course. So volatility goes down, that's probably going to be about $500 for every point that it drops. If volatility goes up, then that's probably going to rise by $500 for every point that it rises. And so, I'm sorry, hold on. Let me restate that. You're short volatility, to make sure I say it correctly. You're short volatility. If volatility goes down, you're going to make money. You're going to make like $500 for every point volatility goes down. If volatility goes up, you're going to lose money. You're going to lose about $500 for every point that volatility does indeed go up. And so that's what the portfolio Vega number means. But in terms of your portfolio swings, so this is where portfolio delta really comes into play. And it all depends on how much leverage you have to the overall index, in my opinion. Now, there's other things happening like Vega and like Theta, but generally speaking, day to day, the big swings in your portfolio are going to largely be driven by delta. And so if you're like on a day like today, you've got the market is up just over 1%. So let's call it 1.25%. If on a 1.25% move, your portfolio is swinging by 3%, that tells me that you're about 2.5x leveraged to the market. Because a 3% move on a 1.25% move is about a 2.5x difference. Is that too much? I don't think so. I mean, I think that's actually fine. I think that's kind of right in the sweet spot. I think that's a very good level that most traders can carry and can live at. Some prefer to be lower. Some could even be higher. I mean, I think even going up to 3 or 4 or 5x at times is fine. 6x is usually about the limit, kind of the ceiling that I see where it's like, okay, I think that can work for kind of shorter time frames, but to carry indefinitely, it can be a little bit dicey. And so if you know what you've signed up for, then of course you can kind of do whatever you want to do as always. But I think 2.5x is actually not that crazy. And so I think from a leverage standpoint, I think you're fine. I think, it just gets to a point where if you're moving around by like 5x or 6x, 5% or 6% on days when the market's not really going anywhere, then that tells me that you have really, really significant leverage in there. And that might be what you want. Like you have to decide if that's what you want. And so, but that's how I would look at that. Let's see. Let's go to the beginning. Man, I see you guys. Look at you guys. Orgenu's in the house. What's up there, Orgenu? I appreciate you so much. How are you feeling? I'm feeling a lot better, man. Like I wouldn't say I'm 100%, but my mouth is probably about 90% now. Like most of the day, I don't really think about it. And like even on the show, like now we're almost done with the show. We got 10 or 12 minutes to go, and I'm doing okay. I'm doing pretty good. And so by the end of the week or so, I should be probably about 100%. And so you are the best teacher, man. I appreciate you. Gift that keeps on giving, man. By that, I think you mean keeps on taking. And I appreciate you. Thank you for showing us how to trade with confidence. Man, you are welcome to Orgenu. Thank you for being a regular part of the show. I really couldn't do it without you guys, man. I couldn't do it. Ryan LP is here. What is going on there, Ryan LP? Point B is here. Dr. Jim, how to know when to sell the rolled position multiple times to know what is the correct price. I have a few positions, but I don't think the 50% closing credit is accurate. I would do exactly what I just did. So you saw what I did earlier, right? Like with the MES, or not MES, but MNQ. I wasn't sure. I wasn't confident. And so I went back to the activity tab. Just go back to the activity tab, get your pencil, get your paper out, roll up your sleeves, and you can just figure it out yourself if you need to. Now, usually looking at the change is going to get you where you're trying to go. And it actually did in this context. Thinking back, I think the change did show that I was up like $200 or whatever, which I didn't believe at the time, but it ended up being correct. And so, but if you're ever unsure, just go into the activity tab and like manually crank it out yourself. And that will kind of tell you like where you're at and those kinds of things. So that's what I would do. And then from there, you can figure out like, what you want to target when it comes to, percentage of, total credits collected or original credit collected or whatever. Personally, when I roll a position, I'm not looking for too much out of that position anymore. Like any splash of green and I'm happy. Like if I get a splash of green on the page, I'm probably done. Like to me, that's a very, very good outcome because if the trade was rolled, kind of by definition, it's not working. Like it has not done what I have politely asked it to do. And so because of that, I'm like, man, let me just go ahead and, just get this guy off the books. If I get anything, any type of movement kind of back in my favor. And so, let's see. SC Golfer is here. What's going on there, Shane? I appreciate you. In for the algo, my man. Appreciate you. Sam L is here. What's going on there, Sam L? Joel James is here. Happy 4th weekend. How's the old tooth hole feeling? Yeah, man, we're hanging in there. You know, we are 100% hanging in there. And like I said, end of the week, I think maybe we'll be kind of back to pretty close to normal. And I think that'll be good. Stanwell Doc, most important question of the week. Did Miss Summer have a great birthday? Miss Autumn, yes. She, have I ever told you guys a story about my friend named Summer? I don't think I have. But so I had a friend in like middle school. Her name was Summer Slepik. And we passed, we were all in this like the same group of friends. And it was like super fun, right? I mean, we just had a lot of fun being goofy kids, whatever. It was great. Anyway, when she got married, I can't remember, she got married like 10 years ago or 15 years, I don't know. But she got married to a guy, and the guy's name was something Snow. So her name was Summer Snow. And her middle name, if I remember correctly, was Joy. So Summer Joy Snow. I mean, sometimes truth is stranger than fiction. Like, could you even put a better name into a fairy tale? I don't think so. Like, could you find a better name that you could put into a story of your choosing? I don't think you could. So Summer Snow. But Autumn, my wife, we had a great birthday. We had a really, really great birthday. And we actually played, we just kind of hung out and spent a lot of time as a family, which was really, really cool. We played Rummy Cube. Have you guys ever played Rummy Cube? Like the game with like the tiles? And they got the jokers in there, and I mean, it's super fun. And I mean, I obviously dominate that game, and so I crush everybody. And everybody's in tears. The whole family's crying. Like, everybody's crying. The kids are crying, right? The wife is crying. I'm like, listen, this is good training for life. Like life, when you leave those comfy doors that I have, put in place for you all, like life is going to beat you down. Like life is going to take you out behind the woodshed, and it's going to absolutely just beat you to a pulp. And so this is good training. This is good practice. And then the next 3 games I lost. But the first game I had him. I had him right where I wanted him. And man, it was awesome. But Samuel, Ravishar, bone saws and mullets for the algo. Man, I like it. I like it a whole lot. Bone saws and mullets. I like it. Yeah, I like it a ton. Brian Rackerton is here. Hello, Dr. Jim. Hope the mouth is feeling improved. It is. Yes, we're doing good. We're moving forward. And I'm really glad I'm where I am now as opposed to, a week and a half ago. I mean, the day when it was all done was like, man, this is not super awesome. But we're doing okay. BDH is here. Back to live humans. That's right. Still plugging for the algos, though. My man. Theta Trader, greetings and salutations. What is up? There was Laura in the house pumping the algo. Pumping the algo from inside the house. Like, that's good stuff, man. Like, the calls coming from inside the house. Like, that's some really, really good stuff. Let's see. Lorge, what are we burning cash on today? Nothing really, man. Like, I mean, I was looking at my list. And actually, I did have one thing. I did maybe want to do a little Micron. I don't know there, Lords. Maybe we do so I was going into August and I was looking at a short put spread in Micron. And I was kind of laughing to myself because I was looking at, what were we looking at? What did Amelia have for us? A 1090, 1080? Yeah, so I was looking at this and I don't know that I'll settle on these strikes, but look at how funny this is. So you actually have an out of the money put spread, right? The stock is at 1130, whatever, 1128, doesn't matter. The strikes are 1090 and 1080, and the probability of profit is 47%. Like, that is literally not possible. Like, it's out of the money. Like, the stock has to beat me. Now, this could be communicating to us like, hey, listen, Micron's about to get, beaten down. Like, it's going to get taken out behind the woodshed, just like your kids during Rummy Cube. And so you may not want to play this thing to the upside. It may be communicating that to us. Like, the market may be trying to, give us a little bit of a whisper number here on Micron. But I'm not so sure. And I'm just like, man, the markets are so wide. I mean, look at the markets. The markets are so wide. The Greeks are so crazy. I mean, the at-the-money strike isn't even a 50 delta. I mean, it's 57 on the call side. It's 43 on the put side. And so this is like, it's pricing like it's a futures contract, which, isn't that supposed to come out this summer? The individual stock futures. Remember, did you guys hear about that? That was a few months ago. Isn't that supposed to get released shouldn't it be in July? Man, that's going to be crazy, man. That's going to be crazy. Opening bell, let me buy some NVIDIA stock. All right. Lunchtime, let me sell some NVIDIA options. All right. Evening time, man, let me scalp some NVIDIA futures. I mean, it's going to be round the clock, man. Like round the clock, whatever you need, it's going to be absolutely amazing. And so Micron, though, looking at this short put spread, I was just really surprised by the probability numbers. I still like the trade. I just kind of want to move it. I want to move it a little further out of the money just to take advantage of, the pricing is just so favorable. I don't think I'm going to get 492 on that guy, but let me try. I mean, 470 on a 1030, 1020. There's no way. There's just no way. That doesn't even make sense. Yeah, you can't get 470. No, we might get 4.25. I'm not going to go down by like a penny. That's a waste of time, I think. I think we might get this, but maybe not even this. All right, we got filled at 4.25. There you go. So there's a little short put spread in Micron. I mean, if you can't beat them, you join them. I mean, this is pretty basic stuff. But Lorge, so thank you for bringing that to my attention. Joel James is here pumping the algo. Brian Racketin is here. What is going on? Doing some gibberish. Sam L, I'm assuming the cake was good, but let's be honest, it's all about the card that you made. It is. It 100% is. Like, I completely agree. I'm pretty sure she threw it away, though. And they pick up the trash on Monday, so it's gone now. It's 100% gone now. But yeah, we didn't do cake either. We actually did. So Penelope, my oldest daughter, she wanted to make some cookies for mommy's birthday. And I actually always help her make the cookies, which is super fun. Like, this is super fun. We've made a lot of fun things together. We decided to make peanut butter snickerdoodle cookies. And honestly, they were pretty solid. I got to be honest. Like, sometimes it's a bit of a, I don't know what's going to happen. But peanut butter snickerdoodle, and I'm not going to lie, they were pretty solid. And so that's what we went with. MP is in the house. Hey Theta, hey TT gang, what is going on? Theta Trader, obscure non sequiturs are what I do, Dr. Jim. You know this. I do know this. Thank you for being here, my friend. Thank you very, very much. BBB Fine says, hey, Dr. Jim, what is going on? Did you know that Ghost makes a protein bar? I did. And let me tell you something. What a letdown. Man, they nailed the drinks. Couldn't possibly have done better on the drinks. But the bars, they really, really nailed those bars. I'm sorry, they really, really miffed on those bars, man. Like, they've got the one that's supposed to taste like a Twix or whatever. It doesn't taste anything like a Twix. It tastes like a 4 or 5 day old Twix that somebody else already chewed up and spit out, and they pour some chemicals on it. I'm like, that's not exactly the Twix experience I'm going for. Maybe it is yours, but not me, man. And so no, Ghost missed it on the they missed it on the bars there. They 100% missed it on the bars there. But man, am I out of time? It looks like I'm out of time. That's crazy. That's crazy. Man, I appreciate you guys so much, so very much. If I can ever help you guys in any way, please shoot me an email. I am jschultz@tastylive.com, or we can connect on Twitter. I'm at jschultzf3. I would love to hear from you guys on there as well. But stay tuned. We do have Tim Knight coming up next with Trading the Charts. In the meantime, guys, trade them small, trade them heavy, and stay generous. We'll see you guys tomorrow.
Ready to take your trading skills to the next level? Dive into the world of stocks, options, and futures with Tasty Trade courses. Whether you're a beginner or more advanced trader, our courses can empower you with the knowledge to succeed. Watch as our team in Chicago shows you how to use the Tasty Trade platform and go over the basics of trading. Perhaps you'll learn about a new strategy or a potential product for your portfolio. To find our courses, go to the Manage section of our web platform or head to courses.tastytrade.com. Start taking control of your financial future. Visit our courses today. Investopedia says we're the best for options trading, period. Investors Business Daily raves about us. With stockbrokers.com, we're #1 for options trading and best in class for futures too. The Motley Fool really likes us, and so does Broker Chooser. So what else can we say other than boom? Trade like a trader. Tasty Trade. Make your move.
Hello everybody, Tim Knight here. It's a shortened trading week. Friday is a holiday. The only kind of big economic event this week is going to be on Thursday morning before the open. We're going to have our jobs data for the month. But today has been a weird day so far. We are up pretty strongly, green across the board. The strongest is tech. The NQ is up 2.2% at the moment. And the weakest is the RTY, the small caps, which is barely up at all, like 0.05%. And this morning, it was very strange because we opened strong. Out of the blue, we fell really hard. And then out of the blue, we went rocketing higher to the highs of the day just a few minutes ago. So it's been a very peculiar day. Of course, we went through the usual shtick we've been doing lately, which is Friday after the close, the war's back on. And then Sunday, about an hour before the futures open, the war's off again. And it happens every weekend. Regrettably, there's no weekend trading, so you can't really do much about it, but that's kind of how the world is structured right now. Let us dive into the graphs here, and we'll start with the diamond, which is looking like it's going to have a lifetime high close. The diamond's up 4.38, a little more than 400 points on the Dow. And although on an intraday basis, we were higher on, I guess that would be last Thursday, as far as the closing price goes, it looks like almost certainly a new closing high for the day. And we've been steadily in this uptrend since the bottom right here. I almost called it the Liberation Day bottom, but I'm losing track of the events. It's the Iran war bottom. But that was back on the 30th of March. Just about everything bottomed on that day. With all the green on the screens, but the only red thing out there is precious metals. And I'm sure it must be puzzling to a lot of folks who have bought into the narrative of war is good for gold and inflation is good for gold. Well, we've got inflation, we've got war, and gold does nothing but go down. I had targeted 4,000 as a price for gold. We are at 4,022 right now. I got to tell you, looking at the miners charts and some other precious metals charts, 4,000 might be too high. Could easily get into the low threes from what I can tell. I haven't had a position in precious metals for a while. I would love to get bullish on it for the long term. I really don't know when that's going to be. I think it'll be above 3,000. But like here, for example, with GLD, you can see that we have snapped below that supporting trend line. We've got our right triangle pattern here, which was broken a couple of weeks ago. And as I said, looking at silver, palladium, GDX, and individual miners like EQX, SIL, on and on and on, it looks bearish to me. And much as I claim to be a permanent bear, there are some things I would love to see go up, like precious, but it's not time yet, I don't think. We had our mania with gold and with silver that peaked here for gold just at the end of January, which seems like about 20 years ago or so at this point, and it's been just sloppily moving lower ever since. So I do not think that we are bottoming at all in precious right now. This is also illustrated with XME, which I've mentioned pretty much on a daily basis recently because, as I've said, if one wanted to go bearish on metals, XME I think is a better bet than GDX. And this seems to have played out to that pretty accurately, especially the past couple or 3 weeks here. We had a hard fall, a bounce, and then a resumption of that. And so we're basically now at the same levels we were trading literally late last year on XME. So that's a pretty ugly creature right there. Getting over to what they call digital gold, I certainly don't, but the world of crypto, some interesting things going on here. BITI, which is the inverse fund on Bitcoin, is off a little right now. Skittish beast that I am, I went ahead and took profits again on BITI. What I really want to see is a breakout from this inverted head and shoulders. That would be really something. And it would take a real failure of 60,000 on Bitcoin itself to get us going on that. It's shaping up. It's a good looking chart. We could get there. I think it's the oddness of today that made me just kind of dial back and take the money and run and get more conservative. So I've gone ahead and taken profits on Bitty. I have a small position, a short position on BITI with a quite loose stop. My stop's way up here where this gap is. Like I say, not a big position. I just like some participation in it. Crypto's obviously had a pretty rotten time since, what was it, last October? Having lost over half of its value. And the associated equities and instruments around that have too, most notably strategy. There's little bitty stuff like American Bitcoin, ABTC, which has been just pummeled, but is bouncing a little bit right now, but I don't think it's going to change the trend. But more importantly, over in Michael Saylor land, STRC, which is their high yield instrument for raising cash to buy Bitcoin, is bouncing big today after getting just battered the past several weeks. So we bottomed on Friday on this, and today it's up over 13%. I don't know all the particulars, but I believe I read that they were bumping the yield from 11.5% to 12%. Although you can see how, shall we call it, dynamic the underlying instrument's been. But for whatever reason, maybe the oversold nature of this, maybe the slight increase in the dividend, it's rallying quite a lot. And it is helping strategy recover to some degree, almost exactly the same percentage bounce. So we got 13% plus on STRC and then 12.1% on MSTR. The position in this, I believe, just looking at the long term on this, the next important level of resistance, and it's a big one, is that line right there. So we could have another day almost as big as today, and that would do the trick. So just around that orange line that you see, there's an enormous head and shoulders top above that line. And this is the classic behavior you want to see: a failure of the neckline, a retracement back to the underside of it, but the roll having changed from support to resistance, and then a resumption of the selling below what we saw on, well, in this case, just on Friday. So we could rally more from here, but key would be to watch that level. We could push past it. You know, this is it's absolutely possible because this is a very quick fall. The next level I would look at, and I'll just put up a quick line here just to note it, will be something like that in terms of the next meaningful level of resistance, because you get a lot more overhead supply at that area. Okay, well, enough about crypto. Over to tech stocks, as I said, this is where the real strength is. The cubes are up 2.44%, and the peak on this was actually back early this month on June 3rd. I believe that was also the peak for the things like the spider. But in this instance, the feature to keep an eye on in terms of resistance is this price gap, which took place between Monday and Tuesday of last week. We had a big tumble on Monday, and since then we've just been banging around this range. You know, it all seems very exciting and electric to be, you know, up. We had like a 700 plus point reversal on the NQ, but if you look at this, we're just grinding away in this range. You know, as I said, we had a dip this morning. It's recovered. We're at the highs right now, but this is the next real test, because for 5 days now we've just been running in place. SMH, of course, probably the most crucial sector in all of tech, semiconductors, is up even stronger, 3.3%. It too had a dip here. Actually, we fell the lowest we've been. And I know this isn't that long ago, but just to note, this is the lowest we've been on that since June 11. We had a lot of weakness in things like Micron, but that bottomed very quickly. I mean, the first hour of the day was just this giant V, and we're at the highs of the day now. But as with the cubes, the test is this gap right here. What will happen at the gap? So remains to be seen. It is a shortened week, and the only real, you know, obviously we're way away from earnings season. So the only things to kind of shake things up would be Iran possibly, or the jobs report. But one big instrument within semiconductors that was roiling the seas was Micron. We actually had a crack of this uptrend for the first time since it began this morning, but it was very brief and not too deeply penetrated. But a crack is a crack. We did get below it, so I'll just note that. But we are near the lifetime high still for Micron because it was down, $70 or $80 before, and now it's actually up a few dollars. And there are some instruments which also did a little bit of a fissure of their uptrends. SanDisk is one. This is actually still down $57. So it's relatively very weak compared to tech in general. We have slipped subtly for three trading days in a row here, and as I say, we did fracture that uptrend a little. So could be meaningless, or it could be the little canary in the coal mine event. Some items aren't bothering with any weakness. Applied Materials is one. This was not that long ago a double-digit stock. It was down $60, $70 stock. Now it's approaching 10 times that level. And so AMAT is up almost to 700. It's actually traded above 700 at some points today. And up double-digit percent, 11.3%. So just a relentless rally on that one. One much younger item, which is getting some much-needed buying, is SpaceX. We found over the past 4 days some stability down in the 150-ish type area, and today we're getting our first, honest to goodness rally since we pooped out over here. So we are up 7.4% on this, $11 plus, and kind of undoing some of this nasty damage that had taken place. Over in Shortland, just glancing over here, about half up, half down today in the short portfolio. FIVE is doing remarkably well on a day like this. It's down over $10. It's down almost 6%. So that's FIVE, real good looking there. ALB, it's just become like Old Faithful. I mean, look at this. Just that's very rare. Like 10 or 11 red bars in a row. So that's moving the right direction. AXTI is up a little, but still a nice little chart. First of all, it's up very modestly, considering what's going on and considering what kind of company it is. But it's also below a completed topping pattern. Some of the other items here, a little less interesting, I confess, but just to share, short these and pretty decent looking patterns. HIMS, HIMS, basically unchanged now, and we're below that resistance line. Coles, KSS, this is down decently. It's down about 4%. This is a retailer, and that's the stop on that one. LEN, which is the home builder Lennar. I've talked about this one before. This is also down pretty reasonable amount, 2.34% below this. Now I have to back way out for this one. This multi-year top. So that one looks quite good. Speaking of retail, by the way, I'm not showing it here, but another good retail short that's doing well that I've got is Costco, COST. Costco is down, not quite 1%, but it's having a nice bearish engulfing pattern today. And one other short here is VSH, which is Vishay Interactive. This one is down not quite 2%, but it did complete this topping pattern here. It pushed below that for the first time, so that one's complete. Obviously, we're not going to close below it today, given all the strength we're seeing in tech now, but it's a step in the right direction. Just to wrap up, a couple of big ETFs. One is the small caps, IWM, the Russell 2000 small caps. We are still in a steady uptrend on this one. I haven't drawn it, but this has been kind of an ascending channel ever since late March. But this is just kind of steady as she goes, as you can see, right near lifetime highs on this. But the spider is a little more clear. We peaked on this way back on June 3. We are below, barely, the price gap formed between last Monday and Tuesday, and it would be somewhat helpful if we didn't violate that, but it would not take much strength at all to do so. But that's a point of minor resistance right now. But backing up, you can see here. There's some detritus here. Let's get rid of that. You can see that over the past year and a half or so, the broad movement has been a general uptrend after the trade war, Liberation Day stuff, a consolidation period here, a brief dip because of the war, and then an ascent, which was very steady until around June 3. And so at the beginning of this month, we did snap below that, and we've been kind of violently moving up and down since then without any really plain direction, certainly ceasing that up every day market that we had experienced until early June. So a strong day today, but the gap is one to watch. And for the first time in history, I'm going to finish before the bottom of the hour. So that's an event. Anyway, I hope you're doing all right. And I will see you here on Tuesday. Thanks for coming by.
Mike, what does it mean to be assigned?
When you are assigned, you are ultimately short an option that's in the money, and the counterparty has the ability to exercise that option. So if you are assigned, it means your option, against your will, ultimately, has turned into 100 shares of long or short stock.
What does a green scratch mean?
Ooh, a green scratch refers to stubbornness getting the best of you. And when I say you, I mean me. Green scratch refers to rolling a position, defending a position, and instead of just closing it for less than loss that you're seeing, or maybe $100 loss, $50 loss, a green scratch is when you close it for maybe a 5-cent winner, 10-cent winner, 15-cent winner. Just the ability to see that green number on your screen and get out in a profitable way as opposed to a loss.
We built Tasty Trade's web platform for today's traders. See it, click it, trade it. Research with fundamentals, endless forecasts, and more. Drill into data, find opportunity, and track the action with hundreds of indicators. Track your options profit and loss history over time per symbol. Note your progress and plan your tactics with a trading journal. See probabilities, max profit, and Greeks in one click. Fund your account and start trading right in the app. The tools, the data, the knowledge. See it, click it, trade it. Join the club. Tasty Trade.
Jermal, we're back. We're here for the final 30 minutes of the trading day in this holiday shortened week. It's still Monday, June 29th, which means it's time for last call. And what a rally we have in front of us here. Apparently, everything goes up.
Apparently so. It didn't seem that way early this morning, right? I mean, when we were doing the live show, it's interesting. There's an interesting thing that happens every now and again. I can't say with certainty every single day, but most days when Tim Knight comes on, we're either heading towards the lows or near the lows of the day. And that's exactly what happened when he came on early this morning around 9 a.m. Central, 10 a.m. Eastern. And that's where we were. We were kind of in the red a little bit, if not close to it. And we were hovering, and it seemed like it was going to be kind of quiet, Chris. And then, boom, just absolutely took off. And we've been sitting around the highs pretty much the rest of the day.
Everything that was bought last week during the tech semiconductor Mag7 sell-off was sold today so that everyone could buy more semiconductors and Mag7 names.
It does seem that way.
Mag7's up nearly 2.5%. Semis are up over 3%. Nasdaq's up 2.2 right now, leader on the board in terms of the four indexes. The Russell just eked itself into positive territory right now. But we can go to the charts here, Laura. Volatility is the name of the game. 1758 right now. Jermal, it felt like in the past several weeks we've had these occurrences where the VIX popped up. The market was down 1%, 2%, 3% in some cases, the NASDAQ in particular. Overcrowded. everyone's long semis. There's a big flush, but those bursts above 20 didn't really last all that long. And so here we are entering this week now within the July window, the Christmas and July window, final 3 days of June, first 9 days of July, 2.5% on average over the past 40 years. Not bad. We're starting this off with a little bit of a bang there. Halfway through in the S&P already, 1.25% to the upside. So how are you positioned today? Because I've been grinning and bearing it through the last week or so. Today feels like a release valve emotionally, but definitely financially.
Yeah, I mean, I have been long deltas in a multitude of different ways, whether it's short puts or, whether it's sort of calendar spreads, things like that, whether it's the Super Bowl trades. And I've been picking and choosing, but the few semis that I do have, it's mostly been short puts via either just outright short puts or short strangles. And like you said, last week was a tough week for those. I mean, I have a Qualcomm put that's still kind of in the money. I have an Intel put that's not in the money now, but I had a lot of those type of trades, and so this today has been really good. I will say though, it's kind of been at the expense. You mentioned the buying in the semis. It's been at the expense of SanDisk and at the expense of Micron, which I think has slightly turned positive now. But those names were really sold off earlier this morning to the tune of close to 10%, at least maybe in both of them. I took the opportunity to get long a call Butterfly in both. I mean, something interesting and very low premium. I mean, both of them were $350, $3.50 around there for both. So just to play this week, and let's just see if they bounce back, because we've seen that happen. And that worked out really
so many
well.
times recently.
I don't think I told you about this last week. I did one of those at the beginning of last week that I held in SanDisk through pretty much almost 2 p.m. Friday. Probably held way too long, but paid off pretty well. I mean, I paid $3 for it and closed it out for $2,100. That was really, nice. I should say I paid $300 for it, closed it out for $2,100. But you guys get the multiples, so that worked out really well. And again, I was waiting in there for a while because I feel like, especially for my book, that's very low premium. But nevertheless, besides talking my book, this has been a very strong day for semis. A very interesting day too, Chris, and I'd like to get your thoughts on this. The stuff about SpaceX. It seems to me SpaceX is beginning to control the fortunes of a lot of different companies. We saw the move this morning with Charter as a result of their supposed partnership coming along. A lot of other names were hit on that. AT&T, Verizon were hit on that. What's the deal with Comcast? No, it was with Charter, right? TMUS, that's what I'm thinking of. T-Mobile is one that I sold a put in as a result, and that stock is obviously taken on the chin in recent months in a big way. But it's kind of fascinating. Last week they bought Cursor, right? And then now this week you're hearing stuff with Charter, and you're seeing how it affected the whole sort of communication space, along with seeing big moves in the names like ASTS and Rocket Lab. So it's kind of fascinating.
Iridium's up 25%, well. but Rocket Lab, RKLB agreed to a buyout of Iridium today. They're trying to build a challenger to SpaceX. But Rocket Lab's up 15%, 16% after the deal. Iridium's up 25%, so the market's clearly, consolidate. Together stronger, which is a nice signal. Rare is the occasion. But you make a good point that SpaceX is getting into the game of telecommunications. And a lot of companies don't like that. You mentioned Verizon, for example. Down. Well, that's a fat finger on that chart, but let's pull that out of here. That's a 5.5% loss today. XLC, the communications ETF, traded higher, gapped open lower. Telecom, a little bit different here, but not exactly capturing the theme that you're discussing right now. So I don't know, Jermal. I mean, I could use better cell service if Starlink wants to give it to me. I wouldn't mind having it. Yeah, I have 2 bars here in the woods. Not great. Makes no sense.
Yeah, the other stock.
2026.
T-Mobile got smoked this morning. It did bounce back. I'm glad because I sold a put in there. I thought that was an interesting trade, but that was down pretty big. And look, these names don't. I know the chart looks like this, but back in the day, these names didn't have moves like this, and so it's kind of fascinating to see that overall. Nevertheless, man, we got a holiday shortened week here.
Yes.
And not only that, of course, we have the quarter end. Start tomorrow. Basically, we'll see. Maybe this is the beginning of quarter end flows. It'd be interesting to see. You mentioned that seasonality earlier, and then on top of that, we got the jobs report on Thursday morning. So it's an interesting chalk-filled week, even though it's shortened.
Yeah, and we got a great question on Confirm and Send today that it was effectively saying on holiday shortened weeks, volumes dry up. Why not do something where you put like a short iron condor on expecting the market to stay pinned? And I think in most cases that's going to work, right? It can make sense in a holiday shortened week. But the caveat there is if implied volatility is staying low enough and there's no obvious catalyst that sits around the corner. And we have the jobs report Thursday. So maybe today's a bounce, maybe Tuesday you find a little follow through or you get a turnaround Tuesday, but Wednesday you drift, Thursday it's dead silent until jobs at 8:30 Eastern, 7:30 Central, and then you get a big move. So, realistically, if you're talking about maybe like a week where you don't have anything going on, maybe it's next week because we're pre-bank earnings, we're post-jobs report, we're not into a Fed meeting yet. There's not really the obvious catalyst there unless, we decide to go back to a war with Iran, which seemingly only occurs when the market's closed on weekends. So why would we even care about that?
Yeah, the problem with let's just look at SPX. The problem it's not a bad idea. It's just the problem is these days there's no such thing as us not really moving. Even on weeks where we're supposed to be quiet, we move, and so therefore lies the idea where would you center it around? For example, let's go to the trade tab, right? Say you want to center this around 7,500, and you're like, well, if it's going to be a big number, let's just do for Friday, right? July 2nd. And say you want to, where do you center it around? Really, that's the real question, right? We could end up moving another 150 points somehow. I mean, who knows, right? Again, it's only forecasting 81.5 points move, but who knows how it's going to play out because of all the lingering things out there. You mentioned the war, that's another thing that's still kind of hanging out there. And you just have random days like this where you still have a 80-point move, right? And so it's just hard to figure out where to center that iron condor around, I would say. I mean, that's the tough part about it. But hell, don't believe me. Go ahead and try it. I've tried it plenty of times. It's tough in this type of market where we're getting random, 1.3% moves on a day where realistically there's no real news.
I'm curious because, we have this intricacy of this non-farm payrolls report on Thursday that we think is probably going to dislocate the market, if only because it's going to be thinner liquidity conditions, right before a holiday.
Yeah.
Would you do something like a reverse iron fly here, expecting the market to deviate substantially from the current price, 74.35, prior to Thursday's close? Maybe not an SPX. It's a little expensive. You're buying the at the money call and put and then selling out the wings.
Basically, being long that straddle, expecting a big move. I mean, I don't want to bet that neither. I don't necessarily want to bet that neither. I would say. I mean, the thing that's been working for me mostly has been so far selling vol in some of these semi names, finding smart ways to do that.
Sure.
Whether it's been the ones that are set around maybe $200 or so, selling whether it's puts or selling strangles in those names, and I would say what else has kind of worked? I mean, again, I've started to move a lot of my trades out to August, maybe even September at this point. Because, again, I think what we've seen in the last couple of weeks is that when things get a little bit volatile, it's a little bit scary for some time. And I think we do have more of those flare-ups coming just because of the crowded nature of some of the trades in the market. So I think that's something to kind of consider. But, the vol is high enough where you can still take advantage, whether it's iron condors, whether it's strangles. If you have the capital to do that, I think those work. And some of the individual names and or ETFs, I think, has been the play.
Jermal, I'm being a little bit of a freak here on the screen while you're talking with semiconductors, but it feels like semiconductors are doing something they've just done several times recently, which is to say that they surge up, they trade sideways for a little bit, they give you that, is this a head and shoulders pattern forming over here? You could see it on this chart, left shoulder, head, right shoulder. You could see it here, left shoulder, head, right shoulder, and then it ultimately just becomes a bullish falling wedge that breaks out to the upside again. And I point all of that out, and as I go through to delete these ridiculous amount of lines on the chart, we have that happening again here. It's a beautiful thing about technical analysis. It feels like I'm using a crayon. But we erase the crayoning, and there's your setup again. Left shoulder, head, right shoulder, failed breakdown. We're back above the neckline. What happens when you break back above a neckline? You take the distance of the expected move and you tack it on top for gain higher. So, I mean, semis, all of a sudden, semis are a little bit back here. Markets favorable to the news that we've seen. So for me, I've been leading long deltas here, Jermal. Maybe a little bit of a stick save and a beauty. Because we were getting a drift down below that neckline. So the short put spread around 535, 540 works. What has me concerned, because this is a holiday shortened week here, if we do continue to rally in this, July Christmas window, the top side of this could get tested. And I'm thinking that maybe because we're talking about a bullish falling wedge, you return to the base. The base here would be a high of 671, and I'm short near 690 or so. So if we start to clear out that wedge, this thing looks like it's extending into new highs, and I'm in deep trouble. So I'm going to keep an eye on that the next day or two. Tomorrow, if we have a day where it pulls back in, I'm probably going to take it off. What I do think is still working, of course, is the short put spread here, which is sitting below the neckline. And obviously, this is a little bit of a 6-day and a beauty for me today, which is why I'm feeling so much better, both emotionally and financially. But I need this neckline to hold right now, and it is. And so if we do get a push higher through like 635, 640 tomorrow, it does feel like that becomes something worth extending and maybe pushing that out a little bit more, getting into the 50 to 60-day window right around 615, 610 or so. We have a line in the sand to work with, and we could start to treat as a level with which we can operate. It's still a 90 IVR. You can't go away from this just yet.
I know. And so herein lies the real question. I mean, like you mentioned, we've seen these lulls and then we see these bounces back. And so with your short call spread, that's one where you could roll further out, right? But the idea of like rolling further out, almost immediately you're thinking, well, these things are going to be higher, right? But what about the next pullback after that, right? And so I think, I think on some of these, especially risk defined, I think time could end up being your friend in a lot of different ways. That's why I'm, pushing for things a little further out, because I know VIX doesn't show it, but in these individual names, things have been volatile. I mean, these names that we're playing, in these individual names, things have been really volatile. I mean, look, SanDisk was just down. We talked about SanDisk and Micron. They were down over 7 to 10% today. Really big moves in just a single day. And then most of them, they both kind of erased those moves. That's some volatility right there. I know people are cheerleading and they're probably got long those things and they're like, yes, it came back. But look, volatility works in both directions, and that's some volatility, even to the upside, if you will.
Yeah, I'm looking at the CBOE has Core 1M, which is the CBOE 1 month implied correlation index, and that's at 7.44.
It's on there. It's
right
just
now.
it doesn't. It's on there if you. It's just there's no bid or ask, but there's just a chart.
Yeah, I can scroll through and find that in the tickers page here. But 7.44. That's pretty dang low. It's pretty dang low, and so that one thing that unnerves me a little bit, which is one of the reasons why if we get a little bit of a pullback, maybe get rid of the short iron condor. It's going to be a small loss. Like literally, I think it's like $14 there. No big deal. The short put spreads though, that can continue to work, and it can continue to work, Jermal, in part because you're getting the Nasdaq that's just behaving somewhat neatly here. The past several weeks, I've been operating around this blue line, the 50-day moving average, first establishing a position when we fell into it back here in early June, and I've been adding back into it on these little dips. So today, getting another bounce off there in both NQ and ES, it does feel validating in a certain sense. Now that we're in this bullish seasonal window where you have a technical setup where you're buying closer to trend support than 10% away from your 50-day or 15% away from your 50-day moving average, like that's a stretch market. Now it's not a stretch market. Like we've traded sideways. Think about here where we were in May. Last time we were at these price levels in the S&P, the 50-day was at 7,100, so the close is at 7,484. We're almost 400 points away from our 50-day at that point in time. That's huge. Now we just touched it early into today's session. And we've lost momentum, and price has not given up anything. This is a market that's digesting. It never got up from the table, Jermal. It's simply waiting for the next course. So I see we're in this bullish July window now. 10 for the last 10, green over 3% gains. Who am I to doubt the fates? Until the market proves us wrong, we have to just take what it's giving us here. Bounce at support. Let's go July rally.
You definitely have to take what it's giving you, but you bring up a really good point. Correlation is fairly low, and I think to that end, like I just mentioned, I'm short vol in these individual names, which are high. They're high implied vol, even if the market is not necessarily high implied vol. So I am monitoring that. My plan is to begin to close down some of these, and when I can, some of these, short out of the money puts. And again, these are naked. These are not spreads, whether it's short out of the money puts or short out of the money calls, because I am worried about the idea of a big flare up in the market and then correlation jumps for a little bit. I mean, we were on the show together when Mr. Spot Gamma himself came on and flagged the idea of correlation, and it was like 8 and change at the time, maybe somewhere between 7 and 8.
Yes.
And not long after that, we had the big pullback that we see here on the screen. So it's something to monitor as far as your short vol positions. I don't think you want to be too short volatility when not only correlation is low, and again, these are basically saying the same thing, but when VIX is in the teens. I mean, I think it's something to be aware of. You don't want to be too short that.
We go into the Friday, June 5th day. Non-farm payrolls day, Jermal. Non-farm payrolls day, Jermal. On that Friday, June 5th, we open up at 7.68 is the Core 1M reading. And that, of course, is this June 5th where we had the market that's trading near, 76.26 when the non-farm payrolls report comes out. And a few days later, we're trading below 7,300. Again, not saying that's going to happen again this time. But when you look at Core 1M right now, it's at 7.49, lower than where it was when we went into the last non-farm payrolls report. And there is one coming up. There's Thursday in advance of a holiday weekend, in advance of these low liquidity conditions. So if I'm sitting at, and the point of all this isn't to say we're going to load up the boat short deltas going into Thursday morning, although the point of this is to say that if I'm sitting on Wednesday afternoon, and it's like 23 days to expiration, and I'm looking at Thursday where it's 22, and you're a typical 45 in, 21 out person, time to take that money and run and kick out your duration. You don't want to get caught in one of these, non-farm payrolls is much better than expected. Oh, geez, we're going to have to hike rates, and all of a sudden we get that big move higher in the 2-year yield, and this Fed funds futures, which all of a sudden had corrected, to a better level this week. We're not going to get 4.25 at the end of the year. It's going to be 4. Okay, we don't need a panic. It's only 1 hike, not 2. Oh, maybe we need to do 2 hikes again ahead of a weekend. Core 1M this low. I mean, that's a 2% down day in stocks potentially. So we can put these puzzle pieces together and not get too over our skis in long deltas. If we get another day or two of run here, and you're like me who has a semi position or a NASDAQ position, good time to adjust and not have to worry about another weekend war.
Yeah, because we know the trade of semis is crowded, and that alone is not the problem. It's more like when, to your point, what last week is what really kind of pushed us lower most of the days was the dollar continuing to go higher and rates kind of staying sticky. And those two things comport with the current rate situation, which we're kind of fearful of. So it's not just the crowded nature of it alone. It's those things in and itself that could create the exit of the crowded trade. And we all know the whole analogy when you're trying to get out of a crowded trade. It's like getting through 1,000 people trying to get through a small door. I mean, it can be ugly. So I think that's just the thing to be, or being aware of your risk, being aware of your exposure. So that's what I'm trying to be. And I am trying to clean up a couple of things this week. I mean, I think I've put on about, 8 trades a day, but more than half were closing. So there's that. But I have a lot of trades on right now, honestly. I mean, that's the other part.
What's your take on breadth in this market right now? I was taking a look at the S5TW, which is the number of stocks above their 20-day moving average, the 1-month moving average. It's 63% right now. That's not terrible, considering where we've been in recent weeks. We dropped down below 30% or 40%, back in the middle of May. Yep. NYSE breadth closed last week at all-time highs, but I'm looking at the gauge here on my screen right now. It's going to close today at a new all-time high. Aren't those good things? Shouldn't we be happy about that if we're bulls and looking long deltas at least for the next 48 hours?
Yeah, it is a good thing. And I would also, too, argue that last week we did see some rotation going on. Julia came on and did a piece this morning, and it was right there in red and green, showing how a lot of healthcare names were moving last week. Lilly was one of them. I did kind of see that kind of flashing at times throughout the week, and it was pretty strong. And among others, I can't remember. Maybe AbbVie might have been as one as well. I can't remember exactly, but there was ABBV. Yeah.
Yeah. No, I was not typing in ABBA.
There was. Yeah.
It's not the singer.
There was a rotation, and I think that's why we're seeing. Because you're right. That metric, we haven't seen those metrics, whether you're looking at the one week moving average, whether you're looking at the 2-week moving average, whether you're looking at 50-day moving average, they've all been on the low end. And to Chris's point about breadth, it's really not been good in the market because it's just been semis, tech, right? And no love to these other areas of the market. And I think last week we got some headwinds in that. We saw those healthcare names. I think I saw a little bit of some financials making some moves. So I think that's good. I mean, overall, I think that's good for the rally, especially a rally where we just had a dip and you want to bounce. I think that's exactly what you need, Chris.
It's exactly what you need. And sometimes you need a friend, Jermal. It's not you, but sometimes people who are trading want to have a friend to trade with. I certainly, at the end of the day, no joke, there's probably 3 or 4 people I have on rotation that I talk to after I finish work, just purely about market stuff. And they're all professionals, so I can't do refer a friend with them. But maybe you have someone like that in your life if you're listening into this, where you like talking markets and they want to get into trading. Tastytrade.com/refer a friend. $100 to you, $100 to them. Tastytrade.com/refer a friend. Jermal, there's nothing else to say there.
No.
It's a social activity to a certain extent. People trade from home, and then we talk about it and we count our blessings or we lick our wounds.
Yeah, it's kind of like a therapy session.
Yeah. And markets are closed 5 to 6 p.m. And I was telling you earlier today, I can't really work out now in the afternoons. I have a baby at home. There's a 6-year-old. So I work out in the morning now before work. I'm trying to start consistently be that kind of guy. But at 5 o'clock, it means it's time for a cocktail. And it means it's time to talk markets with friends.
No doubt.
So it's a different dynamic, but I'm enjoying it during the summer. All right, so 74.92, Jermal. I mean, there's not much more to say about the indexes here at this point. In terms of those big single movers today, we could pull up a heat map here. We could just go to the watch tab, the high options volume watch tab here on the platform. What's moving the most? You're looking at a lot of these names that are like new economy names. A lot of the meme stock names, not the AMCs, the GMEVs of the world, but the retail-friendly names. Your Cerebus, your Rocket Labs, hell, even Corning. Can't believe I was talking about this last year with a few of you guys when it was trading at $45. It's one of the stocks that I never just Corning, crazy.
I know.
But that's kind of the theme today, though. Everything that was a little skittish last week and shifting into value, not even quality. Everything's back into growth mode right now, which is the first good thing that we had to say on air. It feels like, in a week? We had 5 down days in a row for the S&P 500.
Mm-hmm. Yeah, I would say that MicroStrategy you had up is one of the bigger surprises of the day. I know they came out with news, but I mean, there's been no news that has been able to lift this thing until recently. So you wonder if this is a dead cat bounce or if this is for real. I think a lot of people, I'm curious to see if this is the point where a lot of people are going to start looking and say, ooh, these names are interesting, this Bitcoin stuff. These are pretty low. I'm going to take a stab here at getting long. I'm curious about that because if you remember me saying this 4 years ago, I was trying to will this into existence during 2022, and we'd see, I remember specifically a lot of people were trading the 210 spread, and I wasn't trading it at the time. And before I knew it, sooner or later, everybody was talking about it. We'd come on every day on Futures Power Hour and we'd talk about it and where it was. And I just remember everybody in our circle was kind of trading it some, and every other day that went by, they were complaining about it more and more. And I think if you remember at the time, I said, I think the best thing to do is wait until the chorus of people who have a trade on are complaining about it. And if it's been a long time, then all of a sudden it's going to become interesting. And eventually it did. Now it took some time, but eventually it did. I feel like MicroStrategies and IBIT and Bitcoin itself are kind of the same type of deal. A lot of people have talked about Bitcoin. A lot of people talk about the pain. A lot of people talk about, Sailor and what they're going on and everything that's happening there. So I'm wondering if at some point, pulling this up on the regular, right? I'm wondering this is going to be the inflection point, if this is the beginning of the bounce in Bitcoin and these names.
Yeah, I mean, so the response today, and I just wanted to pull up here, Strategy has released a new digital credit capital framework, dollar reserve policy, STRC, their preferred perpetual dividend, STRC, digital credit and MSTR repurchase authorizations, BTC monetization plan. This is a significant shift. So first off, I've seen some commentators say this is a plan to wind down the company unless Bitcoin rallies. That's probably a stretch too far, but it's definitely an admission that the way that they were conducting business previously was not working. And, does that mean that they're going back to the old adage of sell kidneys before you sell your Bitcoin? Absolutely not. That's very clear here. They've made a very explicit point that they have a fund, $1.25 billion of BT monetization authorized to rebuild or replenish the reserve fund that for the preferred dividends and interest. And right now, that dollar reserve level is at about 17.4 months. So they don't need to sell any more Bitcoin right now to cover their losses. You're seeing a huge rally today in STRC, 12% higher. So they're trying to make good on this and get STRC back to par effectively. And I think the market's buying it. But they just couldn't keep doing their whole thing the other way, period, end of story. Does MicroStrategy survive now? I have no idea. But like they kind of threw in the towel on a losing bet. They're still not going under, but they threw in the towel on a losing way of going about things as their share prices and STRC clearly demonstrates over the past 2 weeks, 3 weeks.
And they had to do it. I mean, you know, there's so many different examples we see over time, right? Where you have these situations that a company or whoever the founder may be, they're running it and they think this is a way to run it. But we've seen this before, or we've seen it with funds, right? We talk about the long-term capital situation. I mean, sometimes people just feel like they're too smart for the situation. So I feel like this was probably a good move. We'll see what it yields, though.
Yeah, I mean, Bitcoin has to bounce. That's the end of the story here. If Bitcoin doesn't bounce, then you're looking at, MicroStrategy potentially issuing more equity at relatively unappealing levels. They're going to have to raise their preferred yields to get more people into the STRC, or then STRC falls apart. So Bitcoin up 1% today, and I think that's one of the bigger differences. MicroStrategy up 12, STRC up 12, and then Bitcoin only up 1. So the market's giving, Saylor a little bit more time here right now, but if Bitcoin is not able to get back off the lows, MicroStrategy is letting you know that they have a legitimate issue on their hands.
Pull up ES and pull up the 1 minute chart. We just got a surge higher here towards the end of the day.
I saw that up over 75.02 right now, and a little bit of a bounce there. A few minutes here, about a 12-point bounce. Volatility likewise coming into the close. You could see here the VIX popping below 1750 ever so briefly. That's an 87 cents today. You mentioned stocks bouncing here. I'm going back to that 1 minute chart. NASDAQ is touching the highs of the day north of 30K right now with about 5 or 10 seconds left. And it's semis and it's the Mag7 name leading us to the upside right now. Semis about to go out on the highs here too. Jermal, I know someone who last week was very, very happy, which made no sense to me. And I know someone who's going to be very unhappy today, which makes a good deal of sense to me. Can you guess who it is?
I certainly can. And that's the ebbs and flows of the market. I can't wait to see what happens.
Next on Overtime.
Mike, what does it mean to be assigned?
When you are assigned, you are ultimately short an option that's in the money, and the counterparty has the ability to exercise that option. So if you are assigned, it means your option, against your will, ultimately, has turned into 100 shares of long or short stock.
What does a green scratch mean?
Ooh, a green scratch refers to stubbornness getting the best of you. And when I say you, I mean me. Green scratch refers to rolling a position, defending a position, and instead of just closing it for less than loss that you're seeing, or maybe a $100 loss, $50 loss, a green scratch is when you close it for maybe a 5-cent winner, 10-cent winner, 15-cent winner. Just the ability to see that green number on your screen and get out in a profitable way as opposed to a loss.
It's time to trade smart, post PDT rule elimination. And Tasty Trade has the tools traders need. The Active Trader tab's comprehensive market data is designed for rapid order placement in a single click, while bracket orders let traders set entry, profit target, and stop loss all in one ticket. From the Positions tab, you can monitor positions, roll trades, close positions, and create conditional orders. Now, traders of all account sizes have more flexibility than ever before to engage in the markets. Smart tools for smart traders. Tasty Trade.
We built Tasty Trade's web platform for today's traders. See it, click it, trade it. Drill into data, find opportunity, and track the action with hundreds of indicators. Track your options, profit, and loss history over time per symbol. Note your progress and plan your tactics with a trading journal. Fund your account and start trading right in the app. The tools, the data, the knowledge. See it, click it, trade it. Join the club. Tasty Trade.
So you're an active trader, looking to increase your return, decrease your risk, or quite possibly both. Sure, you've heard of the Greeks. You know, your deltas, your thetas, your vegas, your charms, your vamas, etc. And you're wondering, hey, how do I use these guys to improve my risk-return relationship. Well, join me for a 10-episode crash course, and I'll show you exactly how to do it with all the gimmies and gotchas, one Greek at a time. We'll see you there.
When the market moves, traders need to move faster. Tastytrade Active Trader Tool offers full depth of market visibility, one-click order entry, and instant position management so traders can react in real time. While others charge for professional tools, Tastytrade provides them for free. Opportunity can move fast. Seize it with Active Trader. Try it now on Tastytrade.
Grow a strong community with Tastytrade's referral program. When your friend joins Tastytrade, you'll both receive $100. As your community grows, you get more bonuses. Only at Tastytrade.
Stocks rally. Someone's undeterred. It's still Monday, June 29th, 2026. Happy birthday, wife and brother. That's convenient. Pro tip to all the young listeners out there, you never forget if you marry someone who's sharing the same birthday as one of your siblings. I'm Chris Vecchio. He's Ilya Spivak. Ilya, hope you had a nice weekend. I know that you were celebrating a birthday in your household as well, so happy birthday to your wife there.
Indeed.
We have a market that decided to celebrate, of course. We have the Iran war restart this weekend, which is always a delight, 5 p.m. Eastern on Fridays, but 4 Eastern, depending upon futures or cash equity, but neither here nor there. It wrapped up before trading started at the beginning of this week when 5:55, the futures market. Pre-show begins with first call. Ilya and I were out. Mike Butler and Errol did an awesome job taking it home this week, Ilya, and they were greeted with a gap higher because the Iran war ended again right before the market opened. What are those odds? As someone had pointed out to me in the chat today, really gives a new meaning to weekend warrior.
It really does.
All right, yeah, I'm not going to Home Depot. But we do have stocks here on the other side of the weekend where we have some pretty good news out of Korea, perhaps. It was an 800 trillion won fund. I got to double check the math on that. That's off by a magnitude. But it's good for Samsung and SK Group, SK Hynix, which in turn will see that they'll be able to expand capacity moving forward because there's so much dang demand. But there's more supply coming into the market. Ilya, maybe none of that story matters because today is the start officially. We're now in the Christmas and July window, 2.5% higher for the S&P 500. Final 3 days of June, first 9 of July. Higher by 2.5% over the past 40 years, 78% of the time. And so we start today with a 1.27% rally here in ES, halfway done. What's your problem with this market, sir? Semis are up, Mag7's up. All the stuff that fell last week is back up this week. All the stuff that was up last week is down today. It's more growth. It's less crap, so to speak. We can call it value, but it was just the cheap nonsense that was up. What's wrong?
Well, what's changed? I mean, if we judge this market on the basis of one day, I think we look at this one day and we say, right, we're still in the same range where the S&P has been since, the first half of May. Have we gone anywhere? No. Now, I know you love a head and shoulders at the top as a continuation pattern, and it could still be that. But we don't know.
Oh, well, it's nowhere close to a neckline breakout yet.
Right. So
if it were,
then it would be. But it isn't. So the problem I have with this is very simple. If you look internally here, where former resistance turned support is, and let's maybe go to a more liquid contract than H7, we take a look here and we go, right, so have we gone anywhere? No. Still right where we were sitting.
Midpoint of the trading range.
Midpoint of the trading range. So for me, this becomes a question of, all right, well, maybe this is a breakout higher eventually. I certainly do not have any better of a crystal ball than anybody else. But when I look at this and I say, okay, well, what's my risk reward if I'm short against the top of this range? And that's my point where I say, okay, if it breaks the top of the range, I'm wrong. It hasn't broken the top of the range or even approached. So for me, this changes nothing. I think when you look at the nature of the event risk we're facing this week, and there is all the macro event risk you could possibly imagine compressed into 4 short days. Let's see if this market breaks, and then let's see which way. Because there's plenty of reasons to think that this is the event risk the market doesn't want to see.
Yeah, and that's for what it's worth. And this is, I guess we're going to answer it for a third time here on air. Usually in holiday shortened weeks, and if we think about what happened through the week of Juneteenth here, Ilya, the market really didn't do much of anything. 15, 16, 17, 18. We closed the prior week 74.97. We finished that next week at 75.70. So, 80 points, 70 points.
Yeah.
Not really anything. But that week there wasn't a major catalyst in front of us. And so I know during holiday shortened week, someone had asked the question, if you're looking at, a market with, holiday shortened week, low liquidity, what do you do? Do you want to do something like a short iron condor? That's typically something that could work around a Christmas or Easter, for example. But this week, it's kind of just like June 5th. We're going into June 5th. You have a non-farm payrolls report. Correlations, the Core 1 index is below 8%. Right now, and you've seen a market that's retraced Fed hike expectations. So yes, short iron condor in a holiday shortened week might work, but that's in the absence of an obvious event risk. And so maybe tomorrow is a turnaround Tuesday, Ilya, the market slacks off or it extends higher. I would think that Wednesday you probably get a little bit of sideways drift no matter what happens tomorrow. Mm-hmm. And then Wednesday into the Thursday session overnight, things are going to be sticky. And then 8:30 comes, and that's when you're going to get your movement. So if I'm doing short iron condor, maybe for the next 48 hours, but I would want to have that lifted before non-farm payrolls on Thursday. That could really be dislocative in that thin liquidity condition.
Yeah, and there's ample event risk even leading into that because, sure, we got non-farm payrolls on Thursday, and there's a lot of kind of relevant event risk baked into that after what's happened with the last Fed meeting and what's happened with the data last week, in particular the GDP number revision, which never should we really care about a third revision of GDP. But these numbers were actually very, very interesting. They showed us an even bigger disconnect between the consumers and the business investment part of the economy than we thought was there earlier. And so we ended up with stronger growth at the headline, but the nature of that growth looks even more inflationary than it did before. And the consumer looks already even more hampered by that than we thought. And by a long mile. Frankly, this was a very weak consumption quarter.
It wasn't great. The one thing that I'm looking at here on these charts, though, I'm seeing the beginning stages of a lot of continuation to the upside in this seasonally bullish window.
Yeah.
I'm looking at XLI here, industrials. They had their breakout. We could even readjust this. We could do a ray here instead, and that might actually work a little bit better. You can see here how we had our breakout, Ilya. Mm-hmm. And then pull back to the breakout and then continuation to the upside. I'm looking at biotech. Biotech's really surprised me in recent days. This has just been a big run. It's been a nice run. Little left head, right? Very, very, it's marginal, but we can have fun with the y-axis there and make that a little clearer. And that kind of tells the story. Continuation to the upside higher. Even technology is pulling back up as a broader sector here. XLK pulling up at support. The NASDAQ holding against its 50-day. So, for me this week, I'm getting into the teeth of some expiries here. For SMH, for example, I have a position that's sitting right now at 25 days. At 25 days, do I want to hold this? It's a short iron condor position. So would a non-farm payroll pullback really scare me? No, it wouldn't. Actually, it might help this as we're getting away from the midpoint here. But if tomorrow we drift back in, why have capital tied up going into a holiday weekend? It's going to be 24. Wednesday's 23, Thursday's 22. This is a short iron condor, so we want to go before we hit the decay curve, 45 in, 21 out. This is going to be coming off no matter what. So there's that to consider. There's the fact that the NASDAQ, for me, building into the short M&Q positions that we've been talking about here in recent days, Ilya, this has worked out. And so I want to see a little bit of tenderness. I wouldn't mind a little bit of tenderness, but continuing to press higher and holding that 50-day the next few sessions, which it did at the start of the June and did over the past few days, that all can work out. So tomorrow, unless we see last week's lows broken, this really is just going to be a week where I kind of just tend the garden and kick out duration on some trades if provided the opportunity.
Yeah, I mean, I'm not looking to do anything terribly novel with the equities unless they show some sort of a meaningful breakout this way or that. I have my exposure. I've already kicked out maturities, so I got plenty of time. At this point, the positions I've got on are going to give me at least 2 months' time to just sit and watch for S&P and for NASDAQ in particular. I kicked out to 63 days last week. So all good. I can
So
wait.
today hurts less than it would have had you been in the shorter dated position.
Well, of course. And I took the opportunity. I mean, last week was a nice little sell. I took the opportunity to diversify a bit and kick some parts of the exposure out. And so for me, the interesting stuff this week really won't be in equities unless they break. But I think between ISM and the jobs data and Warsh speaking in the middle of the week alongside all the other major central bank heads, Lagarde is speaking, Andrew Bailey from the Bank of England is speaking. They're all in Sintra, and we know what happens. Right? Sintra is one of these Jackson Hole for Europe situations where they get together for the ECB Central Banking Forum in Sintra, Portugal, and it becomes a forum where explosive things get said by important policymakers, not unlike Jackson Hole in August, where the Fed does its version of this. And so there's a lot on the menu here that could get stocks to break. But unless they do, my interest is mainly in the dollar and in oil, and maybe even gold.
You mentioned, and so both of us kind of have the same, more or less the same problem right now in terms of our positioning, which is that insofar as in terms of how we're trading stocks, we're both short gamma right now, which is to say that we would like for realized vol to be less than what implied vol is. And so the risk that you and I are facing, both as someone who short put spreads in the NASDAQ and semis, you as someone who short call spread in stocks, generally speaking, is that if we get a sharp move on Thursday, you and I can both be right if the market stays pinned on Thursday, right? Yeah. Because then we're going to get that we get theta decay working for us, volatility's coming back in. If it's a rich IV and we're short call spreads or put spreads, then up further, grind down in gamma works for us, particularly on a holiday weekend. But if this thing goes vertical to the upside, you're in trouble. If this thing goes vertical to the downside, I'm in trouble. And it's one of the reasons why I'm looking at Thursday and thinking about all this constellation of stuff, Ilya, going into this non-farm payrolls report and where the risks are. Jermal said I could pull it up on the platform. I'm not going to go fishing right now, but I am going to bring this up here on TradingView real quick. Core 1M is the implied volatility in the market as a correlation of implied volatility in the market as measured at the broad index level. And you can see it's pretty dang low right now. Okay. Beginning of June is when this correlation, Core 1M, is only lower. Going into that Friday for the non-farm payrolls report, it opens up at 7.68. Right now the reading is 7.49. So that, in the context of us showing up to a non-farm payrolls report on Thursday ahead of a holiday weekend, the bond market closes early on Thursday as well. It feels like it's a pressure cooker right now, and we're primed for a big move. I don't know which way it's going to go, but we're primed for a pretty decent move on Thursday. Just plain and simple.
Yeah, I mean, I think, especially after what we just learned, which is that we can get a war is on, war is off, who knows where the war is. J.D. Vance was all over the media this weekend talking about, hey, we either are going to get a deal in these 60 days or we're not going to get a deal, but either way we win. Like, okay, but if a stray missile hits a boat in the Strait of Hormuz at any point, then it's closed again effectively. So how does that help?
Heads I win, tails you lose. What do you mean?
That's right. But crude oil, it sort of reminds you of that scene at the end of Training Day, where a very weathered Denzel is attempting to stand on his own 2 feet, screaming, "Either way, I'm winning. I can't lose." Well, we know how that movie ended.
That we do. Crude here. Maybe this is an interesting development. The fact that crude oil today stayed up after the weekend, despite the unwind occurring in the tensions. We haven't seen that in recent days when we've gotten those, the U.S. and Iran may be jostling again, and then, no, never mind, just love taps or not a big deal. Crude's immediately unwound itself.
Yes.
Today, that wasn't the case. So, it's only a 19.6 IVR, but volatility has started to pick up. You can notice last week the IVR hit a low, believe it or not, of 9.24. Maybe we're starting to round a corner here and finding a bit of a low in vol. And if we are, and we start to get a little bit of positive technical drift, there is long deltas in crude could be something that's worthwhile. And this becomes very appealing right near the open prior to the start of the war. I really like trading around that low that we have on February 26th at 62.96.
Mm-hmm.
I am so hard pressed, and clearly oil has fallen a lot, but I'm so hard pressed to thinking that we're going to fall below the levels that we were at prior to the war, given the situation with the SPRs around the world. But that said, Ilya, I have seen lots of people say that oil is due to fall back into the 40s.
Yes.
Which to me, I can't seem to wrap my head around. I'm obviously not that smart.
Nonsense. It sounds like nonsense, to be honestly.
Yeah, I'm clearly not that smart, right? Grew up a Mets fan and never changed to the Yankees, despite having ample opportunities my entire child and adult life. But explain this to me. Why are people saying that oil should go into the 40s? And as a follow-up question, when people that I know who don't work in finance at all are sending me things about oil falling into the 40s, shouldn't that be a signpost in and of itself?
I certainly think that you get something of a signal from those kinds of things. They're a sentiment indicator to sort of answer that backwards. I also think when you look at this market being basically back to where the war started, and you think to yourself, well, are we back to where the war started actually for how this is going to work going forward? You go, well, no. So what's actually going on? I had a great conversation with the legendary Bob Ryan earlier today. Bob Ryan was the head commodities strategist at BCA for 13 years. Before that, he helped develop the first WTI options. Before that, he was an economist at EIA advising the White House. So, needless to say,
I think of the Boston Globe sports writer when you say Bob Ryan, but that's me.
Needless to say, Bob knows what he's talking about and has probably forgotten more about the crude oil market than anybody in the world knows. So, I was talking to him and asked him, like, Bob, how does it make sense that oil is down here? And the video will be up on YouTube shortly before long. But what Bob said I thought was really interesting because he said, well, look, we've got a mini glut right now because all the ships have exited the strait. Or at least they're able to. And there's a lot of them in there. And they're coming out. And so all of a sudden there's all this oil. We have inventories that are non-existent, that need to get filled. We're entering the big use season seasonally at the same time that we're going to do this. Ukraine has gotten a lot better at shutting down Russian output and has degraded about 40% now of their capacity.
Remind us to talk about the Russian war. I saw some awful stats over the weekend, but go on.
Yeah, so we're in a place where, in the best case, everybody needs to restock in size and supply is tight. And Iran says they want a toll on the strait. That was what we saw this weekend. Why did they shoot? Because the boat went on the Oman side of the strait. And Iran says, no, if you want to pass through the strait, you go through our sphere of influence or not at all. And if you go to the other side, we shoot you. And what does that mean? Well, that means that either you agree to Iran effectively shutting down the strait again, or you let them have a toll, in which case things are expensive again. So the argument that Bob is putting out there is, well, look, 80 looks like it's about a floor-ish, and we're off that now. So we're already a bit cheap. And so once this kind of initial oversupply on top of a sentiment sort of relief thing washes out, you're back to a place where oil is expensive, you need a lot of it, and Iran can basically hold the strait hostage whenever.
Mm-hmm.
That doesn't sound like it's going to 40, does it?
No, it doesn't at all. You know, I want to just divert there for the Russia war in Ukraine. Foreign Policy magazine had this article this week, and as the tide turns against Putin, beware the drowning man.
Yeah.
The average life expectancy of a new Russian recruit from arrival at a training ground to death in a combat zone lies somewhere between 10 days and 3 weeks. Once a Russian soldier has been sent onto the battlefield, they are surviving an average of 20 to 35 minutes. This is a meat grinder.
Russians take meat grinder as a military strategy for not the first time here.
Very, very seriously, apparently.
This is not the first time. This is not the first time. In many ways, this is how World War II was won.
Yes. That is absolutely true. So what do we do to see a corner turned here in oil? How will we know that we're out of the woods? I mean, CLZ6 and CLQ6, it's slightly different, almost the same cut of the jib here, but I'm going to point to those lows near 70. In fact, we can just call it 70 in CLZ6. Get back through 70, you're back through the swing lows from March and early April, all the way out to April 17th. You're back to the 1 week average. Then you have a tradable low to work around with. Q6, obviously, a little bit more sensitive to the front end supply concerns, and therefore when we get this, the war is ending, the front end is pricing in that supply tightness a little bit more than the back end, so that falls harder, further, faster. That's going to be sitting closer to 75 as a line in the sand. So still some work to do here, Ilya. But crude turns a corner the next few days. Wouldn't be a bad idea if you're being a silly summer bull like I'm about to be, like I am being right now in the stock market, and get some long deltas in crude here.
I'm looking in the same direction. I'm looking in the same direction. I don't think I have my confirmation yet, but if you look at a 4-hour chart or an 8-hour chart here, you can see very clearly where the bounds of the consolidation range are in crude. And that's kind of my North Star. It breaks out of this consolidation range, I'm getting back long. And I'm glad you brought up the gold chart here, because I am of a very similar mind here.
Looks terrible. Last week it bounced at the 4,000 level, the swing lows that you have in late October prior to the major rally starting. I mean, we go from 4K up to 5,600 in the GCQ6 contract in the span of, 1, 2, 3 months, realistically? Yeah. October 28th up to January 29th, 3 months and a day. That's the low. And we bounced there last week. We paused there last week. That line's going to stay in the chart when I go down to the 4-hour. So we get the bounce there last week. We start to peter around here. Is this already flailing out? Are we already losing momentum right now again? I'm still sitting short gold. I'm still sitting short gold right now. I know that that's what makes today so remarkable, Ilya. Gold is down. What went on with treasury yields today? Yields flat.
This is the part that I got out of my short gold exposure because of what's going on in yields. Because ZN looks like it's breaking out higher.
Sure.
And when ZN is breaking out higher and stocks are soggy, that tells me, and by soggy I mean, look, we have all the good news. What possibly better news do you need?
That the hyperscalers investing all of this money into AI aren't just lighting it on fire. They're actually able to turn a revenue as a result of it. And it's not just a B2B transfer to semis and to semi-caps.
If Perfect. Exactly. If you're not prepared to take that point on faith anymore, like you've been able to take it on faith.
We haven't. Microsoft's down 30%. Oracle's down 30%. Meta's down 30%.
For 2 years. Yes.
Not this year.
Right. Not this year. Not this year. And so you have a bit of a different thing here now. So you've been sitting basically going nowhere for a month and a half in the benchmark indexes. And the bonds are starting to break higher. I look at this and I go, wait a minute now. It seems like the market has figured out what is already occurring in Europe and in Australia could very well start to occur in the US and Japan.
This is Fortress America, baby.
You can have Fortress America all you want, but if your manufacturing sector, which is maybe 20, 30% of the economy, is doing all the heavy lifting, which is what we're seeing globally. Meanwhile, you have to spin that so quick that you throw around so much inflation everywhere that you squeeze the consumer to the point where they can't consume and services crack, because that's what keeps services alive, and services are by far the largest part of the economy, 60-70%, depending on where you look. If you cannot keep the consumer powering services, you do not have economic growth. Well, the manufacturing sectors in the Eurozone, the UK, and Australia are not as exposed to AI. They are somewhat exposed, in the Eurozone especially, but not as exposed as, let's say, Japan and the US. So they're booming. They're booming. Manufacturing in Australia is booming. Manufacturing in the Eurozone and in the UK, they're booming. They're catching some of this AI.
Germany just announced their Volkswagen shedding 100,000 jobs. I mean, is manufacturing really booming when Germany's largest auto manufacturer is shutting down that many?
Lithography for chips exists only in the Netherlands.
So that's one country.
Forget Germany and their cars.
Well, that's one. I mean, that's one country.
But if everything is narrowly powered by the same chip boom everywhere, which it is, you can see it, then the problem, as you can see in the Eurozone, you can run the manufacturing sector hot.
Yes.
But it's squeezing services into contraction.
I know, but overtime's out of time. So that's tomorrow's problem. We'll be back same time, same place, 4 Eastern, 3 Central, right after last call. So for Ilya Spivak, I'm Chris Vecchio. Good luck trading. Ilya's sticking around, though, after a brief break. He's here with Macro Money. See you there.
All right, yeah, I'll talk to you. There she is. Good, you found the place. Good, you're not stupid. I dated 3 stupid girls in my life. I loved every one of them. So maybe you're the next one. Having a good day? I'm having an awful day. But then it got really good again. Oh, good. So I'm feeling all right. Hey, where'd you go to college?
I went to
University of Penn State Community College. You didn't know they had one of those, did you? Yep, the Fighting Rams.
Oh.
I'm one of the Rams now. Do you have any sexual fantasies?
Excuse me?
I do. My parents are watching. They're sitting on a rainbow. I'm a half man, half giraffe, and I'm dressed like Brett Favre. What does that mean?
I don't know.
Yeah, talking about it gets me pretty hot, though. Uh-oh, there it is. His pants just got tighter. I'm a vampire. Can you believe that? Does that make me more mysterious and attractive? Uh-oh, watch yourself. We don't want to get hit by a car.
Oh.
My brother did that once. He can't talk now.
Oh, my God, that's serious.
Yeah, pretty serious. Are we getting serious? I think so. How many kids do I want? 5? 11?
Oh.
First meal. Here we go.
That was rude.
This is on you. So much time is flying by.
Yeah.
You're very funny.
Oh, thank you.
Does anybody ever tell you that?
Yeah.
Well, you're not that funny, so don't worry about it.
That's interesting.
Not a big fan of Sam's anymore. But now you know everything about me. I feel like I'm opening up so much. God, I'm scared. This thing's moving so fast.
Yeah.
Oh, wow. I haven't cried like this in a long time. Are these tears? Uh-oh, here we are. Front door. Big first kiss moment.
Oh.
This is just moving a little too quick for me. You're a great kid.
Global markets never sleep. Explore them with Forex, now available on Tastytrade. Get in on over 80 Forex pairs, 24 hours a day, 5 days a week, with the Forex platform that adapts to your style and speed. FX marks the spot. Trade it on Tasty Trade.
There's a beast in the financial world, and it's not the bull. If that's you, join us on Tasty Trade. Genius loves company.
So why are we all doing all the things that we do inside of the active trading space? Simple. To make money and generate returns. Well, inside of the Tasty universe, there are essentially 5 keys to making those returns. And in this crash course, we're going to break down all the details of each one of those keys. So I'll see you inside.
There's a beast in
Stock markets manage a rebound, but ultimately don't get too far ahead. And the question now comes, well, we got a shortened week in front of us and plenty of macro risk inside it. Will we finally get a break? That's what we're going to try to figure out here on Macro Money. This is Ilya Spivak, head of Global Macro here at Tastylive. And we'll start here, as we always do, with a look at the price action and how we're setting up here, and then try to answer the question, is the economy already starting to chip away at what these markets are able to do? Here's the S&P 500 as our check on sentiment, and we can see it's basically grinding where you would expect. If this has basically emerged as the range going back roughly to around here, call it the first half of May, we're basically right in the middle of where that range is. And so at this point, the question becomes, well, what is sentiment going to do? And more importantly, what is going to move the needle? Now, what's interesting about all of this is, of course, one of the major kind of points of conversation is what has been going on with the war and with the implications that that has on inflation and on policy. And looking at where crude oil is in all of this, you can see it continues to kind of hover where you might expect. This is the gap here at the start of the war. And since this memorandum of understanding between the U.S. and Iran, we've kind of slumped back. We can see a good deal of geopolitical risk coming out of the market, and so sentiment improving. And of course, at the same time, the strait is ostensibly open despite some shooting there over the weekend. It seemed like both sides were quick to walk that back, at least in terms of the conversation around, well, we still have a ceasefire. We are still in this 60-day window to negotiate something. And indeed, the number of boats traversing Hormuz has increased somewhat. We're kind of hitting a peak of maybe 20 a day as of last week, and some days it's less. And of course, over the weekend, it was much less. But it seems like we've started to get some sort of movement here. So it's not as if we don't have some genuine progress. And it's not as if there's not a whole bunch of pent-up supply sitting in the Strait. So it looks like the markets are responding. But at the same time, start to see some inklings of maybe this is about as far as this goes, because as we look at what momentum studies are starting to show here, we can see negative divergence beginning to emerge here. So even as the price is setting lower lows here, the oscillator, in this case, the relative strength index, but you can use whichever one you like, they're all going to show basically the same thing. It's diverging in a way that says this down move might be losing momentum. And that's an interesting thing, of course, to keep in mind here, because this has been a bogey for inflation expectations. Now, what's interesting even more so in this context is against this backdrop, we see that bonds are trying to break higher. They appear to have overturned whatever this former resistance or former support turned resistance was. So this consolidation range right here seems to have given way, and they're trying to push higher into some kind of a place where the implication would be lower yields, which is very interesting in this context because, of course, it doesn't look like we really have much of a resolution sentiment-wise, and it doesn't look like stocks are finding much good news in this. After all, if the war is as over as the drop in crude oil prices implies, and indeed we're starting to see things unclench on inflation as the bonds imply, shouldn't stocks be surging? Isn't that the best of all possible worlds? And if that's happening at a time when South Korea's big chip maker, Samsung and SK Hynix, are announcing that they're going to spend something like 800 billion won, or just over $500 billion on more capacity. That's happening at the same time that we get scorching results last week from the US's biggest chip making operation, Micron. If all of that is happening and stocks still can't break out, well, what gives, really? What's the issue here? And so some of the interesting points starting to emerge here really stop adding up if you apply to them the sort of war trade logic. It's a similar story in gold, where we can see we're, again, setting lower lows nominally, but again, diverging in a way that's not dissimilar from crude oil, even as we approach something like a supporting level and still kind of hover in the vicinity of the 4,000 mark as we try to negotiate that. It's also something that's appearing in the US dollar, where the uptrend still is very much intact, and it does look like we've punched through a very important range top here, going all the way back to essentially this time last year. But we're starting to come off a little. And so when you see the dollar come off, when you see bonds go up, when you see gold start to show signs of maybe its sell-off is losing some steam, and crude oil has basically erased the impact of the war, you start to say, well, okay, so if the war was an inflationary threat, everything seems to be starting to move as though that is receding, and especially the asset at the center, crude oil. What's the stock market's problem here? And for that, we start to have to look at the macro data, because it seems like the wartime narrative is giving way to something else here. And it is with that in mind that we're going to look at a busy week on the calendar. It's a shortened week because we've got the Independence Day holiday weekend coming up. So Friday is the observed holiday off. And so we've just got Monday through Thursday as far as U.S. markets here this week. And within that time, there's going to be plenty of event risk. Later tonight, we're going to get PMI numbers out of China, where we can see standstill is expected to continue. 50, of course, is neutral in the logic of these numbers. Above 50 is growth, and below 50 is contraction. So we're looking for basically flatlined manufacturing and service sector growth for China for a second month in June. That's what these numbers comport to. Then on Tuesday, we're going to get U.S. job openings, and there we're looking for a little bit of a downtick from 7.6 million down to about 7.3. Then Wednesday, we're going to get inflation numbers out of the Eurozone, where we're expected to stay unchanged at the core at 2.6%, but the headline looks like it's set to ease a little bit from 3.2 to 3% year on year, and that's probably the influence of crude oil waning a bit amid this most recent pullback. There's also going to be a very big day of speechifying at the ECB Central Bank Forum in Sintra, Portugal. That's the annual gathering there. And as you can see, on Wednesday, we're going to have new Fed Chair Kevin Warsh speaking. Of course, we're also going to have the BOC Governor, Tiff Macklem, the BOE Governor, Andrew Bailey, the ECB President, Christine Lagarde. So all of these big central bank heads tackling the very issue that the market seem to be concerned about, the read-through from the war, and for that matter, as we'll talk about momentarily, the AI boom, into inflation, and what that means at a time where, for example, in the Eurozone, growth is contracting. And in the US, where growth is slower than perhaps we'd like it to be. Within that same vein, we're going to get the ISM manufacturing numbers. And here, things are particularly interesting because these ISM manufacturing numbers, on the face of it, look like they're going to be about unchanged from the prior month. 54 was the previous reading. We're looking for almost that. Again, just a little bit of a downtick, 53.7. That 54 that we just recorded in May of 2026, that was the strongest that we'd seen U.S. manufacturing since May of 2022. So we're talking about the strongest in 4 years, and we're expected to be at about the same level here. Now, what makes this very interesting, of course, is we've just seen U.S. PMI numbers from S&P Global last week that showed us just how booming the manufacturing sector is, and this would confirm that, but also that the service sector is anemic to a point where it is barely wiggling. We have a little bit of growth, but we're just barely making do and close to standstill. And of course, what makes that interesting altogether is that manufacturing is largely where this AI building boom is. The service sector is where the consumers are. And the service sector is understandably then much larger, as is consumption, as relative to business investment as a share of GDP. Speaking exactly to that idea, and explain momentarily why that difference is so important, and really giving us a view on that service sector and the consumers that power it, will be the June payrolls report coming out Thursday this week because of the holiday. 114K expected. That's down from 172K in the prior month. The jobless rate seen holding unchanged at 4.3%. 114 would be relatively low, comparatively speaking. The past 3 months were 172, 179, and 214. So this would be relatively soft compared to the preceding 3 months. Not quite as bad, of course, as the 156K contraction in February of this year, but certainly a down step from where we were. And as ever, we'll watch the revisions as well as the numbers themselves. It's also very interesting in this context to note what's going on with average hourly earnings, because the rate here has now fallen below the rate of inflation. So the jump in inflation over recent months now kind of scratching at the 4% level for the first time in quite some time, in a few years actually, is outstripping wages. And this is really where things get dicey. This is why perhaps what we're watching in the markets now starts to look like maybe it's not just the war trade going haywire. Like maybe a new relationship is starting to emerge. We saw this revision of US GDP numbers last week. And of course, what we learned is that GDP grew even faster than we expected at first blush. It was first estimated at 2%, then revised down to 1.6%, and on the final reading adjusted to 2.1%, so even stronger than the first forecast. But what we see over the course of these forecasts is that the degree to which this is being driven by business investment has only increased. Now, at first glance, it was a little bit stronger than at the final. And the difference here seems to have been made by this welcome revision in imports, where they shaved more in the first sort of view than ultimately in the final analysis from GDP. So this third revision gave us less of a down drag from imports on the overall number. But of course, that's a part of this equation, because what we see is consumption is extraordinarily weak on final analysis, contributing barely anything. And in fact, making the smallest contribution other than imports, which is negative, to overall GDP. Now, in that context, actually, a decline in imports, which is a negative number in GDP calculus, kind of speaks to this. If we're importing less, that's less demand, which is, of course, the same story as a weak consumer. Now, that every other category contributed more than the consumer is, of course, striking, because the consumer is by far the largest category. 68% of GDP is the consumer. By extension, the service sector, which is the thing that the consumer buys. Everything else is a pittance. Business investment, the big AI building driver of what we're looking at here, data centers and such, is only about 14% of the economy. And the way that you get this kind of growth arrangement still giving you positive numbers, we can see here this 2% growth rate, how can it happen if the consumers are basically absent and they're the biggest chunk? Well, you've got to really overclock what's going on in the other sectors. And in this case, in particular, business investment is really where that strikes. It is growing in the double digits, in excess of 10%, whereas clearly the consumer is retrenching here. So what's interesting about this, as we've discussed before, is first off, it puts something of a cap on growth. And we can see here why. So we were averaging growth of about 4% before the government shutdown in the fourth quarter of last year. We've only come back to 2%, so we've only reclaimed about half. You can see this is where the share of consumption in GDP starts falling. Where it was healthy, the growth rate was much higher. Now the main driver is investment. We can only manage 2%, and that's not surprising, because historically, going back decades, this is all the way back to 2020 here, so about 2.5 decades back, the contribution from fixed investment to GDP almost never exceeds 2%. In fact, it's done so only twice. in this period. And one of them was the rebound from this crazy downswing amid COVID. And so it's basically a statistical anomaly. Other than this is the only other instance. In general, growth contribution from business investment kind of gets capped at 2%. Consumption, of course, can do much better. We have regular moves here into the over 2 and approaching 3 and even 4 range. But this is the part of the economy that's relatively weak now. And so you start to have to ask yourself the question, well, what does this do then? When you have an economy that's growing at about the speed that business investment will allow it, about 2%, and you're having to get there because you're having to overclock business investment to this extent because the downdraft from consumption is so significant in that consumption is 5 times larger than business investment is in the GDP calculus. And well, when you have to spin it that fast, not surprisingly, you start throwing off inflation because money starts changing hands very quickly in what is a relatively narrow pocket of the economy, comparatively speaking. So when we looked at the inflation numbers that we saw last week, the Fed's still for now favored gauge, the PCE index, gave us the obligatory jump because of the energy shock. And yes, we know that and expected as much. Surely almost everybody did as well. But then we also see that core services prices have increased markedly here and now are showing the biggest contribution to the overall numbers in 3 years. Now, that's not the energy shock as such, although there is some scarring from the energy shock there through things like the cost of freight, the cost of warehousing. And you would expect if whatever's happening in crude oil here actually sticks and prices do stay down, despite some of those signs of maybe changing momentum that we just talked about, well, then maybe that washes out of the equation. But the core part of this that's thrown off because the way the economy is growing is on the back of a smaller engine, manufacturing, and the business investment that's powering that manufacturing, as opposed to services and the consumers that power that sector of the economy. You're getting inflation from just the nature of growth itself. And of course, we already see, in the case of the Eurozone, in the case of Australia, in the case of the UK, the problem now faced in the US has already turned into a contracting economy there. The PMI numbers from S&P Global showed us that although all of those countries had manufacturing sectors that were benefiting from the AI boom to some extent, and therefore were growing at a brisk speed, were not only not enough to offset the inflation they were creating and the weakness that that was imparting onto consumers who found prices just too punishing to bear, but the service sectors in those economies are already in contraction mode. And so the economies there are already in contraction mode. And of course, as you look at then what's going on in the US and you say, well, we're not there yet. Yes, but the ingredients are certainly there. The service sector is basically near standstill. So for as long as this continues, it will continue to feed the inflation that then squeezes the consumer and turns this thing into a vicious cycle, whereby the economy appears to be eating itself. And so this is why this economic data this week is going to be so critical. we're going to see if, in fact, we need to be worried about what's going on with the consumer. And in this sense, job openings fit the bill, as does, of course, the jobs report on Thursday. And then, of course, we're going to see the extent to which manufacturing is going to keep being an avatar for this inflationary impetus in the economy above and beyond, and one might argue even before we start to do any kind of math on the lingering effects and the scarring from the U.S.-Iran war. And so already we can see there has been a hawkish shift in Fed policy expectations. This was, of course, the wartime shift. But tellingly, we can see for those economies already seeing the pain of a hamstrung service sector, things have started to move the other way a bit. And the total tally for rate hikes is starting to edge back. Now, for example, in Australia, there's been 3 hikes already. So of the 89 basis points priced in, 75 are already on the books. And we can see the probability that we're going to get all the way up to 100 basis points, that we're going to get that next and fourth installment of tightening, that probability has been fading back. The likelihood that the ECB is going to deliver in excess of 2 hikes, that's fading back. The likelihood that the Bank of Canada does anything at all, that's fading back. They're only at 17 basis points now. That the Bank of England is going to do 50 basis points has been basically erased. They're down to just 1 hike. Meanwhile, the calculus for the Fed keeps getting more hawkish. But when we look at the breakdown of probabilities, we start to see, wait, hold on a minute now. We had 2 rate hikes pretty well priced in. 1 this year, 1 next year, or maybe even 2 this year. Just very recently. And now it looks like the markets think, okay, we're going to get our 1 hike, but then we're going to stay there. We're not going to get any more tightening. We're not going to get any cuts either. Markets were flirting with the idea that maybe we're going to get a hike and then a cut in quick succession next year. But it looks like the markets are now anchoring to 1 hike this year. It arrives by October, and then we stand still. And this is where those worries about the economy start to take center stage. Even in Fed policy expectations, we seem to be starting to recognize that this growth mix is setting us up for some sort of a cyclical punch in the gut. And so, from an exposure perspective, I am still sitting on these short call verticals in stocks. I am still sitting on the long side of the bonds here. I've got a call vertical in TLT at the long end. I've got some outright calls I bought in the middle of the curve, the 7 to 10 year Treasury ETF, IEF. And I am looking closely around what's going on in gold and what's going on in crude oil, thinking if this is starting to look like a cyclical risk and bonds are going to start moving higher, at least gold might have a tradable bottom from which to operate here. And crude oil is worth watching as well, because if that starts to revive some of the inflationary impetus with a bounce, that only compounds the problem. That is macro money for today. As ever, we are here Monday through Thursday, so every day this week. That's right after Overtime, a show that I co-host with Chris Vecchio, where we look at the Wall Street close and what may follow thereafter. I'm also writing for the News and Insights portion of Tastylive.com and commenting at Ilya Spivak on former Twitter and on Blue Sky. If you're watching on YouTube, please like and subscribe. Macro Money returns tomorrow. Happy trading.
What's up, Tasty Nation? Happy Monday. It is June 29th. We've got a short week ahead of us with the observed 4th of July holiday on Friday, which means if you have any trades or things you want to adjust, the last day to do that is Thursday. There's about a 115-point implied move in SPX for the week, so it seems like it'll be a little quiet, but there are some interesting things around the corner. You've got Nike earnings, you got Constellation Brands earnings, and I think most importantly, you've got a jobs report on Thursday morning that could push or pull the market in a pretty big way